That South Africa has myriad problems on all fronts, I think, is a given. Criticism, grandstanding, and point scoring really is a national sport. Noise is, though, the essence of democracy. But the time has also come for us to collegially and with level heads start to look for real solutions from all sectors of society. And that is the idea, the premise behind Moneyweb's new podcast series. It's called Fix SA. I'm Jeremy Maggs, and I've been in the business of talking to and interviewing people for years and years. And this podcast is going to offer tough conversations around South Africa's national problems, spanning service delivery, governance, social cohesion, and the economy, and a whole lot more. But here's the difference. Our intention is to interrogate creative ideas and workable solutions on how South Africans can navigate and ultimately solve problems, drawing on the insights of South Africa's top business leaders. Starting in early November, you can download episodes every second Friday on moneyweb.co.za, the Moneyweb app, Apple Podcasts and Spotify, or follow Moneyweb News on social media for more updates. I'm really looking forward to you being part of Fix SA. Moneyweb, your trusted source for business and investment insights.
The Moneyweb Frequently Asked Questions series. Part 1, all about shares.
Hello, I'm Simon Brown. Welcome to part 1 of Moneyweb's FAQ video series. In this series, we're going to give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I'll take you through all you need to know about shares and more. The most popular question, what are shares? Shares are listed slices of a company. Each share gives you the right to a share in the profit and a vote at the annual general meeting. They trade in an exchange, such as the JSE, whereby investors can buy and sell. Another popular question, why do shares exist and how do they work? In order for a company to raise money rather than a loan, they sell part of the company to new shareholders who essentially give the company a permanent loan. What are the different ways I can buy and sell shares? You buy them through a stockbroker or within a fund, such as a unit trust, an exchange-traded fund, or a pension scheme. Will I be taxed on my shares? If you make a profit, you will indeed be taxed, but only when you sell. Dividends, your slice of those profits every 6 months or year, will be taxed at a flat 20%. In the next video, I will highlight important information to consider before investing. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Good morning and welcome to the third Moneyweb Be a Better Investor conference. My name is Ryk van Niekerk and I'm the editor of Moneyweb. I am thrilled to be your host for today's virtual event. It is live streamed on the Moneyweb website, our YouTube channel and our app. I believe this conference will equip you with the knowledge and tools to become a better investor, whether you are just starting out or looking to take your portfolio to the next level. We have an exciting lineup of sessions featuring many of South Africa's top investment minds. The full agenda was emailed to you this morning, and it is also available on the Moneyweb website. As you will see, the main themes promise to offer insights into the status and prospects of investment markets, how to build generational wealth, the impact of fees and taxes on investment performance, and how to pick the best possible financial advisor. We will also look at how blockchain is disrupting the market. I also want to hear your views. Please send your questions to the YouTube channel chat box or email events@moneyweb.co.za. If you share some insights on social media, please use the hashtag BetterInvestor. So sit back, grab a cup of coffee, and get ready to learn how to be a better investor. We will kick off proceedings with an We will kick off proceedings with an overview of investment markets and the prospects for the rest of the year. We have seen significant volatility during the first 3 months, and there is currently a lot of noise in the market. So it is not easy to identify clear signals of where markets are going. I have two panelists to assist with this discussion. Joseph Busha, he's the Chief Investment Officer of Busha Investments, and Tsepo Modiba, he's the Chief Investment Officer of Cannon Asset Managers. Tsepo, thank you so much for joining us this morning. Let's start off with noise and signals, because we see investment markets on a good day move 1.5%, 2%. On a bad day, it can be a lot more than that. We've seen some 3% plus movements over the past 3 months or so. So how do you distill signals from the noise? What are you looking for to try and gauge where markets are going?
Good morning, Rick. I think markets are almost inherently a contradiction, right? We're taught as investors to pay attention to all the information coming out, but you can drown yourself in a lot of that information. I think the important bit is to focus on the drivers of why you take investment decisions. As an investment firm, we spend a lot of time looking at valuations and fundamentals of businesses. So what we're always trying to discern is whether the news coming out really changes our investment thesis on either the market as a whole or individual stocks. And I think that's the key component in remaining sane and not fluctuating as the market fluctuates.
Sane, it's an interesting term. But Joseph, in the past we would value companies based on future performance or expected future performance, and there are many very financial, focused models to do that. Is that still the case at the moment, or does the geopolitical developments and the monetary policy type of movements we are seeing, does that affect it maybe more than in the past?
Well, certainly you just mentioned some of the key points, really. 40 years ago, or in the 60s, there were very few variables that would determine where the market is going. So currently, you've got the geopolitical issues that come into it. Then you've got country risk, a specific kind of risk that comes into it, and obviously the fundamentals. Now, your MPCs or central banks today, they play a massive role in terms of determination of valuations and where they're going, because they make decisions on interest rates, and some of them obviously inflation. So then they've got a dual purpose in terms of the monetary policy and certainly where inflation and interest rates go. So those really certainly play a massive role, and you'll be able to see that over the last 10 years, how geopolitical events, politics, the noise comes into it. If you're doing your studies, the issues where you say you must do SWOT analysis and PESTEL, which talks about political legislation and so on. So those really are coming into effect. And you have seen it, with the Russia-Ukraine issue. That's massive geopolitical factor that brings in the volatility you talked about. If you just look in terms of the volatility since the COVID, we have remained quite high. In terms of volatility, but also when you just look in terms of the volume of equities traded on the JSE, you can pretty much see the trend in terms of the fear and the behavioral finance coming into play as well.
I don't want to get to emotion, and I'm sure during this conference we're going to hear from several different speakers that keep emotion out of investment decisions. But the swings we are seeing, I think, are partly, if not significantly, impacted by emotion. Emotion by professional investors, because we are seeing significant volumes on many markets around the world. Is it a nervous market which causes this? And how do professional investors look at these developments? They see the market up or down 4%. Does that influence you? And how do you take emotion out of it?
I'll keep going and be the boring traditional investor. I think ultimately what you want to try and do is have an investment thesis, a basis of that. And you touched on a little bit about how perhaps how we assess valuations has changed now relative to before. I would say actually this period, we've seen periods like this before in financial markets, the 70s. Investors who've been around since then talk a lot about how the 70s unfolded, particularly in the US market. I think for emerging market investors in particular, we're sort of accustomed to volatility. But I will further say that I think it's important to try and block out the noise and keep focused on why you're buying. Is there something fundamentally that's changed on a day-to-day basis that changes that?
Are you trading in your funds more often than you did 5, 6, 7 years ago?
No, we aren't. I think the fundamentals of businesses aren't changing as frequently as the market sentiment and movements. I think it's really important to keep a hold of your emotions. What I will say is not the day-to-day movements, but the significant market changes where the market either rallies 30-odd% over a couple months or it drops down significantly, as we've seen in pockets of last year, do present interesting opportunities. I think there's stocks that we've added to our portfolio that certainly I didn't think that we'd get an opportunity to, just given how much they had rallied before.
Joseph, you've been in the market a long time. You're a very experienced fund manager. Has your trading behavior changed, say, compared to a decade or so ago?
So certainly, I think you do have a long-term, your long-term view and your long-term strategy. And when you do an investment, it's based on valuations in terms of obviously the long-term. But when you change your portfolio in terms of whether at stock level or asset level, you capture the mispricing that happens. But if you then say what has changed over the last few years, I mean, I remember trading at the JSE in the 90s when I was a diagonal. What would be the drivers then? Could you just look at trend analysis? Could you just look at interest rates or the MPC? But also, we must accept as investors that the way of business is changing because of technology and AI. So if you're not going to look at big data, artificial intelligence, if you're not going to look at the disruptions that has been brought in by technology, if you are a financial service business like a bank, now you must understand, or insurer, you must understand that the mobile providers, software providers, are also doing financials. They're in insurance, they are in banking, and so on. So you got to be able to say your income streams, okay? How are they changing? How are you diversifying to be able to make sure that you can still remain relevant and compete? So the way you communicate, there's now WhatsApp, there's Facebook, there's Instagram, something like that. So there are different ways of marketing. There are different ways of where business models are changing. In the past, you would look at, my favorites was like Omnia, Sanlam, where you call them defensive stocks, right? Okay, but is it relevant now? So if you look in terms of Sanlam, from a share price perspective, it has remained really kind of stuck, between 50 and 60 for a very long time. But you could say possibly, it will give you the dividends you want to get, but you might not get a lot of capital gains. So there are few changes. You need to be able to change. But also the investment horizon, people would focus for 10 years, but now you need to look at the shorter term, possibly 5 years, to be able to determine your terminal values, for your equity valuation, to say what is the enterprise value of the business. So you can't go long term any longer, purely because it's now more difficult to determine the interest rates which you use to discount the cash flows, to get your valuations.
So it's a lot more difficult today than 10 years ago.
It is, because your factors that are changing, both quantitative and qualitative, are more complex. you look at the volatility, you look at the optionality that's coming through to change some of your stocks, and really just a question of the globalization as well. So your current risk right now, if you invest in offshore, okay, that also becomes big in terms of currency translation. And also the fact that the companies are now global. So you earning money in the US in dollars and in euro and in rands. So when you do your financials, you do your currency translation. At what rate do you do and what do you use? So those things really are making the investment market a little bit more complicated, but certainly experience then comes in to say, well, here is your long-term view. This is the reason, like Thepo said, why you entered into a particular stock, but you have to look at changing circumstances, to be able to say, well, the fundamentals are still the same, but because of the dip, I still like the share, let me buy more. So the noise, so you make money out of the noise, mispricing, and mispricing comes out of noise.
Let's talk about cycles. We are in the midst of monetary policy tightening cycle, not only in South Africa, but also around the world, and it has had a significant impact. But there are also investment cycles. So let's get into a helicopter. Let's go up as high as we can and look down at investment markets, and it's a broad term because many of the markets are correlated. Where are we in the current investment cycle? And I know it's a difficult question, but if you take the 5 to 10 year view, how do you foresee markets adapting to what is happening, for example, in the monetary policy arena?
I think it's quite a broad discussion point. I think there'll be sub-cycles within the broader market movements. One of the key themes, I think, going forward will be the divergent performances of different commodities, right? We know specifically commodities like copper and nickel, there's going to be a ramp up in demand as the world shifts to electric vehicles, as an example. Just as an illustration of that point, between 1 and 2 kilograms worth of nickel is used in internal combustion engines, and between 40 and 60 kilograms are used in electric vehicles. So if we're moving to a world where half of the vehicles produced are going to be electric vehicles, that gives you a sense of the likely ramp up in demand for nickel. Copper is quite similarly. The outlook for platinum is different, given the reduction in internal combustion engines, but that will be a function of the take-up in hydrogen as an alternative technology.
Commodities, you think, would be supported with these developments?
I think some commodities will be, and I think I think where we are in the world is there'll be a big divergence across sectors, across individual counters within those sectors as we go along. I think what we've seen for the better part of the last decade and a bit is a general thematic investing has done well, right? If you invest broadly in the large tech companies, you're riding the wave and you're doing well from that. I think the big theme will be individual companies, individual sectors doing better than others. And I think that will be a dominant thing. In terms of an overall market view, we're relatively bullish on the outlook for equities, locally as well. I think local markets from a valuation perspective are looking attractive relative to a lot of markets around the world. We're quite bullish on emerging markets, South America in particular. And we think it'll be a bumpy ride. But certainly, if you can put your seatbelt on, you'll survive that ride through the cycle.
Yeah, absolutely. You need a gum guard in these markets. Your perspectives on the cycle?
So we have just come out of the lowest interest rate environment in 40 years in many countries. before the tightening cycle started now, and it was driven purely because of inflation that was getting out of control. We're still kind of in the tightening cycle. And once that is the situation, there's obviously an asset allocation shift between fixed income instruments or investments, securities, and equities. Now the movement then would be, how much are you moving from fixed income to equities? But within the equities also, there are sectors in terms of cycles, where, are we in a kind of in a bull run kind of cycle, and in which sector? Now, you have the commodity sector or the resource sector. Then you've got the industrial, and then tech and financial, which I'll just kind of group together, to say, if we look in terms of the cycles, where are people shifting and in which cycle? Also, if you look in terms of, the global corrections that has happened, whether you can call them crashes, on average, every 6 years, you kind of get a little bit of noise and the market kind of bumps.
A reset,
Yes, okay. So if I just go back when I was at the JSE as well, you look in terms of 97 during the rubble crisis, then followed by some few years, 2001, 2003, the Iraq War, then 2008, and obviously just now a little bit of the COVID. So cycles, you can't time them, but certainly there's a period, where you kind of shift and move towards as people move from one asset class to another, and shift to just make sure that there's smoothing out of performance, and you really don't get out of kilter into that. So currently, I think there's a little bit of shift into the fixed income. I think this year might end up like last year, where we're pretty much flat. If you saw in 2022, so we ramped up from 2020 to 2021, where the equity market almost recovered 40%. Then between last year to 2022, October pretty much flat, and then we had quite a nice pickup this year when the JSE reached all-time high. But now we basically possibly down from there. In the first quarter we will be certainly down. So America is going to take lead the world markets in terms of where we're going, in particular in interest rates cycle.
But we are close to the top of the interest rate cycle.
We are certainly close to that. It's a question of now just managing. But remember, now we still have the geopolitical issues. Then on the domestic side, we still have constraints in terms of manufacturing sector and all the sectors in terms of the electricity shortages, which is really just hampering in terms of the outlook for economic growth. We do have also issues of unrest, in France, people striking, all those things really.
No, we don't have a monopoly on that.
And in SA, our biggest challenge is municipalities, because there's no leadership. So would that lead to unrest and further disturbances, or in terms of, the economic activities, in particular the retail sector? So I think those are all things, but I'm not basically very bullish. Only when the interest rate cycle kind of tops up and we see inflation coming down, people start moving basically into equities from fixed income after they've just fixed their portfolios. And the sector is really to look at possible to be resources and financials.
Yeah, I agree. I think once I don't know if we will ever have certainty. I think the word uncertainty is overused, but I think when interest rates, if that cycle turns, it could be very positive for equities.
I think that is the historical trend. What I will say is, if you look at the US market in particular, it's not so much that we need interest rates to start being cut. You need a stability in interest rates. And given that curve is flattening, I think we are closer to that point than many realize.
Let's talk about valuations.
Yeah, it cannot be flattening, because if you've been getting yields coming up, was the yield curve normal? Are we getting it into a bump in the shorter end where the yield curve is shifting? So it depends where it pivots really, because if you are increasing your short term and your long term is going up, so it must start normalizing again as they start cutting. So that basically depends where the point of inflection is. and where people then reposition. But remember also the US, we have elections coming next year, and Mr. Trump has thrown his name in the hat, and we're not quite sure also how that will play out in terms of just basically market sentiment. We cannot take out sentiment, and certainly your leading figures in the investment world where they put their money. But I think all of us, if we're to learn from Warren Buffett, certainly, obviously, you're riding the wave over the long term does help. But I think we still, like you said earlier on, there's still some bumpy issues, and we need firm decisions, both from central banks' perspective, but also the political leaders.
But you say firm decisions. My perception is that there is almost a brutality in the way the Fed approached inflation. It's been a very, very aggressive response. Is that what you're referring to?
Well, they wanted to tame, but you see, when I talk about basically following fundamentals, is to basically remove emotions and say, how do we tame the market? In other words, how do we control the market? Because we still continue to see lots of pumping of money into the financial market, with Credit Suisse coming down and SBV coming down as well. You see that there's just been lots of money that is being pumped in, but American jobs are being lost as well. You have got a few guys who have been shedding jobs. In particular, last quarter and this year. So I think, they need to make a decision to say they don't want the market to overborrow by being very aggressive, which is what you just said. You have also seen that they started increasing by 25 basis points, but certainly I think if they do increase again by 25 basis points, it might reach a boiling point. So they need to basically look into that and start toning down in terms of their rhetoric.
You've raised the issue of banks. We've seen some action in the US, a very, very significant reaction, negative reaction stemming from that. We have recovered from it somehow because I think the short-term problem has been addressed. But then we have Credit Suisse. There are concerns about Deutsche Bank. And the financial sector is so critical to markets. I think you can have problems in many other sectors and you won't have this reaction. Banks, they are the cornerstone of virtually every economy, if not every economy in the world. What are your perceptions about what happened now, the market reaction, and do you think this crisis, in quotation marks, has been averted?
I'll just touch quickly on your comment around Deutsche Bank. It's funny how emotion and sentiment helps drive fears. So the concern with Deutsche Bank is because the CEO came out to say everything's okay.
Every bank says that.
And everybody panicked. What do you mean everything is okay? I think if we take a step back, one of the key curse words, of course, in investors' minds across the globe and business mind is regulation, right? But I think this banking crisis that we've seen as a function of what happens when regulations aren't put in place. So the key driver for what happened with SBV is, of course, there was a realization of compliance with regulation for banks under a certain size in the US. That enabled the management team to then take more aggressive bets in terms of their deposit book and where they invested, and we're seeing the consequence of that. I think from a banking perspective and investing in banks, ultimately confidence is crucial, and those markets where the regulation is very clear, and at some points we complain about how stringent it is, have managed to preserve depositor money over the years. So the likes of South Africa, Brazil, and a few of those markets where indeed the banking sector is actually quite deliberate around how they enforce those rules, have managed to keep stability in those sectors. And I think as an investor, it's an important thing to keep considering, that regulation isn't inherently good or bad. It's just to assess whether it's the right regulation for a particular sector.
Well, regulation is good, so there's no way that's inherently good or bad. Regulation should be good, and I think it's important to have regulated entities, purely because the behavioral issue we talk about and greed. So when looking in terms of regulation is a moving target, okay? Because businesses are trying to innovate and get competitive advantage, and the regulators have to respond, okay, to new trends and to new products that are happening. So regulation is not static, is something that is dynamic and is led by basically businesses, because the financial service sector has been kind of challenged by the cryptocurrency and other issues coming into the market, into our social lives. So they have to respond to that, to say, how do you deal with a business that say, well, I'm not dealing only with Bitcoin, and how do you also deal with a bank that focuses possibly on a niche of venture capital or kind of startups, and those startups are going to be innovative.
Yeah, it was actually quite ironic. Just after Silicon Valley Bank had its problems, some commentators said, listen, there's been a move to crypto because it's seen as a safer asset class, going from banks to crypto. No. But let's talk about valuations. Let's look maybe at two markets, the JSE or local markets and the US. Where do you see valuations? Is it high, low? How would you describe it?
I think, let me start with the JSE. I certainly don't think we're at valuation levels that we haven't seen before. This certainly isn't the early 2009 where valuations were at the lowest points that we'd seen over the course of the last 30 or 40 years. But I would say that given long-term trends, valuations are attractive, broadly speaking. And I think they're implying that over the next 3 to 5 years, we are likely to see good, not exceptional, but good returns coming out of the JSE. The US picture is a little bit different. If you look at the US historically, or certainly in the course of the last 30 or 40 years, valuations haven't always been a great indicator of when the US market is going to do well or not. And I think that part of that is the type of companies that have driven those valuations over the last decade or so have been tech firms that have had really stretch valuations from traditional measures. I think because of that, the picture is a little bit more opaque in the US, and in assessing that market, one has to be a little bit more discerning. Interestingly enough, I do think that the reaction to the FANGs has been such that there's opportunities in that space now.
Joseph?
The US is always going to be a driver. I mean, if in terms of the fourth industrial revolution and where we are now, you're not going to be able to ignore the USA. So if you look in terms of the big tech companies that has been there, they would either compete, one-on-one with Chinese companies, where they talk about Tencent and the Amazons and all the different businesses. So the US dollar is also still the global currency of choice, reserve choice. So I believe that the US certainly is still quite significant, and that's the reason why, South African authorities increased the exposure you can take offshore, is to try and take advantage of that, in spreading country risk. And playing into the safer hard currencies. So currencies are going to play a big role. The rand is 1820 or between 18 and 1850. Don't know where it is now. That is pretty weak, and you also need to say, how do you play with that? So my view is that your sectorial focus is going to be very critical. We had our resource stocks kind of being hammered from about 2012, 15, 18, and then came in banks that did very well. And in the last 1 year or two, it has been resources, where profits were, in doubles, and headline earnings per share, EPS, all doubles. So there are opportunities. I'll give them almost pretty much a 50-50.
That's sitting on the fence.
So you wanted to be more specific. So there are certain company specifics, companies in SA, I think that would do very well. So you would certainly, possibly put more into SA than overseas. I would possibly allocate 60%.
60?
To SA and 40 outside.
If I can add to that, if you're looking at a US versus a relative assessment of everywhere else in the world, I would say the US naturally, as you touched on, is a big driver of the world. There will always be opportunities there. But I would be underweighting the US relative to its benchmarks versus other opportunities in the world.
I would like to hear from viewers. Please send your questions to events@moneyweb.co.za, or if you're on the YouTube channel, there's a chat box. Just type it in there and I will post it to the panel. Correlation. In the past, the JSE was really correlated with what was happening in the US. That seems to have disappeared, partly over the past few years due to the performance of the tech stocks in the US. We didn't really follow suit, and obviously that is a pretty significant reason. But do you foresee a normalization of the correlation, or are we becoming more like other emerging markets where local factors play a more important role?
But before we go there, if you don't mind, if you can just look into this. I think the last point where we agree that the US certainly will be vital or to be quite important, significant. What's happening in the European Union, in the EU, do you think it has a kind of an impact in terms of how then where investors put their money? Purely because, the EU, there's no leadership. After Brexit, I think things are just looking a little bit sour in there. Do you think then that gives investors more room just to be leaning towards the US?
I think in general, if you take a step back from a geopolitical landscape perspective, we think the world is going through a period of what we call multipolarity, right? So if you look back at the history of the world, we go through cycles where there's one dominant superpower. And in those periods, we have an increase in globalization as the world is optimizing who produces what. You have low inflation environment in those periods, and actually relatively minimal conflict because the big superpower is the judge, jury, and executor who gets to make assessments on who's right or wrong. I think where we are in the world right now is not that period. The US has lost its prominence in terms of its geopolitical stature. And what that's meant is that regionally, more and more countries are focused in their own internal politics. And that's what we're seeing throughout Europe, where there's a rise in each country looking at focusing on what's happening domestically rather than this unified, broad European stance. And I think that trend is likely to continue for the next couple of years. And I think that's what's driving the internal conflict that we're seeing.
What will happen in Europe if the war ends tomorrow?
Russia-Ukraine war?
Yes.
I guess the question is, how does the war end? I think that will have a bearing on what happens. Certainly, what's helped economically has been a relatively warm winter. That's meant that the economic performance coming out of Europe hasn't been as dire as we anticipated, which certainly from a South Africa perspective has helped. Europe is still our biggest trading partner. But we can't bank on that for another year. So I think some sort of resolution of the conflict in the next year or so would be ideal in terms of setting the scene of what's going to happen in Europe going forward.
Anyway, so basically, China has been the global economic superpower over a long period. People didn't actually not realize that China is the center of mass production, superpower. So America has been superpower from innovation and I guess military, but certainly China has always been, at least for the last 10 years, the global manufacturing superpower or provider of goods and services. But let's go back to the correlation. I think a theme you introduced. So the correlation, purely because of the way I think investors look at things, there's always going to be correlation, and also because of, say, if you look in terms of our market, if I can just zoom in on to that, what's the correlation between the different sectors to the overall market? It's purely because of how the indices are constructed. And so you have to remove the correlation out of that, to be able to really see, how the markets are going. And that's a very complex kind of statistical process because you will certainly see that there's autocorrelation in almost every sector because you need to remove that sector from the, the overall market to then say how correlated it is, in terms of influence. So that would be massive. It's purely because of the benchmarking we do. So you either benchmark your returns on your domestic currency versus the US dollar, and you use obviously the global indices, your MSCI indices, to be able to confirm, in terms of how your portfolios are doing. So I believe that there won't be significant divergence, so to speak, in terms of the global indices because of what I can say, the composition or how they are constituted.
If I can,
yes, please.
I think what's driven the decoupling of South Africa's performance relative to the rest of the world has been, a lot of it has been driven by internal factors, right? We know what the state of electricity is. We know some of the mishaps from a policy perspective that have driven that. I think what we need to see in terms of the local environment is load shedding, government getting a handle on that, Transnet getting a handle on that. And I think sorting out those local factors will then likely return us to an environment where we perform in pockets in line with what the rest of the world does. I think ultimately because the South African market is as liquid as it is, it's almost a proxy for risk always. If you sort out local environments in a risk-on environment, the world will filter through in terms of flow.
But many South Africans are very, very negative at the moment. We see business confidence levels at record lows, consumer confidence, investor confidence as well. And that brings me back to the emotional, the debate about emotions. You said you are 60% local market and the 40% foreign exposure, that you believe that is a good split. What are your views? Because there is many views that says, listen, there are too many risks in South Africa. Get your money into a stable economy. You will probably see some growth, but it's mostly a decision to protect yourself against potential problems in South Africa and a weakening exchange rate.
If we put on our investor hat, I think it's important in making investment decisions, you can't just focus on the asset side of things. What you really need to assess is where are your liabilities. For most investors, whether large institutions, for individuals, most of our liabilities are in rands in South Africa. And that dictates that the lion's share of your assets need to be invested locally.
What is a lion's share?
No, I mean, I think the majority of your assets need to be invested locally because ultimately, if most of your assets are invested offshore and the rand goes from 18 to 12, that then means that you are losing a significant share or ability to cover your rand-based expenses, mortgage coverages, whatever the case is. So I think from that perspective, we need to always think through where are your liabilities based in that investment decision making.
But is that a retirement perspective? Or what about somebody like me? I'm still young, I may have grey hair, but I've got 20, 30 years of investment time in front of me.
Sure, but you still, without knowing your particular dynamics, you still maybe pay a bond here, you still pay school fees, hospital cover, all of that needs to be matched in rands. If you've got a basis that where those things are covered from a cash flow, then you can make the optimum upside decision. I do think from a relative valuation perspective, the South African market is in the top 10 most attractive markets in the world. And I think then the case is being discerning around which companies. We do have a lot of issues domestically. Some of the commodity players are exciting opportunities. I do think the likes of MTN, to mention a stock, is companies that are undervalued and are ticking a lot of the boxes that we want. A company that's showing innovation going into new industries, but covers a lot of your local liabilities.
1 minute, please.
So basically, when you talk about performance, there's the economic performance, which is different from the capital markets performance. So people, sometimes we need to look at those two things differently. That the economy might not be doing well, because of the load shedding and some of our constraints. But also when you look in terms of the market, just adding towards we all kind of saying that South Africa could still look attractive. But some of the stocks like your Naspers, some of the heavyweight stocks in the top 40 are global stocks anyway.
Yeah. Well, this has been a fascinating discussion. Thank you, gentlemen. I think we can talk for the whole day about markets. I'm sure we're going to talk during the rest of this program about stock picking and to see where there is value. There are many opportunities, many value traps, and I think the uncertainty, and there I use the term, is going to be significant, and it will be an investment theme going forward. Chepo, Joseph, thank you so much for sharing your insights. Please keep those questions coming. Email it to events@moneyweb.co.za. Or in the chat box at the YouTube channel. Just type it in there and we will put it to the guests. On social media, please use the hashtag BetterInvestor and share your insights. And thank you for joining us for this session.
Are you an amateur retail investor and want to become a better investor? If so, you should not miss the Moneyweb Be a Better Investor podcast. My name is Ryk van Niekerk, and every week I speak to the best professional investors, research analysts and traders about their personal investment portfolios. We talk about how they make investment decisions and hear what they regard as their best and worst investments ever. The idea is to find some golden nuggets from their perspectives and experiences to assist amateur investors in becoming better investors. Join me and my expert guests weekly on the Moneyweb Be a Better Investor podcast. Listen on moneyweb.co.za or the Moneyweb app.
The Moneyweb Be a Better Investor podcast. Show me the money. Moneyweb, your trusted source for business and investment insights. The Moneyweb Frequently Asked Questions series. Part 2, Investing 101.
Hello, I'm Simon Brown. Welcome to part 2 of Moneyweb's FAQ video series. In this series, we give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I will take you through the main facts you need to know about investments. The big question, what are the different types of investments? You've got shares, you've also got unit trusts and exchange-traded funds. Unit trusts are active, they buy and sell all the time, trying to do better than the market. Whereas an ETF is passive, they buy and hold the market, giving you that market return. What about the risks involved in investing? You certainly can lose money, especially in the short term. Long term, quality companies do well and increase profits, and this will see the share prices increase as well. When is the right time to consult a financial advisor? If you're not comfortable managing your investments yourself, there's always a lot of help online. But a financial advisor can add real expertise, and Moneyweb's Click an Advisor is a great place to look for one. How do I monitor the performance of my investment portfolio? Your broker will help you with the value of your shares as well as news from the company. Financial publications such as Moneyweb also offer amazing content. How can Moneyweb equip me to invest better? Moneyweb has a great tools and data page, as well as company news and a great selection of podcasts and articles every day to help keep you informed. In the next video, part 3 of the series, Moneyweb's editor Ryk van Niekerk will unpack Moneyweb's premium subscription offering, Insider Gold. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Welcome to the next session. We're looking at the...
Welcome to the next session. It's our session. You make it sound like we byproduct or something else. Welcome to the session.
Not byproducts of anything. We're definitely looking at how to build generational wealth, in particular in the context of dealing with black tax and what's known as the sandwich generation. I'm joined in studio by my two guests, Nonhlanhla Tailor, who is the founder and CEO of Esteemed Financial Solutions, as well as Esteemed Learning Academy. She's also a mother. She's a financial planner, and she's got over 13 years of experience in the financial services space, assisting people in bettering their futures and planning for their futures in sustainable ways. And next to her, I'm joined by a family favorite of Moneyweb, as well as many other stations. You guys might know him as a chartered accountant, an activist, a columnist, a social media influencer. To me, he's just someone who started out as a mentor, a lecturer, became a friend, and is now someone who is highly sought after in this media space. Kaya Sitole, of course. Good morning to both of my guests. Thank you very much for the time. I guess let me start off with you, Noni. When we look at the idea of generational wealth, what are we looking at? Are we just looking at looking after your children? Is it just a conversation about saving up a little bit of money so that you can retire comfortably? What are we looking at there?
Let's start by understanding what is this generational wealth. It is really having to transfer your financial assets to your family members, children, or even grandchildren and beyond. So it's not only on your children only, or your own children. It is within the family. There are family members where they are taking care of their uncles, their aunts, and so forth, and their niece. Personally, I'm taking care of my niece and my nephews. So I need to make sure that I take care of them and I take care of their future. So you start now while they're still young, put something together for them, save up for them, for their education, for their future, to make sure that they have a better life when they've grown up.
And we know that this comes with challenges. I mean, we know that first of all, the challenge of saving is a significant one.
Yes.
And alongside those challenges, I suppose one of the ones that we're aiming to tackle here as well is the challenge that comes with what we know as black tax. And I'd like to bring you in on this, Kai. I mean, let's explore this idea of black tax and look at what's known as the sandwich generation. I mean, how do we coin the sandwich generation? Which generation does it refer to? And this idea of black tax, I mean, what does it mean for us that are looking to build wealth and to build savings for people in our families?
I actually thought we were in a practice session, but it turns out that we already started. Yeah, so...
Yeah, don't worry.
Actually, I thought we were in a practice session. So obviously the sandwich generation are the individuals who've got the dual responsibility of taking care of the elder and the younger. So South Africa has got unique problems, and the essence of the South African problem is that South African citizens tend to migrate across different forms of poverty. So for a lot of people that are born without means and resources, born poor by definition, the one way in which that poverty is alleviated is through some various forms of social assistance. So if you're born and you get a child foster grant and you get access to free education and free healthcare, that deals with that form of poverty, it mitigates it. Unfortunately, what then happens is that when you reach a certain age, you then migrate out of that system. So you no longer have access to basic education because you're too old. You no longer have access to a childcare grant because you're no longer a child. And the problem comes in that particular time frame between the ages of 18 all the way up to 60. Yeah. Where unless you have a job, unless you've been able to migrate into the economy, you're now subjected to a form of economic poverty. In other words, the only way the poverty can be alleviated is for you to participate in the economy. And then what we see afterwards is that when you get older and you qualify for an old age grant, you're back into the whole social poverty dimension where you're still poor, but there's a mitigation, which is the pension grant that you get. Unfortunately, the design of the social care system in South Africa was not actually designed for the times that we're in the sense that when you look at then the depth of the assistance itself, we've got particular problems. So in South Africa, we do not start off by saying that what are the needs of a particular individual and then map out what those needs are going to cost and then say this amount of money. We simply say this amount of money that we're going to allocate to you and then say we hope for the best, right? Mm-hmm. So what that means is that by the time people get to an older age, the social assistance is itself not enough. So what you then have is that the people that are in the middle, that have been lucky enough to be able to participate in the economy, not only have to take care of the younger ones because there is lack of sufficient coverage for the young ones and also the old ones. So they're sort of sandwiched in between those forms of poverty. But the problem here is that there are far too many citizens, even within that middle, who cannot access the economy themselves. So what you then see is that we're not actually taking care of the young and the older, we're extracting from them. So if I am a mother and I'm unemployed and my child gets a grant, well, the loaf of bread that I buy isn't just uniquely for the child, it's for the child and myself. So we're now actually diminishing even the currency of that grant in the child's hands. Same thing with our old people, whether it's our grandmothers or grandfathers, we're actually extracting from them because, well, we don't have anything, and what little they do get has to then get stretched across. So we've got very, very unique dimensions in South Africa, and I think it's something that probably reflects the I wouldn't say the poor design, but the accidental design of our social healthcare system, because it doesn't start off by saying what are the needs. It simply starts off by saying these are the resources, the needs better match the resources.
Yeah. And more often than not, as you rightly mentioned, those needs far outweigh the resources that are deployed to that. And I mean, to the point around the black tax side of it is, it's not necessarily that we opt to go down this route by choice. So for a lot of people that are caught in that middle, it is an involuntary thing where you cannot afford to see a parent suffer, a parent that sacrificed everything they had to raise you. At the same time, you want to provide a better future for your child or the people that are dependent on you.
So the issue in South Africa is that we call it a black tax, but it's actually a social solidarity tax. And the reason it's a social solidarity tax is that as society, as I've just mentioned, the multiple forms of poverty that we get subjected to. If you have, for example, not been able to secure a stable job, even in that middle period between the ages of 18 and 64, it means that you do not have enough savings to carry you into your old age. It means that even the state pension is not going to be adequate, right? And we do know that historically, the majority of black citizens didn't have jobs within that 18 to 64 bracket. So the prevalence and the density of what needs to be done is much more acute for black people, so that's why we call it a black tax. So the argument is not to say that other races do not take care of their parents and they do not take care of their young. They do, but it just tends to happen because and far more of those particular race groups have been able to participate in the economy, it means that the need that the old white parents have for assistance from their own children is much less than the need that you and I will be subjected to. So of course, it's a tax that acutely affects black people, so that's why we call it black tax. But there's a social solidarity problem wherever you look, across all races. But for those that have been able to participate meaningfully in the economy for an extended period of time, and they realize that they've saved enough, or they've got a very strong enough pension pot, then of course the need and the extractive nature of it is not as acute. So that's why we sort of tend to think of it as something that only happens to black people, but it actually manifests across all races. And for as long as black people have got a very artificial and a superficial participation in the economy, this will be perpetuated for as long as we live.
Thanks for that point of clarity on the fact that it is a social tax that affects everybody. It might be more prevalent to certain individuals, but it does affect everybody. And that being said, I mean, Noni, where do we then look for this wealth building? I mean, where do we start? Because we know that the problem is there. We've identified how systemic the problem can be and how damaging the problem can become if it's not dealt with and addressed. So those that are able to then participate in the economy, where do you then start from an income point of view, from a generational point of view, to start to build that generational wealth?
Honestly speaking, most people find us that there's that one breadwinner who's employed, and whatever that they have, it's not enough to take care of the rest of the family. So therefore, it's then important then to start talking about creating other streams of income, right? And when we talk about other streams of income, we're then referring to start thinking about the side hustle that you can come up with. And I always tell people to say, when you talk about a side hustle, it starts with something that you've got passion about, something that you really love to do. I'll give you an example for one of my friends. He's in the financial services. He's a manager in one of the insurance company. And for him, what he did, he said, I love photography. I like to take pictures. And I said, why don't you get the equipment, and see what you can do? And he started with that. He got the equipment, started taking pictures, obviously for free. I was one of these free clients to do the pictures. And then he started building a portfolio that he was able now to market himself as a side hustle. So every weekend he's now getting weekend gigs that he's getting paid for. And those are the small things that you can do. Personally, what I did when I was still employed, before running my business, I opened up a laundromat, Ekasi, and people thought, what is this girl doing? Why are you opening up a laundromat, And guess what? Since 2012, it's still operating. My mom is running it. My niece and my nephew knows how to operate it. So that is some of the things that you keep teaching your family to do. There's small things that you can, because even with him, he doesn't just do it by himself. He's got his kids as well. He goes with his kids to do these things. So you build that by working on the side hustle that you've got passion for, that is able to involve the family as well, so that they can take over whenever you're not there. The other option is to look into your rental incomes, and someone would say, where will I get the money to really buy property, because property is expensive? But sometimes it's because we are looking at those high market properties that are going for millions and so forth. Only to find out there's also opportunities where you can actually go to an auction and buy a gassy house, Some of them can get it for 70, 100K. You put that together, you save up for a good 6 to 12 months, have that lump sum, go to an auction, buy that property, fix it up, and there we go. You've got a lifetime income coming in. So those are the small things as people that can start working on. And of course, the other way, someone said, definitely, Noni, I cannot do this. What else can I do? Then you can start thinking of an investment. Because there you are getting an interest income that will also be building within your income, which we call it like a compounding interest. So we can start small, putting that small 500 Rand into different investment vehicles and see what for a long term. The thing is, our people like to say, I'm putting money away in an investment. 6 months down the line, they want to come and take it off, So it's important to keep on your long-term strategy. Keep on that long-term plan and stay in it, so that you can definitely see the results of that generational wealth.
So I'm getting a sense that a large component of it is diversifying your reliance on one income stream and sort of starting
100%.
to build out multiple income streams in an effort to balance out what Kaya mentioned around the fact that when you participate in the economy, you're
Yes.
participating in a limited capacity. So expand your participation
100%.
in the economy to ensure that the different income streams or whatever you're building on the side then becomes an add-on to what you already have.
Yes.
Let's stick with the investment side of it. I mean, what are we looking at in terms of the types of investment vehicles or investment strategies that are appropriate for wealth building? Because I get the sense that something like a fixed deposit might not necessarily cut it if you can deploy the capital better elsewhere.
Yeah, so there's different kind of investment platforms. For the lack of a word, I just put it like flexible investments. In the term of the industry, they call it LISP platforms, which is your linked investment service providers. It's basically a combination of unit trusts where you can really start with like I said, you can start with a minimum of 500 Rand, put that together. It is then important then where you partner now with a certified financial planner that's going to be able to put together portfolios that will speak to the short, medium and long term to make sure that you're able to achieve those goals according to that. So there's those flexible investments. There's also your tax-free accounts that you can also use for long term, not just only for yourself, but also for your kids' education. You can use those kind of platforms. It will definitely help you for a long term.
Just a reminder, I mean, you can send us your questions to the panel on the YouTube chat box, or you can email it to events@moneyweb.co.za. You can use the hashtag BetterInvestor. Kaya, I want to come to you. How do we then, now we know sort of, or we've got an idea of the types of instruments or the types of vehicles or the plan to go about this. Another component of this has to be conversations. You mentioned earlier that for a long time, certain individuals have been excluded from participating in the economy, and the historic issues that we've had to deal with. How have those issues played into where we are now, and how important is it to have conversations with family members or with your family regarding these sorts of financial situations and setting up things and explaining to someone, hey, you're my child, I've set up a trust for you.
Yeah.
How important are those conversations to be had?
Well, they are very important for the very few people that can afford to have them, no pun intended. And the reality here is that very few South Africans have any form of discretionary income. We've got a very low savings culture as a country across the board. And the reason we've ended up here is that in a normal nuclear family, you're unlikely to find that every single person within the family has got an income. And of course, it means that those that have an income have to spread it so much wider. And the consequence of that is that savings then doesn't become, an instinctive reaction. And also, even in instances where there is an element of discretionary income to be put away, it is on a very fragile model, as you said, where 6 months later, then there's a pressing need in order to be able to activate that and withdraw it. So we do not have that culture of long-term horizon thinking. And one of the ways in which we can obviously start addressing that is by making sure that many more people are in an income earning capacity. And when they do earn an income, that income is sufficient. Because until there is an income to be saved, then there's no point in us talking about savings. But I think also then there's a question of the education about which instruments are desirable for which type of planning. So we do know, quite ironically, that funeral insurance is a popular thing in the black community. And one of the ironies is that we've seen a funeral. Everybody knows what it costs to plan a funeral. So there's a sense of visibility associated with the fact that there's a linear link between, if I put this away, I'll be able to do that. For other type of investment opportunities, I've never seen somebody, getting a lump sum because no one talks about it. So for a lot of people, it's much more difficult to sell the idea to them to say, well, actually, if you put this away, then this is what's going to happen in the long run, and this is why you're in a better off position. And it also doesn't help that, look, if something goes wrong, then the state will step in. So a lot of people are like, the future will take care of itself. Yeah. So we need to be able to start reorientating people differently. There's also another point that I'd like to raise, in that when we talk about generational wealth, South Africa still has a gap in the monetization of the wealth that we have. So if I go back to the Bundus, back in KZN, we've got huge amounts of land. If you want to build a house, I can give you a parcel of land. That huge amount of land doesn't have a financial value. So if I say that I want to go and get a loan, it's not in my name. It's literally just this tailor family land, as it were. So we don't associate it with any singular individual. But if I want to build a house, then I'm able to do so. When I'm here in Johannesburg and I've got like a fraction of that land, that fraction of the land has got a piece of paper that underpins it. So therefore, that fraction of that land has been monetized. I can then use it to go and get access onto income earning opportunities, for example. So that lack of monetization of the wealth that people in South Africa have is a bit of a problem itself, because it may well turn out that comparatively, the fact that I know that I've got a piece of land that I will inherit in 10 or 15 years' time means that I've got a form of wealth. But I cannot document it anywhere, because it's not going to be something that I go home and say, guys, put this on a piece of paper that this piece of land he will inherit and this is how much it's worth. So that's a form of intergenerational wealth, but we haven't quantified it and we haven't captured it. So we've limited ourselves to simply saying that the only forms of wealth that we understand, the only forms of wealth that we account for are the wealth that is a form of wealth that has been formalized. But a lot of us actually do have a form of generational wealth in terms of either the cattle that we're going to inherit or the resources that we're going to inherit, and the simple fact that I don't have to pay rent back at home, which is the greatest thing for me. So we need to find ways of actually being able to articulate exactly what people have and how to sort of figure out how to talk about it so that people understand exactly what it is that we talk about when we talk about generational wealth, and simply not limited to the type of system that far too many of them find so elusive because they just don't have income earning opportunities.
And I think to your point on the land side of it and that sort of thing, we are often told that it doesn't hold value because it's not near a mall, it's not near a Sandton, it's not near a developed area. And if you come back to what you were mentioning earlier, Noni, about the fact that you can utilize that resource to do something else with it. You can farm the cattle, you can build an agricultural business, you can start something completely new, and that will add value not only to yourself but to the economy. I think what you're saying, Kaya, about the fact that we need to understand that it does hold value, even if it's not a quantified value that's assessed by a commercial bank that's sitting in Santon Drive and that sort of thing.
So one of the problems is that when people talk about value, they're trying to sort of think about resale value. So when they say that it doesn't have value because it's not next to a mall, it simply says, well, if you try to sell it to Jimmy won't pay much for it. But my intention is not to sell my family home. My intention is to be able to occupy it and not have to pay to occupy some other form of land. So for me, that is the value. That's the implicit value, in that I do not have to otherwise bleed cash on an ongoing basis, which is what I have to do if I move to Johannesburg, if I move to Durban, or if I move to Cape Town. So that for me is the implicit value that, again, a lot of people tend to not actually appreciate that it exists there. And I think why we need to be able to sort of, sensitize ourselves to this is that if we're then going to start crafting conversations about how to then build, additional financial wealth, for example, which in other words is a bank account, if you can simplify it like that, then we need to be able to say that this is the starting point, this is what we currently have, but what we need to be able to do is to generate ongoing or recurring cash flows in order for us to be able to do additional things. So once we then figure out what it is that we're trying to do, then we look at the opportunities that exist and then say, okay, what are the best ways of ensuring that what little we do earn as an income, a part of it is still being put away for a rainy day, because obviously over a long term there are always going to be particular issues, whether it's marriages or whether it's death or particular events like that that are going to require us to have some form of physical cash. And it's the classic case study that I used to talk about, the case of the Transnet pipeline. Does it have any value? Well, Transnet is not allowed to sell it, but does it make it worthless? No, it's not worthless. And in accounting terms, we used to struggle with the question of how do you associate a value, and what's the point of telling people that it's worth $1 billion, it will never be sold, it will never be transferred. So that value, that number, what is the meaning of it all? And we need to be able to understand what we're trying to say when we talk about these numbers, when we talk about these values and the essence of what wealth is.
No, your thoughts on this? I mean, from the perspective that Kaya's just mentioned around the fact that what we see as value needs to be redefined firstly, but also in conversation we need to then redefine the plan for that value. We need to outline what we intend to do with it.
100%. And that's why communication is very key. I will call it family meeting is very key. To sit down and have these kind of conversations to say, guys, this is what I've built now. I want you guys to be involved. I want you to make sure that you take care of this legacy, you know. The same way that, like I said earlier on, referring to the laundromat, to say, the kids know about the business, the kids are involved, they participate on weekends and during school holidays. They know how it operates, so that even if when Gogo is not there, even if when Auntie is not there, they will take care of it and they will continue, because that's an income that was coming home, right? And then Kaya mentioned about the land back home. You can do so much with that land. Yes, it might not have value, and trust in me, I do have clients where I'll tell them to put it on their wills, to say, this land, based in this area, must be able to do 1, 2, 3, 4, 5 for my children, so that when they start reading that will, the kids now open up other ways of thinking to say, actually, Dad or Mom wanted us to do this. We must not sell the cows, we must not sell the goats, and so forth, and take care of the wealth that he had created. So it's then important then to make sure that that family meeting is being held and it's been discussed, to say, guys, this is what I've put in place. Make sure that you implement it accordingly, because I did put it on my will and you need to take care of it. Yeah.
I guess we've got a question from Lungani in Randburg asking, how do you teach young children about the different financial educational tools whilst maintaining family values? What's the best practice there, Noni?
So it's that again from you as a family to say, what are the family values, right? Do we value money or do we value creating wealth? Because there's a difference there, you know. So I then say that it's then important to teach them at a very early age, because I can tell you now, my daughter, she knows that when she has worked, done something, she's rewarded by cash to put it away. And then there's also money to spend. So it starts when they're still young. You teach them with different principles to say, I need to learn to save my money, because we've got a competition at home with all the children where we say every December, let's put all your savings here. Who is the winner? And then we reward them accordingly. So those are the small things that you build in, and they enjoy, because now in December they know they've saved up. They're able to buy the best toys that they wanted, because you can't always be buying what they want. So you say, put up the money for you to get what you want. And that, it's a principle that you're teaching them and making sure that at the end of the day, they are learning these basic principles at a very young age. Yeah.
Teach them young and teach them how to save. Kolani wants to know, what's your take on stokvels as a savings vehicle in the black community, given that we're talking about savings, Kaya?
It's a tricky one. And I think, the one thing about stokvels is that conceptually they've been designed as short-term, put-away systems rather than long-term saving systems. In that in December we know that there's a meeting and then we buy the groceries or we simply distribute the money. So it is a missed opportunity in that we've simply restricted it to the 12-month horizon. And also because we've restricted to the 12-month horizon, the financial system hasn't been conducive into giving it more attractive interest rates, for example, because it's not a long-term fixed deposit. They know very well that, the shorter the time frame for the investment, the more poor the interest rate is. But if we said that these were 5-year stokvels, for example, I think the returns would be much better, would be much more tangible. So I do think it represents a missed opportunity. And perhaps, again, it comes back to the question of we do not have enough to put away, because if we had enough to put away, we could then say in our stokvel that, look, half of it is going to be distributed in December so that everybody can be able to have a good Christmas, and then the remainder is part of this long-term thing. But that obviously requires people to commit to be part of this for a very long term, and that's not always easy to guarantee because of the very informal nature of what our stokvel systems are. So I do think it represents a missed opportunity.
I have to agree with you there. I mean, there's so much that can be said about the discipline and the culture that a stokvel can breed in terms of looking at a culture of saving, a culture of thinking forward, a culture of looking to beyond just the now. And stokvels are definitely a missed opportunity from that respect. I have to agree with you there. We've got a comment from Moebone who says, I hope investment companies are listening to get an idea on advertising to the black market. Make it visual, show long-term benefits. And that's something that Kaya said, is if you're able to visualize and you're able to see the end goal the same way you were able to for a funeral policy, for example, you might have a different view on how this whole picture plays out. But looking at this wealth side of it, I mean, we have to look at something that we spoke about at the start of the conversation as well, around the liquidity of that. Let's look at the liquidity of it all, Kaya. We know that something that Noni alluded to earlier is the diversification of income streams and that sort of thing. From a liquidity point of view, how important is it to have that liquidity? You mentioned something around the fact that at certain times, family emergencies come up, unforeseen events come up, and how important is it to balance, even though you have a long-term generational view, to make sure that for the short term you have liquidity so that you don't dip into that long-term side of things?
The importance of liquidity is illustrated by how robust the credit market and the mashonisa market is in South Africa. Because obviously, if people were sufficiently liquid, they wouldn't rely on those. Yeah. I saw something truly disturbing yesterday on Twitter, in that one of the banks has now created an advance system for grants. In other words, you can, if they know that you qualify for a grant, you receive a grant per month, you can then go and ask them to give you the money before the grants gets paid out. Sure. I think it's remarkably dangerous, but it's also reflective of the sense of desperation that emanates from a lack of liquidity. So people's expenses do not necessarily wait for that particular payment date. And if there's been an interruption in their cash flow, so you can plan for 30 days, but if something happens, there's an injury or an unexpected trip or a death in the family, then it interrupts your cash flow. So in the absence of liquidity, you then have to go for these alternative systems, where that's tapping into the credit market, but for a lot of people, they do not actually have access to the credit market because of their poor incomes or their irregular incomes or a lack of a job, where the credit market is going to ask, where is your 3-month pay slip and all things like that. Very few South Africans can actually be able to provide that. So it drives them towards that particular market out of a sense of desperation. And also, unfortunately, the unintended consequence of us excluding people from the credit market is that you then amplify the exploitation, because, trust me, there's always a mashonista willing to give you the amount of money that you need. By the type of interest rates that we hear about, I mean, in spite of the fact that the National Credit Act was signed into law in 2005, the National Credit Act doesn't mean a lot much to a lot of people, because out of a sense of desperation, if she says that you want 100 Rand, you must bring back 200 Rand next week, you're going to do it. That's literally what happens. And as soon as you pay her the 200 Rand, it means that you're now cash poor, and then you have to go to Jimmy and ask for another 200 Rand. So it actually perpetuates a cycle, and once you get trapped in it, you hardly ever get out. And there was one interesting anecdote that happened in my village a couple of years ago, where someone died and a whole lot of people celebrated. It turned out that the person who died was a mashonista who didn't keep a formal ledger. So when he died, everybody knew that they were absolved from their credit. So yeah, that is what happens there. Yeah.
I think that's a very scary thing that you've just outlined around the fact that you can now get an advance against your social grant, because we know you've gotten an advance against your airtime and those sorts of things. And some companies, I don't know if a lot of companies still do an advance against your salary. But essentially what that is you're living in debt, because when your salary does eventually come in, you have to settle the advance, which means you now don't have that 30-day window that you had initially, and you're going to be repeating that borrowing cycle. I mean, I think if anything, the only real thing that makes sense for an advance may be a bonus if you don't have intended plans for that bonus, and you can then use that to offset against some of the things that you have. But what that's going to do is you're now, with this whole cycle that we're going through, you're perpetuating a cycle where people's bonuses are only going to go filling gaps and not building wealth and maintaining these sorts of things. So then, Noni, what do we do to maintain the liquidity? Do you have an emergency fund? How do you then make sure that the liquidity that you're maintaining doesn't, one, distract you from the long-term goals that you have, but two, is readily available for you to not have to go to the mashonisa that you hope passes away very quickly?
I would say that, personally, I always have 2 emergency funds. One, it starts with the bank, put something away that when you have an immediate need, you can tap into that, versus to using the credit facility, And I know it's not easy, but it's that mentality of putting that 250 away, 200 Rand and so forth, and start accumulating that 1 month worth of a salary. Put it there, keep it there for that immediate need. And then there's also the second one, where I say now, put together an emergency fund for a good 3 to 6 months that speaks to your personal monthly expenses. Because you don't want to find yourself, when you've got that immediate need, you tap into that, because you are saying only when you've got a challenge with with you losing your job and so forth, you know you've got that 6 months worth of salary being saved up, and you don't have to find yourself going back to the credit facility and asking for money. And it's quite challenging because people ask themselves, how do I do it? How do I access money to make sure that I can start saving up? I always tell people to say it all boils down to say, how do you maintain and manage your money on a monthly basis? When the salary comes in, what do you do with your money? Do you record what you do? Do you know where you spend your money so that you don't end up finding yourself spending your money somewhere else where you don't even know what you've done with it? And it boils down to the budget. Do you do the budget to make sure that you've got a portion in your budget, you've got a savings option to make sure that there's a debit order going off, you know that it's going to help you out whenever there's a need. Yeah.
We've got a question from Mtobisi saying, are there comprehensive information hubs online that we can pass to friends, family, and those within our community? Mtobisi doesn't think that there's enough or there's a need for multilingual financial education for us to teach and relay this information to older family members. Are there tools that are readily available, whether it's from a financial planning perspective or whether it's free resources? I mean, I know for one, Kaya puts out a whole host of helpful tweets every now and then on information that is public knowledge. A lot of it is articles that have been written, that have put out in the media. It's just about accessing those sorts of things. But are there specific platforms where we can get this information?
Personally, I do something similar to Kay as well. I post educational information on my LinkedIn profile or Facebook pages. But there's also a website from the FPI, which is the Financial Planning Institute. They call it money123.co.za. You can actually go in there. There's quite a lot of content in there. They talk about budgets, investments, all kinds of articles that you can educate yourself with. So I think that platform can really help the public out there.
And of course, the Moneyweb app. I use the Moneyweb app. It's one of the most reliable resources, right?
Sure,
I found that a lot of the things that I've done in the media space as well, the Moneyweb app provides you with reliable content, reliable information, and often, and Kai, I'd like you to weigh in on this, often the information we read in mass media, there's certain elements of it that's factually incorrect. And so you want a reliable source if you're going to educate yourself from factually correct resources.
Yeah, unfortunately, the unintended consequence of open access to information dissemination is that we do not have the strong filters that we need to have in order to vet the information. Ironically, it happened last week where one of the most prominent Sunday newspapers put out a tweet that said, oh, a few months ago, interest rates were at that particular rate, this is how much you're paying for your bond, now it's gone up so much, and this is how much you're paying for a bond. And they had a fundamental factual error in that they confused the repo rate to the prime rate, and it obviously just made the calculation completely much more dramatic than it needed to be. And of course, for a lot of people, if that was their only source of information, they'd be like, yo, actually, this financial system is just a problem because it can do that to people. So of course, that is the one platform where the filtering should have happened, but it didn't. It was only later, once people highlighted it, that they then corrected it. So we do have that particular question of the credibility of the sources, because the unfortunate consequence of financial information is that people may take decisions based on what they see, and if what they're seeing or what they're being told is factual isn't, then it actually leads to unintended consequences. We saw that I think it was a couple of years ago, where there was a DJ who was punting particular property investments, and I think the underlying fundamentals with in that information were not as well ventilated as they needed to be. So people say, hi, if a DJ says you must do it, then you must do it.
Go for it.
And then later on, when the consequences happened, when the interest rate cycle changed, and then people found themselves out of pocket, people were like, how? But we thought this was reliable. And you're like, actually, I'm a DJ for a reason, I'm a financial planner for a reason, I'm an accountant for a reason. Sticking to lanes is occasionally important.
And I think to your point on sort of sticking to lanes as well, being quite important, you sort of see that this is now something that the regulators have taken on as well in terms of access to information, saying that the information that you provide, even as a social media influencer, you have to make sure that we're now going to hold you accountable for the information you provide. So make sure that the information is accurate.
Yeah. A lot of people don't actually appreciate the importance of regulation, because if I trust you as a person, if I trust you as a brand or as a human being, and then you punt something there, if I have faith in you, I will believe that, okay, this is the thing to go. But if it turns out that you've never used the product, you're only simply being paid to promote the product, and I make decisions unaware of the fact that you actually have a financial incentive to tell me something in particular, then I'm actually being screwed over. So it's quite important for us to be very vigilant about how we regulate the dissemination of information, particularly if it affects people's finances, because once you've lost the money through the scammer, once you've responded to that Instagram DM that says, do you know how you can make 800,000 Rand profit within a week, that money is never recovered. There's enough evidence in front of us that Instagram scammers and crypto scammers are second only to churches in terms of fleecing people.
Yeah. And maybe just to add on that point, Jimmy, is to say it's important for people to verify as well when they're dealing with a particular person to say where you registered, because the regulator has made it quite clear to say, yes, to do certain things you must be licensed, to be able to give advice and so forth you must be licensed. So we do get quite a lot of even older people as well, because they've heard somebody saying that from your retirement money, if you take the whole pension and put it here, then you will triple all your pension and you'll live for longer. That's where it goes wrong, because the first thing is to say, start with checking that person, are they regulated? Are they licensed to advise me according to the regulation?
Okay, so then in closing, 2 points from each of you, please, on what it is that is most important to look at from this whole wanting to ensure that you build a better life and a better future for your families and for those that you look after.
Okay, so I will say, start early to save. That is always the message that I would like to put across, to say, no matter whatever you have, as small as whatever rand amount you have, put it away. And also to say that educate yourself. There's quite a lot of information there so that you can actually make an informed decision.
Okay, Kaya?
I would say information is key. I think the ability to make the right decisions hinges on the quality of the insights that one has. And of course, one of the problems that we saw earlier on is that far too many of these tips, far too many of these lessons are not available in the languages that are accessible to a lot of people. So if English is not my first language and Afrikaans is not my first language, I struggle to get the same depth, the same volume of readily available information that will explain to me these things in a manner that then enables me to go and have that family conversation, because if I can't articulate it myself, I'm not going to convene a family meeting in the evening to say, guys, this is what savings is if I don't understand it myself. This is what a unit trust is if I don't understand it myself. So there's a huge information gap that exists there, particularly on the question of making accessible to as many languages as possible.
Thank you very much. Thank you to my guests, Nonhlanhla Ndlele, as well as Kaya Sithole, for their insights on how to build intergenerational wealth, how to get around this trap of black tax, or as Kaya calls it, social tax, because it affects everybody, and most importantly, what steps to take in terms of ensuring that you put forward your best foot on behalf of your family and on behalf of those that depend on you. Please stay tuned to our sessions. We do have a session coming up now with Simon Brown as he chats to Harry Joffe around the importance of offshore investing.
Tune into the SAFM Market Update with me, Fifi Peters, tonight from 6 to 7 p.m. as we unpack the day's business and investment news. You can live stream and download the latest podcasts on moneyweb.coza or via the app.
Moneyweb, your trusted source for business and investment insights.
Moneyweb Frequently Asked Questions, Part 3, the Moneyweb Insider Gold Premium Subscription.
Welcome to part 3 of the Moneyweb FAQ series. I'm Ryk van Niekerk. We received the question, what are the benefits of an Insider Gold subscription virtually every day? The short answer is that a premium Insider Gold subscription unlocks a myriad of premium data tools to assist any individual to analyze and research the performance of JSE-listed shares, unit trusts, ETFs, ETNs, commodities, exchange rates, and international indices. The historical performance of these instruments is available for up to 5 years, and the tools allow for the ranking of the indicators according to many predefined metrics. I want to highlight 2 unique and pretty cool tools. The comparison tool allows subscribers to compare the performance of multiple instruments over various periods. For example, a subscriber is able to compare the share price of a company such as Sasol with historic performances of the price of Brent crude oil, the Rand-Dollar exchange rate, and the S&P 500 index, all on one graph. We also offer a dedicated page for each listed company and unit trust. They are the Click a Company and Click a Unit Trust pages. Each page contains detailed information on the historical price and financial performance of the instrument. Sign up today for just 630 Rand per year or 63 Rand per month and equip yourself to make better financial decisions. In the following video, I will highlight a few of the many other benefits of the Premium Insider Gold subscription. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
I'm Simon Brown, host of Moneyweb Now. I'm joined today in this Moneyweb Better Investor Conference. I've got Harry Joffe, Head of Legal and Tax Marketing at Discovery Invest. Our conversation is going to be around offshore, not the investing part, sort of the legal part, the tax part. Harry, appreciate your time today. That's the key point. The debate about should we be offshore is solved. The answer is yes. The debate around where we go offshore, we can talk around that. Today we really want to say, now you've got those assets offshore, there's actually a lot which I think a bunch of people haven't thought about, and that is, where do you pay tax? What happens when you pass? How do you leave it to your estate? And those sort of challenges which I think for a lot of people come as a giant surprise after they've externalized money.
I thought you were going to say, Simon, after they passed away.
Well, then too, but I mean...
Yeah, I mean, the thing is, you always get the situation. Client comes up to you and says, I've got this property in London. What do I do now? Do I need a foreign will in the UK? Do I need a foreign executor in the UK? Do I need to do estate planning there? What's my tax going to be there? And that's at least good because they thought about it. Most people, they just go off and they buy the property in the UK and they don't think about it. And then they die, and then their South African will has to be transplanted into the UK, and you have endless trouble. So I think that's what we're going to talk about today.
Yeah. That's going to be a topic. If you've got questions, you can send us our questions, events@moneyweb.co.za. That would be the email. Or you could use the chat box on the YouTube channel. You can drop it in there. If you're on the social medias, the hashtag is BetterInvestor. So that's, I suppose, the key point. Let's start with wills. Tax is an important component as well, but let's start with that estate process. Your South African will is important. You need to have one. You absolutely do. If I've got offshore assets, do I then always need a will for offshore, but also, maybe for each jurisdiction?
Yeah, so that's where the fun comes in, because the question is, what asset have you got offshore? So you just got that bank account in London. You wouldn't need a separate will just for that bank account, because that your South African will could handle. The problem comes in when you start dealing with fixed property. So it's that flat in the UK, or that property in Europe, or that house in America, because there, of course, the foreign law is going to apply. So you've got a South African will, which is going to apply South African law, and now if you've got a fixed property in that foreign jurisdiction, you've got foreign law applying, there could be a clash or a conflict. That's a legal problem. But there's a practical problem, which is an obvious practical problem. Even if your South African will is applicable and is valid and legal in that foreign jurisdiction, how are you going to get it there? So you'll die in South Africa. The master here will want the original will. They will then wind up your estate here, and then eventually you'll get that original will to the foreign jurisdiction. And that's, of course, time-consuming. You're going to wait a year and a half before you get it there. And then you're going to start the winding up process there and hope your South African will is valid offshore. For example, in Europe, they've got what we call forced heirship. And that runs from Napoleon's days. They're still applying Napoleonic law, which you've got to admire the old fellow that his law is still being applied 200 years later. But now forced heirship says you have to leave your assets to your spouse and children in certain percentages, and they differ depending on the jurisdiction. So you've got a South African will leaving your assets to your best friend or the SPCA or some charity. But the foreign authorities won't accept that, because their law says it has to go to your spouse and children. And now you've got a conflict of laws, and you've got this endless trouble. Apart from the fact of trying to get a South African will translated into French is not so simple. Then you've got different concepts. You've got a usufruct in South Africa, which you do have a usufruct type concept in French law, but it's not exactly the same as South African law. So it gets very, very complicated, and it's far simpler if you've got a fixed property or you've got major assets offshore to have that foreign will. But then it goes into the next issue. Do I need a separate will in each jurisdiction, number one? Mm-hmm. And number two, how am I going to get the foreign will drafted? I just go to my South African lawyer and ask him to draft a will for my French assets.
And they know Napoleon, but they know about the elephants and the Alps. They don't know the law.
Exactly, and they might not know about forced heirship and about all the French terms. And then you start looking at costs. And, what's it going to cost you to do a foreign will? Do I need a foreign trust? And then all these things start coming out. And again, it's not a simple answer. It's not a one-size-fits-all. So you might say, well, I've got a bank account in the UK. My South African will can do the job there, but it can't help with the flat I've got in London or the house I've got in the south of France. There I need a proper will, and I need proper estate planning. Do I want a foreign trust to own it? Do I want a foreign company to be owned by the foreign trust? Because again, what's going to happen when you die, you'd have this issue of winding up that foreign estate, the foreign will, the foreign executor, and the foreign distribution. So you need to think that through here. And again, the answer is preferably, if you can afford it, to have separate wills in the foreign jurisdictions.
And the key point, I suppose, and certainly what you've alluded to, is make that plan up front. It's things, for example, do you want to have it in a company or a trust or a company owned by a trust, etc. Plan it now and find someone who is well-versed in this process. To your point, I got a lovely lawyer, but I'm sure if I asked him to write me a French will, he would be like, I have no clue. A German, exactly. Whatever the case may be, finding those experts who are proper niche experts in their area of expertise.
Yeah, Simon, I think we need to be honest here. We need to be quite elitist. You either can afford the foreign structure or you can't. So, for the average South African, without being negative, that's me and you, if they've just got some basic investments offshore, now they've got to decide, do I want the expense of a foreign trust or a foreign company or a foreign will? It's not worth it. It eats up your return. And I've said to you earlier, I'm going to talk quite openly to my book. Obviously, I work for an insurance company. But what we found is a very simple solution. And it doesn't have to be with my company. All the South African insurers offer it, is this offshore endowment wrapper. And what an offshore endowment wrapper is it's obviously an endowment policy, but it's issued through one of our offshore offices. We go through Mauritius. Some of the companies go through the Isle of Man. Some go through Bermuda. It's all through a tax center. And it allows you to wrap unit trusts into this wrapper. So you can have a choice of like 300 different unit trusts, including ETFs, which you put in this endowment policy. And it falls under our law and under foreign law. But what's so neat about it is you nominate this beneficiary. Now, it can be a beneficiary for ownership, which means the policy itself moves over, or it can be a beneficiary for proceeds, which is just the cash from the policy moves over. But you nominate that beneficiary or beneficiaries. When you die, the money or the policy pays direct to the beneficiaries, and there's no foreign will needed, there's no foreign executor needed, there's no foreign legal problems to go through. It just pays over. And in that way, you're getting the distribution done at a very effective rate. And it's simple for the average South African. You know, it just takes away that whole layer of foreign estate planning that you need to go through.
And it pays to the beneficiary. So in other words, it almost, I mean, and there's a legal jargon here which I don't know, but it kind of supersedes your will. Your will sits at one side. The endowment says, in the event of my passing, this is who inherits, this is
how they inherit. It's a life policy, so it doesn't need to be mentioned in the will.
Okay. And that then would hold, I mean, so it's not going to hold my property, because my next question was, I get your concern around fixed assets, but what around if I've got ETFs in there, I've got unit trusts, or perhaps cash offshore, that then fits, those would then fit within the endowment policy nicely.
Correct. Anything like that can fit in. And now, I mean, talking about fixed property, and I've got to talk to you about this case. We had a client a while ago, had this fixed property in the US. Now, he wasn't living in it. I mean, obviously, if you're living in it, you can't do anything. That's your property. But he was just renting it out and using it as an investment. So we said to him, you know, when you die, you need a foreign will, foreign executor, and we'll come to the foreign taxes just now. We haven't even got there.
I know.
The foreign citus taxes. And we said, do you need this? And he said, no, I just want to be exposed to the American property market. So what he did is he sold this American property, obviously paid some CGT because he had made some small gain, took the money, put it into a foreign endowment wrapper, and he bought an American property ETF. Now he's still got that same American property exposure, probably better, because now he hasn't just got one property. And he's now in an offshore endowment wrapper, so there's no need for any of that. There's no foreign will, foreign executor, and there's no foreign citus tax, which we'll get to now, because it's not sitting in America.
Yeah.
The endowment policy sits in a tax center.
So that is quite cunning because, and in fact, even locally, I said to a lot of people who want to do the buy for let, I've said, well, that's nice, but you need that critical mass. And I don't want the phone call at 2 o'clock in the morning when the geyser breaks or, you know, my tenant absconds with all the fittings or something like that. You actually say, well, that's an asset, but we can do you better by just getting into a collective investment scheme ultimately. Gets you diversification, massively reduces risk, and takes the stress of management off your hands.
And take that offshore. I mean, you don't want to call from at 2 in the morning that your offshore keys is gone.
New York. Yeah.
And again, it just makes it simpler. And the endowment wrapper, of course, gives you that issue where you can distribute to your family. And what's so nice about the endowment wrapper as well, it falls under the South African Insurance Act, the Long-Term Insurance Act. And if you've got a life insured on, which you would have because it's a life policy, after 3 years, it actually is protected against insolvency. That's Section 63 of the Long-Term Insurance Act.
Okay.
And that means, you know, that endowment wrapper, it's so simple and it's not hugely expensive. And you've almost got a full estate plan. You've got your insolvency protection. You've got your distribution to your heirs that you want. You've got your investment planning in there. It's just a kind of a one-size-fits-all for the average South African.
And that would be with already offshored money. You get the first $1 million and then sign some paperwork. You've got the next 10 million.
So exactly.
Per individual per year. But that's with your offshore money
That's
already.
using your allowances, either your 1 million or your 10 million or both. I mean, it's using your allowances.
What sort of minimums are we looking at?
So I can talk for us, and I think most of the insurers are the same. It's about 350,000 Rand, which divide by 18.2, you can do the math better than me.
It's not even 20,000 not even $20,000 at this point.
Yeah, it's about that. So it's, those are the kind of minimums.
Okay, so and that's not massive. Okay, so that's one way of managing the assets. And I got to say, I like it. I'm a big fan of listed assets, your ETFs, your unit trusts, rather than fixed assets. I know some people like property, but I think there's better ways of getting exposure to it. The next part, which perhaps becomes even more complicated, is when you do pass and there is tax implications, there is citus, there is all sorts of complexities in that space. And it's not a simple process at all.
Right, so I mean, I'm a tax lawyer, so I love citus tax.
Okay, there we go. Someone has to.
And I love Latin, because we had to do Latin at varsity. So citus tax really says you pay tax where the asset is. And the US and the UK are big on that. So if you've got, property there, normally it's fixed property, but you can have other assets there. Those assets will be subject to citus tax there, which is really their death duties. Now, of course, what's so neat about that is their death duty rates are a lot higher than ours. So we complain in South Africa that we're heavily taxed, and we might well be. But when it comes to estate duty, we're actually not. So our estate duty rates are 20% or 25%, depending on the size of your estate. But their rates are 40%. So in the US, I mean, it's a sliding scale, obviously, but you get to 40% quite quickly. And what's so nice about the US is if you're a non-American citizen, they like blatantly discriminate against you. You've got to love the Americans. So as an American citizen, you'll get about $11 million abatement for estate duty. As a non-American, you get a $60,000 abatement.
Oh, wow. Okay.
So you're going to get to your 40% quite quickly. Now, the interesting bit comes in. So you're a South African, you die in South Africa, you've got this property in the US, you've got to pay 40% death duties. Where does the dollar cash come from to pay those death duties? You know, your South African estate hasn't got dollar cash. I'm not even sure if it's allowed to, raise dollar cash as an estate. How's it going to pay the death duties in the US? It's going to have to sell the property to pay the duties, which is, of course, not what you want. So I'm going to talk to you about another wrapper now. I mean, I'm talking my insurance book, but I mean, it does solve the problem. So we've got a product called Dollar Life, which is a life wrapper. I mean, the endowment policy is a life wrapper as well, but that's an investment wrapper with investments in. Our Dollar Life wrapper is a pure offshore life policy. So you pay your premium, you get life cover, disability cover.
Premium paid in dollars or in ZAR?
In dollars.
In dollars.
Using your allowances as well. So using your 1 million or your 10 million, you're getting life cover in dollars, and it pays anywhere you want in the world when you die. Now, that means if you've got a citus tax exposure of $500,000, you can take this Dollar Life policy for $500,000. When you die, it kicks out dollars, and it can settle your citus taxes quite easily. Now, it gets a little bit more complicated. And, just to complete the picture, you want a neat structure. So you don't want that dollar policy paying to your spouse, and they take the money and run, and you've still got that citus tax exposure. So what we've linked onto that is what we call a short-form trust. Now, again, a foreign trust is a very expensive vehicle. You know, we're spoiled in South Africa. Our local trust costs you 5,000, 6,000 rand to set up, and then off you go.
Yeah.
If you go to an offshore trust, that's going to cost you $5,000 a year to run. And that's before you phone your trustee and actually ask them to do anything. That's
just the base
entry
rate.
level, $5,000 a year. So that's just unaffordable for most South Africans. So what we've done for our dollar product is what a short form trust, which is an offshore trust set up and running through Mauritius, but it can only be a beneficiary of this dollar product or of our endowment product. So it doesn't hold assets, it's a beneficiary kind of to wrap up assets and receive it. And that trust company does it much cheaper for us because they're not holding assets yet. That will cost the client $450 a year, which again is still a fair amount of money, but it's at least affordable and a lot more affordable than $5,000 plus a year. So then you take this dollar product, you use that offshore short form trust as a beneficiary with a letter to your trust company, when I die, the proceeds must be used to settle my death duties. And then you've got a very neat structure which is fully funded and fully structured to achieve its aim. And what's so neat as well is that dollar life policy, unlike a South African life policy, is not estate dutiable in South Africa. Because most life insurance is estate dutiable in South Africa. This dollar life isn't because it's a non-domestic policy.
And what it ultimately is doing, it's removing complexity, which in itself is quite nice.
Yes.
But it's also it's benefiting your heirs because ultimately that duty they need to pay, the profits, whatever it might be, is going to hit the estate at some point. And this is kind of plugging that in, which means there's more to be distributed to the heirs. And
they don't have to sell the property at an inopportune time to raise cash to pay the debt duty. So it's a very simple but effective structure, and it's relatively affordable.
If you've got questions, you can send them events@moneyweb.co.za, and of course you can put it in the chat box on the YouTube channel. If you're on the social medias, #BetterInvestor. A question from Rob, and I'm not going to go too much into the details because we could spend days resolving it, but he says tax resident in Cyprus, South African will, offshore investments, US, Singapore, on the Swiss exchange, i.e. a lot of complexity. Submits returns both in South Africa and in Cyprus. He says, do I need an offshore will as well as my SA will? My advice would be yes, but, and the but is, in points like this, and in many cases, we need to chat to the experts as the individuals, because it's also, each of our circumstances is going to be unique. You know, we're talking Napoleonic law, but maybe my apartment's in, I don't know, Austria or Ukraine or something like that.
You're surprised how far Napoleon got. I mean, it shocks me.
Fair point.
None of us are historians, but I tell you, I mean, you can look at a country like Egypt, and it sometimes had a bit of Napoleonic law. So I think the answer as well, Simon, is the viewer raises a very interesting point. You know, what if I'm spread all over?
Yeah, yeah.
You know, so I've got the yacht in Spain, I've got the flat in France, I've got something in the UK, I've got something in Singapore.
Ferrari in Monaco.
Exactly. I mean, we know these high net worth clients that we dream about. But it might well be worthwhile then setting up an offshore trust. Because if you think about it, to have 4 separate wills in 4 different jurisdictions, to have 4 different executors when you die in 4 different jurisdictions, 4 different sets of law, it's very complicated. If you set up that offshore trust, now of course you're going to pay the $5,000 a year plus, but at least all your assets can be wrapped into that offshore trust, and then when you die, there's nothing. You know, there's no more complexity. And so that viewer should look at the offshore trust option. Again, understanding that there'll be costs to set it up, costs to move assets into the trust, maybe some common capital gains tax. But if he's not tax resident in South Africa, and he's tax resident in Cyprus, which is a bit of a tax center, there might not be CGT there, and it might be a good time to move the assets into that offshore trust.
I want to get to CGTs in a moment, but I also want to get to the point which I kind of alluded to right up front, which is, and it comes to the point of around structuring your assets. You know, and before we came on air, I was talking about someone I know who's got property in 3 different continents, excluding South Africa, 3 different other continents. And, you know, it sounds great, and they're earning different currencies and the like, but they didn't do it in terms of thinking about the implications around tax and CITES. They didn't do it thinking around estates and all of that sort of thing. And firstly, if you're sort of starting out, is plan accordingly. And secondly, if you find yourself in a position where maybe you've got these different pieces all over, it's simpler to say, hang on, to your example earlier, can we actually step back and simplify this process? Because and I get the excitement of owning stuff all over, but it's adding complexity, which we don't need, particularly around death and taxes.
And the other thing, Simon, people forget, you know, you might have this flat in France, or you might have this investment in the UK, but you forget about the tax back here. Because if you're tax resident in South Africa, there's CITES tax when you die, but there's income tax when you're alive, unfortunately. And you'll have to declare that on your tax return in South Africa, because you're tax resident here, no matter where the asset is in the world, and you're going to have to pay tax here in South Africa. Now, we have clients all the time that have to do this, and think how complex that gets, because you've got rental in pounds, you've got costs in pounds, now you've got to declare that on your tax return in South Africa in rands, so you've got to convert pounds to rands. You know, good luck with the way the rand moves.
Sure.
SARS does put out a document on their website every year for an average exchange rate for the year to try and help everyone, so that's quite useful. But again, it's not simple. Trying to work out the average rate for the year, because it works month on month, and then you've got to work out your costs, which you've got to convert to rands from pounds. If you've got a capital gain, say you've sold shares in a foreign exchange, and now you've got to work out your capital gain, convert that back to rands. That's very, very complicated. And foreign dividends tax, you know, if you've got foreign dividends tax, what's your dividend tax there? Have you got a gross dividend or a net dividend? Trying to report that on your tax return, that is complex. And again, you need foreign experts and you need local experts to do it on both sides of the sea.
And part of the trick with that is that I've made some money in dollars or euros or sterling, I don't know, Aussie dollars, whatever the case may be. It's offshore money that I've made. SARS wants ZAR back home. I mean, I can repatriate money back, but that kind of defeats the point. And again, you've got that mismatch.
Exactly. So you've got to try, you know, fund your liabilities back here in South Africa. And of course, bringing it back might mean you sell assets, which creates more CGT and more of a tax problem. So again, I mean, I'm going to talk to our book, and I love talking about insurance wrappers, but again, it makes your life simpler. If you're in an endowment policy, you know, there's still tax. Don't be fooled. It's not like an endowment policy is tax-free. But in the endowment policy, what is so neat is that tax is paid inside the policy.
Because that would be my question. Okay.
So you own this endowment policy, local or offshore, it doesn't actually matter. Let's say it's an offshore endowment policy. There's still tax because it's on our balance sheet, but we pay the tax in the fund for you. So you don't even need to report it on your tax return because the tax has been paid in the fund on your behalf. Now that means, again, no rand-dollar conversion, no working out the complex capital gains tax, no working out the dividends tax, because it's all paid for you. It's after-tax investment in effect when it's in your hands. And of course, it also means not only do you not need to report it, but your tax rate is lower, because us insurance companies get a lower tax rate than the individual.
Sure.
So if you're an individual and you're earning taxable income, you're paying 45% at your marginal rate. In the fund, you're only paying 30%. Now there's not normally much income in these funds, but there's always capital gains tax as you switch and as you move. Now the individual capital gains rate at the top end is 18%, but in the fund, if it's owned by an individual, it's only 12%. And that's a big difference. So we pay the CGT on your behalf, and we're only paying at 12% as opposed to 18%. So again, it depends on your wealth, but for the average South African going offshore, going into these endowment wrappers, you're getting the estate planning, you're getting the tax benefits, and you're getting the tax planning. And there's a nice word I always use from my grandmother called tax schlep. I mean, tax is a big schlep anyway, but offshore tax is a bigger schlep, trying to do all this work and all these calcs. And the other thing, don't forget, which I always talk about, you're invested in a foreign unit trust with a foreign company. You know, it's all very well if it's a South African company, but say it's Templeton or any foreign company. They're not tax residents here, so they're not going to send you a tax form. So you've first of all got to get hold of them, and you're going to say, please send me my dividend tax form for the February 2023 tax year. Then I'll give it to you eventually in dollars. Then you're going to say, please send me a capital gains tax form for the February 2023 tax year. They'll send it to you in dollars. Then you've got to do all the conversions, and you've got to do the calcs, and the foreign dividends you've got to do. But if you're in a foreign endowment wrapper, it's just done for you. And we have to sit and go through the tax schlep on your behalf.
No, that's fine. You're the tax.
And we get paid for it.
You probably love tax. Akbar's asking around rapid 30% default tax. Correct, we've just discussed that. A question from Emma. Emma, I'll be with your question in just a minute. The endowment policy, if I'm understanding it correctly, is not around income for me so much. This is more around estate planning. Is that a fair comment?
And around tax. So, I mean, the question we got around the default, so it's not really a default tax in the sense that you'd only pay 30% income tax in the fund if you've earned income. You know, almost all these offshore investments, are, they're roll-up funds. So there's no income normally earned. It's always rolled up into the price. And that means you're only going to pay capital gains tax if you switch or if you exit. So it's always going to be normally the 12% CGT.
Gotcha. Emma, you're saying dividend withholding tax on an ETF such as the S&P 500, which are inside a tax-free account. What percent are we charged? I can answer this because I've been down this rabbit hole. So IRS would charge you 30%, but you get some of that kicked back. So you get essentially, you're ultimately paying 15% on the dividend only, and that's if you're holding a JSE-listed S&P 500 ETF in your tax account. It's 15% ultimately. There is no shortcut to it, and if we consider that the dividend yield on the S&P, let's call it 2% because it makes my math easier, it's costing you about 0.3% of the actual value of that investment. So you are giving some money to the IRS, but it's not staggeringly huge amounts, and it's not going to make the biggest difference in our life. I mean, fees matter, and you know, less is always better. But in this case, it's fairly modest, and there are some efficiencies to it. But there's still some tax drag there. Some folks will say they don't want to put offshore products into their tax-free account just to resolve that. Emma, that's a question you're going to have to decide for yourself. Personally, the 0.3, I can live with it. The Americans, they could do with the 0.3 right now. It is around that schlep, and it is around the planning, but it's also, you made a point there, which I'd never thought of before. SA insurer will only pay proceeds to a local bank account, and I'd never thought of it before, and initially I look at that and I think to myself, that's not even the end of the world, but then suddenly a whole bunch of things start to come in, and hence talking around your particular dollar life policy, there's so many sort of neat little problems that it solves.
So let me say, Simon, one of my biggest set of questions that I get, I get lots of questions around, miners as beneficiaries, which we all can come to as well. But the biggest issue I get, Dad has just died in Johannesburg, he's got a son in London, he's got a daughter in Sydney, and he's got another daughter in Paris. Now he's got all these assets in South Africa. How do we get the assets to the kids overseas? And then the kids, of course, are fighting as well. And then it's not simple. It's just simply not a simple issue. So there's a SARB circular from May 2021. And SARB, again, with all respect to SARB, they really wanted to make it simpler. And in their circular, they tried to set out a set of rules to make it easier to get these assets offshore to these beneficiaries abroad. But I can promise you can read that circular, and it is difficult to understand. And we've got a group of people called at a CISA, which is a group of insurance companies, and we've got a legal group, which is fascinating. You must come and join us. Every 3 months we meet and we talk about insurance tax law, the highlight of all of our year. And none of us could understand the circular, and it's contradictory, and it's just not simple. I mean, Forex is not simple, we know that. As much as they try to make it simple, and they are trying to make it simpler, it's just not simple. So if you've got a kid abroad and he's trying to get the money out, or she, are they tax resident in South Africa? Do they have their allowances still? Because if you're not tax resident, you don't get the 1 million allowance.
Ooh.
That's something what the SARB circular says.
Okay.
So you've got to try and get the 10 million allowance, you've got to apply for a tax clearance certificate, but then, you know, Johnny's been living in London for 20 years, he hasn't got a tax number, he's not tax resident here anymore. So it's just messy. And then what we would do at the insurance company level, we will say, Dad had a life policy here, great, we'll pay the money to a local South African bank account, and then you go sort it out with SARB and get the money out, and good luck. No, I mean, that's just the reality of it. But if you've got your dad had a foreign life policy, you know, the dollar life, or a foreign endowment wrapper, there's no issue because it's already offshore, it's an offshore product. The allowances have been used by Dad. We'll pay the money out to a foreign bank account anywhere in the world.
Okay, so
and that South Africans don't realise the problem.
And that dollar life, I can, to your point, and it's nice and cheap because there's no assets in it while you're alive. You pass, money then flows into it, which will be in a foreign currency. It's already offshore. I can use that to pay the profits on the flat that I have to sell, but I can also leave it to my heirs.
Exactly. And we pay, as I say, to a foreign bank account anywhere in the world, so the heirs don't have to go through the Forex issue when Dad dies, because the money is already offshore.
And they don't have to phone SARS and get reference numbers and other bits
exactly,
and pieces.
And
with credit, SARS is way better, but SARS is, tax is never fun anywhere in the world. Miners as beneficiaries, you mentioned that. Is that a further complication?
So it is, because now the first thing is a miner, as you'll know in terms of Forex law, can't actually invest offshore. It's one of the quirks of Forex. You have to be 18.
Of course.
You have to be 18 or over to invest offshore. So even that miner gets that 200,000 Rand allowance, that's to travel. And the miner has to bring the money back when they finish traveling. They can't invest it. So it's the first problem. Now, Dad has got this foreign life policy, and he's got his minor kid, Johnny, who's 5. Now, what does he do? Who does he make the beneficiary on his life policy? Don't make Johnny, because as a 5-year-old, we have it. I have it every month where Dad has died and we've got a 5-year-old who's got a couple of million Rand due to him, and who do we pay? And again, there, you've got to look at the foreign trust option. If you want to benefit a foreign beneficiary who's a miner, or even a South African who's a miner and there's offshore assets, you must use a foreign trust. You can't have a local miner with foreign bank accounts and foreign investments. It just doesn't work. We've had one case where this miner was a 5-year-old, very lucky miner, granny died in London, left him £1 million. Now, we had to speak to the Reserve Bank because we didn't know what to do because he's under 18, and the Reserve Bank said because it's an inheritance, he could keep the money there and it could be invested. But that's the exception. As a general rule, a 5-year-old can't invest offshore. Obviously, he can take a Rand-based local investment in Rands with offshore exposure, but he can't go directly offshore.
So to wrap, because we're hitting the time limit, I mean, in terms of, and let's break it into the two parts. The first part is we want offshore assets, but we want to keep it simple, particularly from a tax perspective. We want to keep it, our tax returns that we have to do every year, quite simple, because we don't want that complexity around that. And that then is that offshore endowment. In your case, it's Mauritius. It is properly offshore. It actually has some tax benefits for me, and then I can leave heirs either as to wrap it up and pay out, or to pro rata give it to my potential heirs, and they're now
the policy itself can move over to your beneficiaries.
And that's a nice, simple, clean way of putting all of that together. The more complex part, perhaps, is that either if you want to bequeath money to offshore individuals or the like, or you perhaps need to clean up an estate in France or Belgium or Egypt or somewhere, is a dollar life policy, which, if I understand correctly, is unique to Discovery.
Yeah, so that's the one thing. I mean, everyone does an offshore endowment wrapper. That everyone in their dog does. But the offshore life policy in dollars is unique to us, our dollar life policy at the moment. We're the only South African insurer that does it. Of course, there are offshore insurers that you can go to.
Sure.
But I mean, I must be a bit arrogant here, Simon. The South African insurance industry is streets ahead of most of other countries in the world. It really is. And not just Discovery, all the South African insurers. Our products that we bring out, our life policies, our endowments, are really a lot more advanced. You go to the UK and you buy a life cover, and you'll get term insurance, which ends at 65. You'll get very basic disability, whereas all our life insurance companies offer whole of life cover, very complex disability, severe illness, and all the other bells and whistles as well, with vitality and all those good things. So, I mean, the South African insurance wrappers, offshore and local, life cover and endowment are really very, very advanced products.
Our financial services industry locally is absolutely world class. I mean, we're seeing American banks fail.
Yeah,
we're seeing European banks, 150-odd European banks not make it. We're going to leave it there for today. Hilary Joffe, Head of Legal and Tax Marketing at Discovery Invest. Hilary, I really appreciate, Harry Joffe. Harry, really appreciate the time. The key thing here is that, as I said right up front in this presentation, yes, we're taking money offshore. Of course we should, because South Africa is such a small part of the global economy. Offshore needs to be a significant part of our environment. But we need to do it with thought. We need to do it with intention. We can't just say, well, this is easy. I can literally these days click, and I've got cash offshore. That's great, but there are implications. There are tax implications. They can be resolved, but they're complex, and there are real implications in your estate when ultimately you pass. And remember, the only two certainties in life are death and taxes. So if you're taking money offshore, stop and pause first and be a little bit smart about how we're doing it. Harry Joffe, Head Legal, Tax Marketing, Discovery Invest, appreciate the time. Ladies and gents, we'll be back after a short break.
I'm Kieran Ryan, and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scamsters. Remember, this is an unregulated area of the market, so one needs to be especially careful. If you're going to get into cryptos, and the stats suggest a high percentage of people are at least looking at it, then you need to enter with eyes wide open. So join me and my expert guests weekly on the Moneyweb Crypto Podcast on moneyweb.coza, the Moneyweb app, Apple Podcasts, and Spotify.
The Moneyweb Crypto Podcast, hosted by Kieran Ryan. Moneyweb, your trusted source for business and investment insights.
We've just recorded the first episode of Fix SA with Standard Bank's Sim Shabalala. Among the many topics discussed, leadership in South Africa and why technology in education is so important. A magnificent conversation.
I love the definition of leadership by Napoleon, which is a leader is a dealer in hope. The second one, I think, is, and again, talking about this podcast, Einstein said, learn from yesterday, live for today, hope for tomorrow. The important thing is not to stop questioning. And that's what you're doing with this podcast. And I keep saying to you that this is just an incredible piece of work. So bravo for that.
Here's an invitation. Join me, Jeremy Maggs, and South Africa's top leaders on the fortnightly Moneyweb Fix SA podcast. Listen on moneyweb.co.za, the Moneyweb app, Apple Podcasts, and Spotify, or follow Moneyweb News on social media for more updates. Moneyweb, your trusted source for business and investment insights.
Moneyweb Frequently Asked Questions, Part 4, the Moneyweb Insider Gold Premium Subscription.
Welcome to Part 4 of the Moneyweb FAQ series. I'm Ryk van Niekerk, and today I'll highlight a few other valuable tools to answer the question, what are the benefits of an Insider Gold subscription? Whether you are a novice investor or a money-savvy professional, a premium subscription offers several tools to keep subscribers informed of all the daily developments and announcements related to listed entities. One of the most popular tools is our live SENS service. With a few clicks, you can access the latest SENS announcements as and when they are released. As you may know, traditional SENS announcements are notoriously challenging to read. However, you can access PDF versions of all SENS announcements, making them easy to read and to save. Subscribers can also elect to receive notifications when companies they follow release new SENS announcements. And exclusive to Insider Gold users, we offer a portfolio tool where subscribers can create their own share and unit trust portfolios to monitor their performances on one screen. Go to moneyweb.co.za and click on Sign Up and choose the monthly or yearly Insider Gold subscription options available.
Moneyweb, your trusted source for business and investment insights.
Hello and welcome to the property session of the Better Investor Conference. My name is Suryan Naidu and I am Deputy Editor at Moneyweb. I also host the Property Pod, which from April is a weekly podcast on Moneyweb, published on Tuesdays. This session of the conference is titled Beware These Pitfalls When Investing in Retirement Property. I am joined by Michelle Domercer, a Cape Town-based conveyancing attorney and estate law expert, who is director of Michelle Domercer and Associates, to discuss this topic. We will not only look at the pitfalls, but the pros and cons of different retirement property options when one retires and is looking to downscale. Michelle is joining us virtually from the mother city. Welcome, Michelle. How's the weather down in Cape Town?
It's good, thanks, Sharon. It's good to be here.
Thanks again. Just a note to our viewers online to send questions via our Moneyweb YouTube chat box or via email on events@moneyweb.co.za. Michelle, to kick off, tell us for retirees rather, what are the key things to consider
when they're choosing a retirement property?
Yes, but also from an investment perspective, which is better, going for sectional title ownership as opposed to life rights?
Yes. Well, in terms of an investment, sectional title is better, because you get 100% of the profit when you sell your asset. So this isn't possible for everyone, because benefit of life rights is you often get a lot more facilities for lower price. So often people can't afford sectional titles plus the facilities they need. And so, yeah, that's why there seems to be so many new developments because it offers people a way of getting the facilities and healthcare they need that they can afford. But unfortunately, it also means they don't get the profit in the life rights as well.
Maybe if you can give us a little bit more detail on the pros and cons of each, because I'm sure there are positives to life rights as well.
Yes, there definitely are. So the pros for life rights is, like I said, they're more affordable. And often they come with lots of facilities, healthcare facilities, and it provides a real community for people. They've got age restrictions of how old you have to be to live there. And so people are surrounded by their own age. And there's also a capital gains tax benefit, because there isn't capital gains if there's no profit when it's sold. Then with the sectional title, there's also a community that you benefit from. And you get 100% of the profit when you sell it. Often they don't come with facilities. And so the levies for sectional title are often lower because there aren't the facilities. But you do also get the benefit of living in a community. But what has to be said for both life rights and sectional title is it does pose a change for people who are used to living in their own home. Because whether you're in sectional title, you'll have a body corporate that you're answerable to, or if you're in a life right, you'll have the developer or the trustees that you're answerable to. So either way, people have to be prepared for quite a significant change.
When it comes to buying a life rights property, it's not always a case of the owner losing the property as an investment when when an owner wants to bequeath it to their children or heirs. Give us some insights on the life rights side of things, just to understand a little bit more detail to why you thinking maybe sectional title is still a better option, because it seems that life rights is becoming quite a thing that's being punted by property developers and residential estates.
It certainly is. So what's really important for people to understand is that a life right can't be released. So it finishes when the person who holds the life right dies. So that's not something you can bequeath in your will. Whereas if you own a sectional title unit, you can bequeath it in your will to a loved one.
Michelle, apologies about this, but can you please turn your sound down and your headphones up a little bit, just to be a little bit clearer?
Is that better?
Is it at all possible for you to wear headphones?
Serene, is that better?
Okay, maybe if we can just maybe speak. Okay, fantastic. That is better. Thanks, Michelle. Not all life rights are the same. What advice would you give a person regarding questions to ask when considering life rights as opposed to sectional title?
Yes. So it's a case of it being very, very important to read the fine print. Every life right will come with a set of rules and regulations and a constitution. And it's really important for investors to either read those or ensure that their attorney or accountant reads them for them. Because in that, it will give them a lot of important information that will affect both their investments and their standard of living in the unit. So it will give them, if there is a percentage profit that's paid at the end, it will give them that percentage. And it will also give them a good idea of what the rules will be to live there. And things to consider for a life right is often there's an age restriction. So if you want to have a guest who's under the age of 50, you'll have to get permission. And all of that will be stipulated in the rules and regulations. And so it's really important for people to read those and to know exactly what they're getting into.
Just in terms of costs, costs such as levies and other ad hoc expenses of owning a property, but also a retirement property is no doubt a big thing to consider, especially for a retiree that's balancing not a certain budget, as it were. Can you give us some ideas on costs? Naturally, it's dependent on a specific property and estate, but maybe a list of possible costs that could come up, especially from a retirement property perspective, I suppose specifically with sectional title. Also, the big elephant or not really elephant in the room, but the issue around load shedding, more and more people, and I suppose retired people would also want to consider, what options they have from a load shedding perspective.
Yes, absolutely. And I think that a lot of developments, life right developments, have they build in generators and inverters and a way to mitigate against load shedding. Whereas the sectional title, generally you've got to put it in yourself and incur the cost. So for maintenance, if you have a life right, your maintenance costs are going to be lower, because that is covered by your levies. With sectional title, you'll still have to pay for maintenance for the inside of your property. Obviously, communal area maintenance is covered by your sectional title levy. And for both of them, you'll have to pay for utilities. I know they often have food levies, which you can choose to take or not with your life rights. So the big difference is with sectional title, you can expect your monthly maintenance costs to be higher, whereas with life rights, your maintenance is covered by your levies, and that cost is fixed. So it'll tell you in the rules and regulations what the escalation is going to be for your levies each year, so you know exactly what to expect and they aren't unpleasant surprises.
Michelle, we are taking a 1-minute break. We will be right back. Welcome back to the property session of the Better Investor Conference. We have Michelle Domercer from Michelle Domercer and Associates talking to us about retirement property and the pitfalls for retirees when they consider retirement properties, and what are some of their options, tax implications and other cost implications. Welcome back, Michelle.
Thanks. Sorry about the sound.
No problem. We can hear you much better, so thanks for that. You were talking the costs around sectional title, but when it comes to life rights, are there any other hidden costs that a person looking to invest in a life rights option, are there any hidden costs worth highlighting?
Yes, look, your monthly levies with the life rights are usually much higher than they would be for sectional title. And this is often because of all of the extra facilities that are paid for by the levies.
As a estate law expert, you've probably dealt with dozens of retirees that have downscaled over the years and have bought properties. What are some of the other things to consider or issues that may have come up where, for example, a retiree decided to go for a life rights option but regrets the decision?
Yeah, I mean, it comes back to reading the fine print and being really aware of what they're getting into. So I always say to people before they get into a life right or buy a sectional title unit to really do their homework and obviously read all of the documents, but also speak to people who are living in the estate. Speak to people, if it's a new development and there's nobody living there yet, find out what developments have been done by the same developer and go and speak to people living in those developments to find out what it's like. And people can do the same for sectional titles. Go along to the block of flats, meet people, ask them what it's like, and just really kind of give yourself the information you need to make an informed decision before you commit to it.
And just in terms of life rights, are there, if you decide you've bought into a life rights and then you say, okay, this is not for me, how easy is it to get out of life rights? Do you have to just, do you forfeit? What are the options there?
Yeah, so all of that will be determined by the rules that you'll be given when you're signing up for a life right. And it will provide, the process about what has to happen if you wish to get out of a life right. Generally, you get back what you paid. Often they take a small amount, a maintenance amount, to restore your unit. But generally, you give them the notice they require, and then you receive most of what you paid for the life right.
Important topic for everyone is tax. What are some of the tax implications depending on whichever option you go for, whether it's sectional title or life rights?
Yes, so for life rights, there will be no capital gains tax payable if there's no profit. So capital gains tax only follows where there is profit. And so if you own a sectional title unit and it's sold, there will be capital gains tax payable on that if it's above the primary residence exclusion. But yeah, so people always get excited and say, oh, there's no capital gains tax for life rights, but that's often because there's no profit.
I've seen you mentioned in some of your articles before, you talk of end-of-life legalities. You may have already covered this in previous questions, but how important is a well-drafted will, for example, when you decide on those different retirement property options?
A well-drafted will is very, very important. And it's a good idea for you to have your will drawn up by people who wind up estates, because then they know exactly what needs to be included. Most South Africans die without a will, and the main benefits of having a will is you get to choose who your executor is and stipulate who you want your assets to be bequeathed to. And the reason why you want a well-drafted will is well-drafted wills are clear. And I always say to people when I'm meeting with them to draft their will, the more detail that is clearly stated that you can put in your will, the kinder it is for your loved ones, because it prevents conflict, it prevents squabbling. It's often difficult for people to know exactly what the deceased person wanted. And a will provides a roadmap so that your intentions and what you want is absolutely clear. And it's very, very important for your loved ones.
When it comes to sectional title, for instance, I understand there's ways to structure your estate so that inevitable implications of capital gains tax and income tax are minimized. What are some of your tips around that to lessen your tax burden, as it were?
Yes. So I'm not a tax specialist at all. So whenever I do a will for somebody who's got a large estate, I work with their financial advisors or accountants to ensure that the most tax efficient options are taken. And there are little things that you can do in a will, like if the person drafting the will owns property, it's really important to stipulate exactly who the property is going to, so that you take advantage of transfer duty exemptions and things like that. But it is something that needs a collaborative approach to ensure that the most tax efficient options are taken for the person.
Michelle, I know you have somewhat of a bias towards sectional title, but what are the trends in the industry, just in terms of your interaction, the amount of clients you deal with? Is sectional title still in demand, or is this life rights becoming a big thing to consider? Perhaps property developers, you might hear of them adding to the incentives to look at life rights as opposed to sectional title developments.
Yeah, look, I think that there is a huge need for care facilities for elderly people. You know, our constitution enshrines the rights for old people to receive healthcare. And I think that is something that developers are creating, is they're creating a place where elderly people can live, where they receive healthcare facilities at a more affordable price. And so I understand why it is a booming part of the market and why there are so many new developers and new developments going up, because I think there are a lot of people who need to have a safe place to live where the facilities are there if they need them, they're secure, they've got healthcare. So there is a real need for that. So I do understand why there are so many new life right options available to people.
To conclude, Michelle, what are some of your key messages around retirement property planning, broadly speaking, from our chat today, and other insights that you've gained over the years as a law expert specializing in this area of the property industry, as it were?
Yeah, it is super important to read the fine print. So, people have got financial advisors that they can speak to, attorneys, accountants. Whenever you're about to have a big change in your life and to embark on a new chapter, it's really, really important to upskill yourself and to gain as much knowledge as you can before choosing the next right step for you. So I would just encourage people to really do their homework, read the fine print, interview other people in similar situations so that they make the best choice for the next part of their lives.
Thank you so much, Michelle. That's a wrap for this property session of the Better Investor Conference. Michelle is the director of Michelle Domercer and Associates based out of Cape Town. Up next, my colleague Ryk van der Kerk has a session on South Africa and the significant political challenges ahead.
I'm Simon Brown, and I host the Moneyweb Now daily podcast. If you're an investor, Moneyweb Now gives you sharp insights into what's happening in local and global markets, with expert market commentary, CEO interviews, economic analysis, and expert opinions on everything market and investing related. As a DIY investor, keeping abreast of important market-moving events, updates and results needn't be time-consuming. Join my guests and I as we navigate the investing world for you every weekday morning in 20 minutes. Live at 6:30 a.m. on moneyweb.co.za or the app, with the podcast available just after 7.
Moneyweb Now. Business, finance, and investment news. Moneyweb, your trusted source for business and investment insights. Moneyweb Frequently Asked Questions, Part 5. How to use the Click and Advisor tool.
Welcome to Part 5 of the Moneyweb Frequently Asked Questions series. I'm Bitumelo Nzoko, and in this episode, we'll share how to use our Click and Advisor tool. Moneyweb's Click and Advisor offering provides financial advisors with the unique opportunity to grow their investor-based audience and attract new clients. Advisors can choose between having just a Click and Advisor profile, which starts at only 650 Rand for 3 months, or the more extensive Moneyweb Insider Pro subscription, which further develops your professional persona as you're able to submit your own opinion pieces and answer readers' questions. This option also includes all the benefits of a Moneyweb Insider Gold subscription. Both options include an advisor profile page with your contact details, company logo, geography, areas of expertise, accreditation, and awards, and can link to your website and social media accounts. Your profile is searchable on search engines, promoted on rotation in our highly popular morning newsletter Moneyweb Now, and is listed on the Moneyweb app. Once you sign up, you can log in, view dashboard at your own convenience. Here's how you can join today. Start by going to the moneyweb.co.za homepage, click on the menu tab, scroll down to Click an Advisor and select the Sign Up for Click an Advisor option. Choose between a profile only or the Moneyweb Insider Pro option. Alternatively, to speak to a consultant, please email pro@moneyweb.co.za. Here is what some of the advisors from our Click and Advisor community have to say.
Hi, my name is Tulisile Nkomo. I am from NFB Private Wealth Management. I have been part of the Moneyweb Click and Advisor for the past 3 years. This platform has been a powerful tool in helping me build and grow my professional profile, as well as educate the masses of South Africa about financial literacy. I'd encourage other financial advisors to consider joining this platform, as it helps in growing your own book and also helps to empower other people by educating and promoting financial literacy. Thank you.
Good day. I'm Elke Brink from PSG Wealth in Pretoria and Stellenbosch, and I've been working with the Moneyweb Click and Advisor team for probably 3 or 4 years now, and this has definitely been an exceptional opportunity for myself and my practice. Not only is this really a fantastic platform for you to educate readers and, of course, reach a much bigger scope of clients. But there's definitely a big opportunity for leads as well, coming from the articles and from the opportunities that Moneyweb provides. So yes, I would definitely advise any advisor to get involved. It has meant quite a lot to me in my practice for the last few years. And yeah, go check it out on moneyweb.co.za.
You can go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
South Africa faces significant economic and political challenges. We will be lucky to see any economic growth this year due to load shedding and widespread corruption, and this has of course pushed down business, investor and consumer confidence levels to record lows. This could result in investors taking emotional decisions, which could be very costly. In this session, we will discuss how investors should look at opportunities in the local market, or whether it makes investment sense to instead look at other markets around the world. Now, I've got two heavyweights participating in this panel. Carl Leinberger is the Chief Investment Officer at Coronation, and Duncan Artis is the Chief Investment Officer at Allan Gray. Carl, gentlemen, thank you so much for your time today. Carl, let's start with the views of South Africa, because confidence levels are really, really low. And how do you see the debate between some advisors, some asset managers saying, listen, take everything offshore, there are too many political risks in South Africa, versus the other side of that debate, listen, the JSE offers value, do not be overexposed offshore?
Yeah, I think the first thing is that there's an enormous amount of emotion right now. All citizens in South Africa would be feeling it. It doesn't matter whether you're financial markets or not. And if you're going to successfully invest, you need to take emotion out of it. You need to be very careful when emotion's high. And I think right now, South African asset prices are on fire sale. And I think to make the argument that you don't own any South African assets, which are, in my opinion, extremely cheap, I think would be an error. At the same time, there are enormous risks for the country, for the fiscus, for the sovereign, for all citizens, and to not avail yourself of diversification, it would be a big mistake. So we very much have a balanced exposure, taken almost the full 45% offshore. We think that there are big opportunities in local markets, but we also think there are big opportunities in South Africa, and we think, to achieve some balance between the two makes sense right now.
Duncan, your views?
Yes, morning, Rick. I think just a thing we've got to think, of course, is the South African stock market is dominated by offshore shares. So just Naspers, Restaurant, BHP and Anglo is about 40% of the index. So, the effect of offshore weight of most portfolios is a lot higher than it appears when you look at fact sheets. But I concur with what most of the people says. I think we're thinking a lot about risk in the portfolios. Are you buying value trades? I think Carl was with me at the Bank of America's conference in Sun City. The companies were pretty bleak there. So I think, looking out to around 2024 is going to be the important thing, because I think the earnings are still there in 2023. But I think the year after is going to be continuing for South African companies. But the other sort of count that is, if I look at the market caps of South African companies in dollars, many of them, it just seems too small. So the South African stock market has gone nowhere in 16 years when measured in dollar terms. So that either tells you our stock market's very poor, or it tells you there are probably a lot of opportunities.
Do we see the performance of the local market, relative to other emerging markets? How does it compare? Carl?
I think the one point I want to make on that is I think that I really don't like the industry's tendency to see South Africa as an emerging market, to obsess about that, to argue, for example, that you can't have emerging market exposure because you live in an emerging market. I think South Africa has very little in common with, for example, Asia. And just because some MSCI benchmark has lumped us together, I really would caution South African investors from looking at the SA market in the same light as other emerging markets. I think we're just so different. We're long commodities, they're short. They're highly productive nations growing strongly. We are unproductive and not growing. Debt levels are much more manageable in many of those countries. We have worrying levels of indebtedness for the sovereign in South Africa. It's just so different. So, I'm quite cautious whenever to frame South Africa and the uniqueness of our market in the context of emerging markets. I think one has to be very careful. I don't know if that answers your question, but it is a particular sort of bugbear of mine. I think people must be careful of it.
But still, South Africans who are living in South Africa and who are investing, they're saving for retirement. This is a difficult debate because the prospects, is very uncertain. What will happen? We have some severe economic problems at the moment. Now, obviously, the performance of the economy is not a benchmark of how investment markets will perform. And there is emotion. So how do you think South Africans living here, let's take my age, I'm around 50, and I've got some significant investment life in me, I hope. How should I look at this? How much offshore, how much local, and how do I strip out the emotion of that decision?
There's definitely no generic answer to that. So the answer, for example, for a high net worth South African that wants to live an international lifestyle, the kids are going to go to overseas universities, they want to travel once or twice a year, that's completely different to the average South African who's retiring on a 7% drawdown, and their primary focus is ensuring that they don't outlive their capital. So I think we must be super careful of generic answers. I think the high net worth South African can afford to take very strong views. They can afford to be wrong. They can afford to mismatch assets and liabilities. They can afford to have all their money offshore and take the stress out of it. I think that the average South African who's actually retiring in quite a tight situation needs a very healthy offshore balance. And in our balance fund, we're currently at 44% offshore, but they also need domestic assets which match their liabilities where they will be over the coming decades, which give high yields, which takes a lot of the volatility out in their portfolio, and which to some extent does give some protection from cost of living that's escalating every year by 6 or 7%. So it depends who you are, depends on what your drawdown rates are. I think diversification is important. And for your average South African, I think a balance of domestic and offshore makes most sense.
Duncan, what are your views on that?
I echo most of what Carl says, but the one thing I would say is the biggest mistake I've seen individual investors make over my career is definitely the offshore-onshore thing. When the rand's very weak, the news is pretty poor, you take money out at a bad exchange rate and you buy the NASDAQ at 5,000 in 2001, and then you bring the money back when the rand's 5. So people make big mistakes, and that's why I think your sort of point on emotion is right. I agree with Carl that we don't really look at it as South Africa versus the rest of the world, and I think it's important that when people talk about the rest of the world, actually almost most of the stock returns over the last 12 years have just been driven by US equities, and within US equities was a number of mega cap tech shares up until the last while. I mean, in Europe, maybe LVMH, L'Oreal, maybe a couple of companies. Most Asian stock markets in dollars are still, flat, just like South Africa. The European index, when measured in dollars, is lower than 2007. So I think you've got to be cautious when you just say, oh, South Africa's bad and the rest of the world's great. Actually, most of the returns have been driven by these big companies in America that have actually been able to grow earnings in dollars. There are very few offshore companies over many years that can grow their earnings in dollars. But I think you're right about the emotion. I think people have subtracted substantial portion of their returns by taking money offshore or onshore at the wrong times.
Yeah, I think your remark regarding timing is critical, and I would assume we are now in that situation where the rand is weak. There are significant concerns about what will happen in South Africa over the next few years. Is this now a period which you caution against for taking money out?
No, so we're not quite as high as Coronation. We're sitting sort of 34, 35% offshore. But if you add the dual listed companies, we're probably close to half offshore. But I think about it slightly different, Urek. As Carl said, it all depends on individuals and what your risk is. If you can afford to hedge the tail risk, that's great. I mean, I don't worry about the rand going to 20. I worry about the rand going to 1,000. And if you think that sounds bad, just go and look at some of the countries MTN have invested in, or just go and look at some of the African currencies that the South African corporates have been caught in. So it's really a massive devaluation that hits you in one day, because then you have no chance to react. So we always think about hedging that sort of side of the currency risk.
But Carl, the facts are the S&P 500, the absolute return was around 12% over the past decade, and in South Africa, the ALSI over the past decade showed growth of 3.2% in dollar terms, just over 10% in rand terms. So if you just look at the historical performance of the past decade, it suggests that offshore markets will perform really well, especially US markets. So obviously that is in 2020 hindsight. But how do you think people should look at those facts and incorporate it within their strategies?
Yeah, you want to distinguish in investing between the rearview mirror and the windscreen, right? So, I mean, for sure, South African markets have done poorly over the last 10 years, and global markets, and as Duncan says, mainly the US, have done really well. So why has South Africa done badly? Again, difficult to answer because we've got global stocks listed here, we've got commodities, we've got domestic stocks. But certainly, I think for the domestic stocks, the big reason is the very poor performance of the economy over the last 10 years and very, very high prices 10 years ago for domestic assets. And 10 years ago, we were super, super negative on SA equities as an asset class. And, we strongly cautioned clients against exposure. We ran incredibly low exposure. So in our balance fund 10 years ago, we were at 55% in equity. We're currently at 74% because sure, the economy is not performing well, but asset prices are low. And that's the big thing you've got to get right in investing is you've got to be able to understand the economic environment. You've got to understand what's happening to the economy, what's happening to businesses. But then you need to look at what you're having to pay for assets. And if asset prices are low, you're just in a much better place than when you're having to pay a high price for them. And so the key point I would make is that we are much more positive about JSE equity exposure today than we were 10 years ago because today prices are low.
Yeah, Duncan, I'm sure you agree with that because your foreign exposure is lower. But is that pretty much the way you also look at the market?
Yeah, so I think Carl makes a good point. People forget South African equities outperformed the S&P and the world index by quite a few factors from 2002 at the bottom to 2010. And we've roughly been underperforming since 2010. And I remember in those years, exactly like Carl said, in 2007, we were saying, you should take your maximum offshore and South African equities are expensive. And they still went up for another 3 years and all the investors were pretty unhappy. So it shows you how the psychology can change. But I think if you look outside the dual listed shares, it's very hard for South African companies to grow profits because you're basically only growing by taking market share from someone else. Either Shoprite's growing at the expense of Pick n Pay and Woolworths, or Tiger Brands is growing at the expense of AVI. There's not this sort of cake that's growing at 5%, sort of 5% real. But people know that, and so valuations are pretty low, and profits haven't gone up a lot over the last few years. So if you want a positive, the biggest positive about South African equities is that it's so bad, right? Because you just need to get a little bit better. If profits expand and people put a higher multiple, you could see reasonable returns from South African equities. And I personally think the dual listed shares in South Africa are far more attractive than the mega cap tech shares in the US. So I think you could also eke out a few basis points over there. I think Carl might disagree with me on that, but we think some of the, things like ABM and British American Tobacco are pretty depressed versus the big American stocks.
Yeah, and in many ways they are international stocks. So, sorry, Carl?
I think what Duncan was saying a little bit there, and he said in his earlier comment, which we very strongly feel, is that there are times in markets where the benefits from stock picking are not easily felt. Sometimes even the returns from stock picking are low, and then there are times when there's an outsized, the potential for outsized return from stock picking. And we definitely think that this is one of those times, because as Duncan was saying earlier, there's a lot of value traps in South Africa right now, where you're seeing stocks on 7 or 8 times earnings, where you think they're on 7 or 8 times earning. They look really cheap. They haven't traded at these levels in a decade or two, but the earnings base is going to take massive pressure in the next 2-3 years because the economy is weak, the costs of business are going up, maybe they're losing market share. And conversely, there are businesses that are either taking market share or are better businesses than the market acknowledges. And trade on low multiples, and they're going to be great investments. And so you're trying to as an investment team get that right. You're trying to make sure you're correctly avoiding the value traps and finding the very meaningful value that there is in many stocks. And so I think this is a stock picker's market.
Yeah. I would like to hear from viewers. Send emails with questions to events@moneyweb.co.za. If you're watching on YouTube, just use the chat box and I will put the questions to the panel. Duncan, of course, we are talking about equity markets at the moment, but the South African investment world is a lot bigger than that. From a risk perspective, a local risk perspective, do you also have you changed your asset allocation model within your multi-asset funds just to try and reduce the risk?
Yeah, so we think about, as I mentioned, we think about risk a lot at the moment. And you haven't mentioned, I think, the sort of elephant in the room in the asset management industry, and to my mind, certainly when you take part in panels like this, and that's South African government bonds. I think it's a very consensus view in the South African asset management industry that South African long bonds are very attractive. You get a 10.5 to 11% yield. Inflation goes back to 5. You're getting a 6% real return. Why bother even analyzing any equities? And we can see that the flows in the retail industry mainly go to the fixed income and income funds. And one of the things we did correctly, I think, over last years was, we reduced our duration. So we're not quite as bullish on South African long bonds as I guess the industry consensus is. The yield curve has flattened quite a lot. We can get almost 9% on a 1-year note with a bank. So we've moved, a year and a bit ago, we moved quite a bit more into floating rate sort of debt and into sort of shorter term paper. And then I think the one thing that's important from a risk and asset allocation point of view is China. So our stock market is massively exposed to China through Naspers, Richemont, and the commodity companies, and indirectly because South Africa only runs a surplus when commodity prices are high, and China tends to be the main buyer of those commodities. So, I mean, it's an extreme situation, but if you wake up and China invades Taiwan and we get a Russian scenario, South African portfolios could take a real hit. So that's why we like owning something like British American Tobacco. It has zero exposure to China. ABM have only single digits, where something like Richemont and the commodity companies and many of the global consumer companies, Apple, Nike, Starbucks, Disney, most of their growth comes from China. So that's something we think a lot about in the portfolios as well. And what we also did was we've introduced a hedge in the portfolio. So that's one of the things that helped performance last year. We had roughly 10% of the portfolio hedged offshore, which produced an 11-12% in dollars when you took big losses in equities and bonds. So there are other means that you can sort of play around with your asset allocation to try to protect against risk, especially when you don't see a lot of value across all asset classes.
I want to come back to your remark about external risks. But Carl, your views on bonds and diversification also through a change in asset allocation?
Yeah, I agree with Duncan. We, as a team, are obsessing at the moment with the debate of what happens in South Africa 5 to 10 years from now and the risk that we find ourselves in a debt trap. And were that to happen, do you go the financial repression route? Do you allow inflation to run? Or do you go the quantitative easing where the central bank just becomes a massive buyer of government bonds? Or do you default, restructure? Where do you want to be? Do you want to be in cash? Do you want to be in fixed rate bonds? Do you want to be in inflation-linked bonds? We've incredibly carefully gone through every single major default in by global sovereigns since 1960, trying to work out the lessons where you want to be positioned. I definitely agree with them. It's not as simple as saying you're getting 11% yield and you can buy bonds. In our balance funds, global balance funds, we're sitting about 13% in government bonds. So we don't have that's a big underweight. And then we've been quite careful about where we are on the yield curve to try and manage these risks. I think these risks that Duncan and I are talking about there are completely irrelevant over the next year or two or three. But I think the investor who ignores the sort of longer dated risks, makes a big mistake. So I agree with them. I think it's nuanced. I think it's difficult. I think there's so many known unknowns, so many unknown unknowns. Certainly, I'd echo what he's saying, that if you aren't thinking carefully about those risks today, then you're failing your clients. And certainly, it's one of the most hotly debated issues in our team. We take a constant poll. We've been doing it 2 or 3 times a year for 5 years already as to whether or not, in our investment time horizon, South Africa finds itself in a debt trap. And the team is quite split on the issue. But yeah, certainly we're very mindful of it, and I agree with him. It's not receiving enough attention in the industry debate.
But did your team, through their views, is there a bit of a consensus view of what could happen and what should be done now to try and mitigate that risk?
No, there's no consensus, because there's a decent part of the team that thinks we can muddle through this. Which so many countries have successfully done over the last decade. And then there are people like myself that are more worried. Typically bankruptcy works in the following way, that it happens, incredibly slowly, and then it happens enormously quickly. Your day of reckoning comes with absolutely no warning. So, there are a lot of people who take comfort from the fact that, we seem to be muddling through these things, but I think already our levels of debt have become unsustainable. And I think trying to navigate that as the sovereign over the next 5 to 10 years, that's going to be enormously right. And I think it requires a lot of things to go right for it not ultimately to manifest in some kind of crisis at some point in the future. Very unlikely in the next few years, but certainly, within my investment horizon, I think it becomes an issue.
Duncan, those are harsh words. I don't like the term bankruptcy. Obviously we have a fiscal problem in South Africa. It's probably still manageable, but as Carl said, if it gets worse, the slope, the angle of the slope can, worsen quite quickly. How do you view this scenario?
So Rick, we've got quite an interesting lens to look at it, and I know Coronation did this too. I think we run the world's biggest African bond fund. So, when you look at Angola, when you look at Senegal, Uganda, Ghana, Nigeria, we've done reports on all these countries, and it's quite interesting because, if you look at the US, you can't just forget about their debt and that. But when you're Nigeria, when you're Ghana, you can literally run out of dollars. You run out of dollars. And if you think Kenya is one of the better run African countries, you can just go and look what's happened to their currency at the moment. So I think Carl's right. It'd be very naive to think it can't happen to South Africa. We've kind of been saved a little bit, in my point of view, by 2 things. One is we have a very sophisticated financial services sector. So when our dear President, Mr. Zuma, changes the finance minister, you wake up on Monday and the bonds have moved massively, and the bank, insurance, and property stocks are all down 20. And the Treasury Department can go, and the Reserve Bank can point to the government and say, look at what you've done. That doesn't the other countries don't have as deeper financial markets. The other one is we have quite a resilient private sector. It's quite incredible when you speak to some of the companies now, after all the mismanagement of our economy and a no-growth economy, some of our companies have run pretty well, and the management are really resilient. And one of the trends we're seeing is private companies are just taking over from the government. The one thing we're very careful of, I don't know if Carl has the same problem, but a lot of the fund managers here live in Cape Town. And last week, we were in Johannesburg and then driving to the northwest, and I was, please take me back to my Cape Town bubble. That's what I was thinking, right? So we've got to be very careful at sitting in Cape Town. We don't underestimate the problems in the rest of the country. But interestingly enough, our Africa Bond Fund, I haven't checked recently, returned the same as the all-share index over like 10 years, despite all the problems. But then you were starting with like 15, 20% yields. And obviously South Africa can't afford that at the moment. The one thing Carl didn't mention was next year's an election. And I was fortunate enough to vote in the first democratic election, but there's a chance for my first time as an adult, we're going to have a country with no majority government. And if you look at the way the cities are being run, it doesn't give you much hope about coalition government. So that's another risk I think the foreigners might be waiting. Because, you know, if yields go high enough, foreigners will fund our government. It's just whether we don't want to get there.
I think another positive you can add to the list is SARS, because SARS has overperformed or performed above budget now for a few years. And of course, the more revenue we get as a country, the more favorable our fiscal ratios will look. But gee, my hair is almost tingling in my neck because we've got a lot of external risks. You've referred to the war in the Ukraine. In an earlier discussion, it was made very apparent that the impact that war could have on the world could be significant when it ends, because it will depend on how it will end. And the impact could be felt far and wide. We have interest rate cycles in the rest of the world which are pretty aggressive. So there are many risks facing South Africa at the moment. What of those risks are you the most concerned about? What do you think could have the biggest, let's call it medium-term impact on South Africa? Would it be foreign risks or domestic risks? Carl?
I think the quick answer to that, I mean, you've thrown so much at the problem here, and as Duncan says, a lot of South African companies and citizens are resilient, and they're still sort of finding ways to carry on. I mean, I think it's not like we've got a prosperous system and we're asking what could break the system. We actually have a system that is failing, and already we've thrown so much at it. Probably the biggest risk in the next year is just that Eskom deteriorates meaningfully from our already poor level of performance. I think I'm almost a little less worried about South Africa, just because so much bad has already happened, so much bad news is in the price. Probably the biggest worry for me from a global perspective is just inflation, interest rates, the risk of recession. These are all things that global economies and global investors have not had to deal with over the last decade. And the consequences of those, all of which I think are, the risks are heavily skewed to the downside, that's going to be a lot for global markets and global economies to absorb. So I think that's also very important in this debate to bear in mind. As much as South Africa has its own challenges, you don't need to explain that to any South African. We're all aware of it. Internationally, there's a whole lot of risks that are no longer sort of academic debate. They're sort of actually playing out before our eyes, whether it's geopolitics, whether it's inflation, whether it's interest rates, whether it's over-indebted sovereigns. These are all very real risks in global markets right now.
I think let's draw a line under risks, because South Africa does not have a monopoly on problems. I think there are many other countries facing probably different problems, but it will also affect investment markets. Duncan, if you look at the local market, a current recurring theme was it's undervalued, or it offers fair value, and there are several sectors and companies within those sectors that offer value. Where do you see the opportunities, and can you maybe mention a few companies you are actually investing in right now?
Okay, Rick. So just let's caution that our big stocks are all the multinationals. So, British American Tobacco, our biggest purchase over the last 2 years has been AB InBev. Then we own Glencore. And I think what we look for when it comes to domestic stocks, ones that are focused more on the South African economy, is self-help stories. So if we go back a couple of years, you look at Woolworths, the huge problem in Australia, the clothing business not doing well. We spent a lot of time trying to prove that David Jones was worth at least zero, because people were valuing it at minus like 10 billion rand, and then you had the clothing business where the margins were pretty low. And Woolworths has been a fantastic investment since then, and it's because there was something they could do. So generally when we're looking at local companies, it'll be, do they have something that can enable earnings to grow outside of a low growth a low growth economy. And as an example, I think, Coronation, I think if you still Carl can correct me wrong, they prefer First Rand, we have Nedbank and Standard Bank. Standard Bank's Africa story may or may not work, but at least it is something that's independent of the South African economy. And then I think there's some things which are just dirt cheap. If you look at the hospitality sector, so our clients are invested in Sun International, Tsogo, Southern City Lodge. If you convert their market cap or their market cap plus debt into dollars, I mean, for Marriott or someone, they could buy them with pocket change. And you'll be getting these huge businesses sitting over here in dollars. And I do think if South Africa works other than commodities, what we've certainly recommended to the government is travel. I mean, at Cape Town at the moment, here at the waterfront, it's just packed with foreigners, and that's a very labor-intensive sort of industry. So self-help stories in South Africa and some things which are just very cheap. I think the hard thing to call at the moment is commodity prices, because obviously all the big diversified miners are all on single-digit multiples, but obviously those prices have been coming down. And when commodity prices come down, it's also likely that the rand would weaken. We go back to a deficit, and that puts pressure on the local economy. So you asked Carl earlier what his biggest risk is. My sort of biggest risk would be a true implosion in China, because I think that's the biggest bubble in the world. But I've thought that for 16 years, so you don't have to listen to me on that one.
Yeah, that is indeed a risk, and it's also not only for South Africa, for many countries around the world, probably the world economy as well. Carl, what is your proof in the pudding? Where are you investing now, and what are you staying away from?
I think unfortunately it's a very difficult question to give broad brushstroke answers to. I think the stock picking is particularly important. So for example, I'm not that bullish global equity indices, but I think there are so many stock picking opportunities, so many companies that are just being completely mispriced in an environment where factor-driven investing is just driving share prices. And I think that if you stock picker with a 5-year view, I think you can find so many stocks that are going to do incredibly well. In South Africa, I think there are significant stock picking opportunities. As much as the economy is performing poorly, there are some businesses that are growing strongly, either because they're taking market share or because they're in growth industries, for example, private education. I think that you have to be careful of SA bonds, but I think, for example, in the global credit space, there are amazing opportunities to buy well-capitalized businesses that are trading where you can buy their bonds at sort of 8 to 10% yields in hard currency. So I think that when people are worried, it's a good place to be. Okay, what you don't want to be is in a market where no one's worried and everyone's high ego and overconfident. And right now, whether you're a South African investor or a global investor, all we'll talk about is the risks, because the risks are real and there's lots to be worried about. But consequently, asset prices are low. And I think that if you're with a manager that has proven stock picking skills, that thinks long term, I can't believe that manager won't put a balanced portfolio together that will deliver really good returns over the next 5 to 10 years. And that would be sort of my summary of the kind of markets we're in. And it's why, as much as there's so much to worry about, we actually are quite confident. And while our balance funds are actually sitting quite high in equity, whereas 10 years ago they were really low.
Gents, that's all we have time for today. Thank you so much for sharing your insights. I think will remain in a very nervous period, especially the short term. Of course, it's very difficult to invest, for the short term. But I think what will happen over the next few years, and especially if we can recover from our electricity challenges, it will impact long-term investments. And good luck with your job. Good luck with managing people's retirement money, because your success will determine how well they can retire. But again, thank you so much for sharing your insights. That was Carl Leinberger. He's the Chief Investment Officer at Coronation, and Duncan Artis. He is from Allan Gray. Gents, thank you so much for your time today. We're going to take a short break. We will be back at 1:45, so please stay tuned. And please keep those questions coming, and send emails to events@moneyweb.co.za, and also use the chat box facility on our YouTube channel. Stay tuned.
Did you know that small and medium-sized enterprises, or SMEs, contribute more than 30% towards South Africa's GDP? They are the lifeblood of our economy and make up an incredible 90% of businesses across the country. I'm Akona Machoba, and I'm really passionate about small business. And I'm inviting you to listen to my new Moneyweb podcast, Small Business Conversations. I will be digging deep into the minds of entrepreneurs and business experts to give you the essential information as well as practical tools you need to protect and nurture your business. Each week, I will talk to those who've made it in or influenced the sector on topics such as financing growth, job creation, the impact of SA's energy crisis, mental health, and the role of technology in the pursuit of growth. If you are interested in starting and succeeding in business, I would love you to join me and my guests from the 2nd of February on Small Business Conversations. You can find the pod on moneyweb.co.za, the Moneyweb app, Apple Podcasts, and Spotify.
Moneyweb, your trusted source for business and investment insights.
The Moneyweb Frequently Asked Questions series. Part 1, all about shares.
Hello, I'm Simon Brown. Welcome to part 1 of Moneyweb's FAQ video series. In this series, we're going to give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I will take you through all you need to know about shares and more. The most popular question, what are shares? Shares are listed slices of a company. Each share gives you the right to a share in the profit and a vote at the annual general meeting. They trade in an exchange, such as the JSE, whereby investors can buy and sell. Another popular question, why do shares exist and how do they work? In order for a company to raise money rather than a loan, they sell part of the company to new shareholders who essentially give the company a permanent loan. What are the different ways I can buy and sell shares? You buy them through a stockbroker or within a fund, such as a unit trust, an exchange-traded fund, or a pension scheme. Will I be taxed on my shares? If you make a profit, you will indeed be taxed, but only when you sell. Dividends, your slice of those profits every 6 months or year, will be taxed at a flat 20%. In the next video, I will highlight important information to consider before investing. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
I'm Kieran Ryan and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scams. I'm Kieran Ryan and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scamsters. Remember, this is an unregulated area of the market, so one needs to be especially careful. If you're going to get into cryptos, and the stats suggest a high percentage of people are at least looking at it, then you need to enter with eyes wide open. So join me and my expert guests weekly on the Moneyweb Crypto Podcast on moneyweb.co.za, the Moneyweb app, Apple Podcasts, and Spotify.
The Moneyweb Crypto Podcast, hosted by Kieran Ryan. Moneyweb, your trusted source for business and investment insights.
The Moneyweb Frequently Asked Questions series. Part 2, Investing 101.
Hello, I'm Simon Brown. Welcome to part 2 of Moneyweb's FAQ video series. In this series, we give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I will take you through the main facts you need to know about investments. The big question, what are the different types of investments? You've got shares, you've also got unit trusts and exchange-traded funds. Unit trusts are active, they buy and sell all the time, trying to do better than the market. Whereas an ETF is passive. They buy and hold the market, giving you that market return. What about the risks involved in investing? You certainly can lose money, especially in the short term. Long term, quality companies do well and increase profits, and this will see the share prices increase as well. When is the right time to consult a financial advisor? If you're not comfortable managing your investments yourself, there's always a lot of help online. But a financial advisor can add real expertise, and Moneyweb's Click an Advisor is a great place to look for one. How do I monitor the performance of my investment portfolio? Your broker will help you with the value of your shares as well as news from the company. Financial publications such as Moneyweb also offer amazing content. How can Moneyweb equip me to invest better? Moneyweb has a great tools and data page, as well as company news and a great selection of podcasts and articles every day to help keep you informed. In the next video, part 3 of the series, Moneyweb's editor Ryk van Niekerk will unpack Moneyweb's premium subscription offering, Insider Gold. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Simon Brown here, host of Moneyweb. Now, in this session after the lunch break, we're going to be talking fees and taxes that can, truthfully, they can squeeze your ultimate returns. There's something I think we often don't give a lot of thought to, but they are critical and they are truthfully unavoidable. There's no investment product, there's no investing, there's no return without either fees or taxes. You're going to get both of them at various different points. I'm joined with 2 absolute experts to help me unpack this. Kanisa Nganda, Head of Tax Service at S&G Grant Thornton. Appreciate you joining us in the studio today. And then Zwelaki Mguni, Chief Investment Officer and co-founder at Benguela Capital. Ladies, gentlemen, appreciate joining. I'm going to come to tax in a moment. Let's start first with something around the fees. And I want to start right at the base of the point, and that is the exchange. And I chat with a lot of folks and they always say to me, oh, the fees are because of the exchange. And my question to you, is that a fair response? I mean, certainly there are fees at the exchange. Is your sense that they're expensive? Notwithstanding, of course, we're getting alternative exchanges where we can transact as well.
Yeah, I mean, it depends on which fees you're talking about. If you're talking about the fees in terms of us as fund managers trading, I think those fees are minuscule, to be quite honest. I think the brokerage runs at about 25 basis points or 0.25 basis points in the worst case. And I think if you're looking at fees from fund managers to clients, I think that's where there could be a major effect. And certainly, I think those fees can be justified by the amount of investment and resources that go into finding ideas that could be invested in with your money. So fees play a role, but it depends where. So if you compare, for example, passive versus active, the fees would be higher on active because you need analysts to actually generate the ideas. On the passive side, you basically take the index as you see it on the stock exchange and you replicate it.
Yeah, and hence some of the passive. I mean, I think the cheapest passive in our market is at 10 points, 0.1. Offshore, I mean, the VOO, which is a $1 trillion fund probably, or at least hundreds of billions of dollars, is 0.03. But to your point, they basically pay a provider for the index and then they can run an algo out of an Excel spreadsheet almost.
Sure, for sure, certainly. So it does make a difference, but I mean, I think if you look at the history of our industry, the fees have been significantly high from an active fund manager point of view. And in some respects, I mean, it's justified that the returns haven't been as good as what clients expected. So certainly the fees have had to come down. And I think the emergence of passive was actually a major driver in bringing the fees on the active side down. So it's been quite a benefit for investors in that way.
Yeah, I remember, and I've told this story before, my first unit trust just before the emerging market crisis of 98. I probably bought it about 1997. My fees before performance fees was 5.5%. Now, it never performed, so I never paid performance fees. But in truth, I mean, I'm not sure that we have a base fee of 5.5% in a collective investment scheme anymore. I mean, those days are well behind us. Good riddance, but you're probably not paying that at all these days anymore.
Yeah, certainly. I think the most expensive guys I've seen, they go up to 1.5 before advisor fees and all those. Mm-hmm. But sadly, the fees are trending towards below 1% for most fund managers, even in the retail space. Of course, in the institutional, the fees are much, much lower, probably 40 basis points for big institutions. So yes, the fees are coming down.
And that is scale. If I've got a 500 billion rands under management, I mean, I can get economics of scale. I can take my analyst and really squeeze the viability from him. I can get cheap trading fees. If I've only got 10 million under management, it's going to hurt harder. So the institution is always going to get that better, and therefore often cases offer better than the small player.
Certainly. I think also, I mean, in the early days when you start a fund management firm, you're probably looking at, you're going to fund the losses, right? So you're going to pay for the team and all the costs until your business gets to scale, as you say. And once you are over the scale where you can cover your costs, any growth becomes profit now. So I think the argument about fees is actually could also be justified by the owner basis that, once you've got scale, why are you charging us so much fees? I mean, I certainly think that there is a need for balance between the effort that goes into building a fund manager and generating good ideas, and also the thinking about the other side in terms of investors are losing quite a substantial amount of money if you take a big chunk of their fees. I mean, at your 5%, I think...
I was never going to make money. I mean, the idea was it was a small cap fund. It was, we just had elections, I was never going to make money. A quick question before I move to Kanisa. Is there a sense of what that scale is? I mean, do I need to have, is it 100 million or $500 million, or is it how long's a piece of string?
I think if you're active fund manager, probably 10 billion would be a decent size. I think you should be able to get benefits and build like a solid team, solid operations. I think at 10 billion, I think you quite at a decent size.
Okay, I've got a way to go. Some very way to go. Kanisa probably also got some way to go. Tax treatment. I mean, there are the easy taxes, I suppose, in a sense. There's dividend withholding tax. I've received a dividend today from one of my holdings, and 20%, I don't even see it. It just goes straight to SARS. Dividend withholding tax, nice and simple. There's capital gains tax, of course, when I sell a long-term investment, and then income tax, which I get on interest, on REITs and short-term. Those are the kind of simple taxes, which I think probably all of our viewers out there are nodding and saying, we're kind of largely aware of those ones.
Yeah, no, certainly those are the simple, straightforward taxes.
And the distinction between, if I've bought an asset, and let's keep it in the market, so I've bought a share. I've always been told that the rule is 3 years. If I hold for 3 years, past that I'm going to pay capital gains tax, which of course maximum of 18% if I'm in the top bracket, and my first 40,000 Rand is excluded. If I'm selling shorter than that, I'm going to be paying the income tax, which could be 45%. Is that a fair line in the sand, or is that something that traders and investors like me sort of cling to, perhaps without any hard evidence?
No, it is a fair line. It's a fair assumption to make. Sorry, please pardon my voice. So the general rule is if you hold your shares for a period of 3 years, then there will be CGT when you do sell it. But if you then enter into, there's still a lot of case law that says if you have entered into active trade, so you're no longer holding it, you must still determine what was the purpose when you acquire that share. If you acquired it to resell it, even if you sell it after 4 years or 5 years, your intention was not to hold it as a capital asset, your intention was to hold it for trade purposes. So the receiver could still argue that you must pay tax on that sale at normal rate. But of course, you can always apply the section, because it is there, and apply the CGT rules if you hold it for about 3 years.
And that is often I want to say the crux of tax, but one of the important points in tax is intention. And to your point, exactly. And I mean, from my experience, I mean, I will often, I mean, I do the short-term sort of trading stuff, and then I do the sort of longer-term buy and hold, bottom draw type of scenario, and I have process. But intention is not always that easy to necessarily prove. One of the things I do, for example, I have completely separate trading accounts. Yeah. So I can say to SARS, well, this was my long-term trading account. I bought transaction capital 3 weeks ago. The bottom fell out. I sold it quickly because it's a fundamentally different business. Does that help prove intention by saying, here's my short-term, here's my long-term?
Yeah, so I think if you're in the business of doing both, one, it may be a little bit tricky for you, because if you are in the business of investing, then if SARS wanted to be a little bit harsh with you, they could say, well, you are in the business of trading and investments, so then, well, I don't know if it's enough to have the separate accounts, but it's a good start to say, I have made my intentions clear when I invest with the intention of holding for longer, because I'm looking for their capital appreciation, which will be subject to CGT. I hold in this account, so that is a good intention. If you do happen to sell in that account within the 3 years, you can still argue and say, well, my intention was always to hold it for a longer period, but like any other investor, I didn't want to lose money. So then I sold within the 3 year period. But then again, it becomes a little bit tricky for you to prove, because you've got the section that has already been set out to say, if you've held a share for longer than 3 years, then presumption is it was for capital appreciation, therefore you can apply CGT. If you've held it for shorter, assumption is it was for normal trade, therefore apply your normal, what you would apply, your 28% or 27% going forward. So I think the safeguards that you've had, it's a right step. If SARS doesn't want to be difficult with you, they will find it acceptable. But if they're short of revenue, they may not.
Yeah, no, they might still come. They might still come knocking and audit it.
And the difficult thing is the onus is always on the taxpayer. So you, the investor, to prove that this was my intention. And that can be a difficult mountain to climb. But I think keeping all the information as possible, everything that you have to support your position would obviously help.
And that's a good point. This is often around keeping the data, keeping the pieces of paper, and you know, just good admin in essence, which is not something I enjoy, but it's critically important. Yeah. If I am, let's say I'm a short-term person, I never expect to hold anything more than maybe a year at most. Maybe I'm even derivatives, and it's less than a year, and I make profit. Can I offset costs against that income that I've made? Because this is now almost, I mean, I want to say in inverted commas, it's kind of like a business. It's kind of like maybe having, a fish and chip shop down the road.
Yeah.
I've got income, but then I've got a whole bunch of expenses that I can offset against that income.
Of course you can. So if you are actively involved in trade, if you are investing and whatever it is that is associated with that investing, you are so you buy, you sell, then you actively involve in trade. So you can offset the income that is associated with that trade against whatever you make from, I guess, whether it's an income or capital gains, whatever qualifies. So from a CGT perspective, what you would need to do, again, more admin. If you are incurring costs and you are investing in shares, holding them as a capital asset, some costs may qualify to be added on the base cost of your shares. So over and above what you incurred to acquire the shares. So again, you need to keep the evidence and you can capitalize those costs. So eventually when you do sell, then you would have a higher base cost, which would obviously reduce your profits or your CGT when you sell.
Okay, it comes back to record keeping, which
is difficult even for corporations.
Difficult's a polite way of putting it, I think. If I come back, you run a collective investment scheme. Tax is not your concern because, as I understand, you pass it all on to the unit holders.
Correct. So the investors are taxed in their own hands rather than in our hands, certainly.
And that is, I mean, there's a bunch of benefits to investing in collective investment schemes. One is that I can go and buy your fund and I hold it for the very, very long term. I'm going to get dividends. I'll pay tax on the dividends. But when I sell it in many, many years' time, I'll pay CGT. You can almost effectively trade within that environment.
Yeah. So in the back of that unit trust, we can do trading, we can do all sorts of things to try and generate the returns. But I think on the outside, as long as you haven't sold as an investor, there are no tax implications of those type of activities. Unlike what Kanyisha is talking about, where if you as an individual trade, you would actually incur some taxes there, right there. So you can delay the taxes in our case, where if you trade in via the unit trust.
Yeah. Okay. So two benefits, lower fees, perhaps. You were going to say?
So I wanted to just come in on the CSI. Something that in practice I find quite interesting is with a lot of CSI returns, they can be an investment that generates both dividends and interest.
Yes.
And even with larger corporations, there is that bit of struggle of maintaining the separate maintaining record of those separate positions, especially if you then reinvest, because whether you have paid the investor or not, if that income has been earned, if it accrues to the investor, it must be subject to tax in that year. So, and there's different tax implications for dividends and different tax implications for interest. So it's just something that it's...
Okay, that's a great point I hadn't actually thought of. And interest is an important rabbit hole we should quickly go down. Because, of course, we've talked about CGT, we've talked about income tax, we've talked around dividend withholding tax. But there's tax on interest as well. And there's the threshold, and if I remember correctly, it's 24,800 if I'm under 65 and 34,500 if I'm over 65. That amount of interest is exempt, and thereafter it is added to my income. So that would be money in the bank I've got. Perhaps I'm holding a retail savings bond or a money market type of product. REITs, of course, pay interest, and that gets added directly to my income and taxed accordingly. And there is no how long have you held it for. It arrives in a year and it's taxed in that year.
No, certainly, unless you've invested in those interest-free investments.
Sure.
Still, yeah, but generally, yes, it is taxed when it accrues to you.
Yeah, I was about to say that what Kanyisha is also talking about is that the unit trust companies have to also provide you with the difference between your dividends and your
interest component.
So those components need to be added to the tax.
That's a good point. I might get paid, let's take an example, a rand a unit, get a payout. To keep it easy, 90 cents as dividend, which will get taxed at a flat 20%. Yeah. The other 10 cents might actually be interest, which then is added to my income and declared at the end of the year.
Yes. And that's what they need for, as she says, I mean, you need to have records where the unit trust companies, and you can see even with the medical aid schemes, every Feb or beginning of March, they send you a statement to say, this is the interest that you earned in your savings account over this period. So that type of thing is quite important. I mean, the record keeping, again, that's the emphasis.
Yeah, record keeping. We keep on coming back to record keeping. Look, it's probably easier these days with computers and stuff than it was way, way, way back in the day. I want to come back to fees. We'll come back to tax in a moment, but fees, and I don't have the data on me, but we've all seen the chart where you've got an investment growing at X% over 2 decades, and the different fee levels. There's always a 0% fee, but there's never anyone charging 0% fees. You get the 1%, the 3%, the 5%. It really can have perhaps the biggest impact on the long-term return, a high fee fund, and two funds with similar returns, and one is maybe a 1% fee and one's a 2% fee, and you think to yourself, what's 1%? It can add up.
It does. I mean, I did the exercise before we came here, where I looked at if you put in R1 million into a investment product, and it returns 10% per annum, and the fees, you have a situation where one charges 0, the other one charges 1%. The difference at the end of the 20-year period, so you'll end up with about 6.7 million on the no fee situation, and probably 5.3, 5.4 on the fee, 1% fee situation. So you're going to give about 1.3 million rands in fees. So you're going to give that away. Yeah.
And that absolutely does it. And then it brings me to the question, and I don't know if my sort of thesis is perhaps sound, but in an environment, so hear me through. If we are in a lower inflation environment, and I'm an old enough person to remember the 90s when inflation was, high teens. I remember prime being 26% in 98 when we had the emerging market crisis.
Savings account then.
I bought a house then. It was the scariest thing I've ever did. But in those days we could, is it fair to say, conceivably expect perhaps better returns? And now we're in a lower inflation environment. And does that, if you're in a lower inflation environment, let's say inflation was 12% in the 90s, and in the 20s it's going to be only 4.5% because the governor's going to get it bang on the middle of the target. Would that therefore say, we're going to get a slightly lower return, and therefore the fees, a 1% fee or a 2% fee, has a bigger impact?
So I think it's a good point, but I also have to say, why would the returns be lower in that kind of environment? If you think about the capitalist system, there'll be money chasing the next highest return, right? And because of that, they're going to push the returns down, because as people earn income and there's, let's say, pension fund, and we all flooding the money in, the next best return will be lower and lower and lower. And that's what's bringing the returns down. But if you think about that kind of situation, you will end up with fees becoming a bigger component of your income, and therefore your net would be significantly lower.
Rodney, I'm going to come to your question in a moment because I've got that on my list for Zalaki, so we certainly will get to it. Can you see if I can come back to you? Is there, as an individual, the question I get asked often, so we all open our first account for investing and we do it in our personal capacity, and then at some point someone's like, should I do this in a company, in a PTY? Should I do this in a trust? And my argument is always no, and let's be clear, I'm the novice. And my argument is, A, it's expensive and cumbersome, but also my sense is that if there were these giant loopholes that existed, SARS would have closed them by now.
So from a trust perspective, yes. I think the benefits of investing in a company, obviously if you have intentions of growing your portfolio, would be very obvious when your your tax rate is much lower. So it's going to be 27% compared to what would be possibly 45% on the individual. So if you're not intending on taking that money out, so then we're not going to take into account the effect of the dividends tax if you are withdrawing money out of the company, then it's better just on those facts alone. So I would say, but I don't think there's any benefit on creating a trust. I think that becomes, it's the same because the tax rate is the same. And it's also easier in a company on the record keeping question. If you have a company, it's easier to have clear intention. It's easier to also keep record related to expenses. If you're doing it as an individual, if you're printing or whatever else you're doing, then SARS requires a lot more out of an individual to support deducting expenses from income that you're earning from a business. So I think if you're running a business, if you're just investing as a hobby, keep it on a personal capacity. If you want to create, or you want to create a trade, some kind of trade, it's a lot better in a company.
Yeah, I take the point, and that's maybe why the Christo Visas of the world don't do it in their personal capacity.
Yeah.
And if I'm hearing what you're saying correctly, is the company's 27%. My personal tax, let's assume I'm the rich person out there, is 45% potentially.
Yeah.
Ultimately, I've got to get the money out of that company, and that closes the loophole. But while I leave the money in the company, I get the benefit. I'm almost getting a interest-free loan from SARS.
Yes, we can certainly say that, or you're getting an interest-free loan from all the other individuals who invest in their personal capacity. Because that's why, if you look at the stats, if you look at the stats from a revenue collections perspective, individual taxes are the highest. And part of the reason is exactly that. Whatever you've earned this year, you pay tax on it. In a company, yes, you pay tax on whatever you've earned, but at 27%. The tax gets higher if you, as an individual, take it out. And individuals do not have that simple benefit.
I got you. And then I know a bunch of the viewers out there are thinking, brilliant. I'm going to set up a PTY because you go to SIPSA these days, and I did it a few months ago. It took minutes. No, it literally, from start to finish, I had everything. The thing that took a long time was the bank account. But the SARS number, everything, literally the whole process was 20 minutes. Transferring my existing assets into that PTY, I've got to put a peg in the ground at a price. And let's say I bought it at 10 Rand and I'm transferring at 20 Rand, I'm going to have to pay tax on that gain, am I not?
Of course you are. And it's not only what you decided must be. So the question is, what is the market value of this asset at the date when you decide to transfer? So then on the date, generally, there would be CGT. But not all is lost. So there are group provisions that do allow companies or an individual to, so if you're not trading outside, so you want to sell assets to your own company, so you can apply the group provisions and you can sell deferring the CGT. So you won't have, on the date of transfer, pay the taxes associated with that sale. If you say I'm doing it in terms of Section 42 or in terms of Section 45.
That is so sneaky. That is so sneaky. No, not sneaky. It's totally legit. That's so clever, I think, is the phrase we're looking at. So like we've already said, that you, within the CIS, tax is not your issue. But speaking to the private investors out there, one of the things I was always taught is don't make financial decisions based on tax implications. Just pay the tax. If it's time to sell a share, it's time to sell that share. That's a fair point. I mean, you might have to pay tax on it, but if you're paying tax, it's, you know, my accountant always says, you pay tax, Simon? It's because you make money.
Yeah, that's true. That's true. I think if you delay the decision making purely because you want to avoid tax or minimize tax, I think you could end up with a disaster because you might have a capital loss on the underlying asset, especially if it's shares and it's a time when markets are volatile like where we are now. So I wouldn't avoid paying tax. If I've locked in a profit and the environment is deteriorating, I'd certainly pay tax and rather protect that capital. And if it's in a vehicle, as she says, and if you put it in a company, you haven't taken it out, so you can basically still keep the gain in there and reinvest when the environment is right.
Yeah, okay. And I know someone, and they're way smart, they're on Twitter, I won't name them, Transaction Capital, bought it in the pandemic lows, went to $50, they're 300% up, and they don't sell because of tax, and now, so always the point. I want to come to Rodney's question. He's saying relatively new to the investing game, and asking what sort of different fees that we would see in terms of, so the fees would be, obviously there is a base fund fee, and let's call that 1%. There might be an advisor fee who puts you into that, and that is between you and your advisor. You as a fund manager have got no relationship with that whatsoever, and I can negotiate that with my advisor.
Yes. And then you may find, depending on the vehicle, I mean, you may be charged an administration fee if it's a fund of funds, for example. So you're going to end up with 3 layers where if you went directly to a fund manager, you might avoid that. But the assumption is that you'd get a benefit from getting advice. The advisor would be unbiased and look at what is in your best interest that way. Whereas if you come to me, everything that I offer is in your best interest.
No, of course. But that's a great point around advisors. And in fact, we've got a whole session later this afternoon around advisors. Is a lot of people are like, I'm paying that advisor a lot of money. Sure, maybe you are. The question is, are you getting quality advice for them? I mean, let's take another example. If I need open heart surgery, I don't want the cheap dog. I want the best surgeon that's out there. He or she, I don't care. I want the best surgeon. we don't quibble price. Suddenly financial advice, we're like, can I have somebody cheap? You can, but it might come cheap. What about performance fees then as well? There will be, so not everyone will charge a performance fee, and there will usually be a hurdle, a benchmark. We've got to beat the all-share index, or perhaps it's a blend, perhaps it's an offshore, and above that there will be a performance fee on that as well.
So I personally don't believe in performance fees.
Me and you both. I didn't know, so I didn't want to say anything, but if you're on my board...
But certainly, I think it is, to some extent, if you look at how the performance fees structures are set up, oftentimes the fund manager benefits on the upside, right? When they underperform, they don't lose anything, right? They've got a minimum fee that they will charge at any given point in time, whether they're doing well or not doing well. So there's only upside for them from a performance fee point of view. So if there is a cyclical environment that favors their approach to investment, they're going to charge performance fees and they'll bank the performance fees. When the environment suits, they'll basically, you lose out. And I don't think it's the right thing. I think there has been a perception that you need to incentivize the fund manager to perform. But I also think that, it's your money, right? So why must I double dip in your money? So you pay me to deliver the best service as I can. And if I'm not good enough, fire me. But to have a situation where when I'm doing well, I benefit twice. When I'm doing badly, I still benefit on one side on base fee, and then you lose out on the performance fees. I don't think it's fair.
You speak my language. And also, if you're a good fund manager and you grow your fund 20%, well, your fees go on 20% up because you've got more ORM.
Correct.
And you're going to be in the front page of Moneyweb, and people are going to flock. I mean, you're going to win raging bulls, and everything will happen.
Absolutely. I think to some extent the performance fees can be considered unethical, because how do you double dip like that? I mean, it's quite a substantial fee. If you look at the amount of fees sometimes that when people do well, they take a substantial amount, and then when the very next year things fall apart, they bank the fee and they're not returning any back.
They've still got the Ferrari.
Yeah.
So then I'm going to ask you the question, because I agree 100% with what you're saying there. What's a fair fee? I could phrase it another way. What do you charge? Because I'm assuming you charge a fair fee, right?
Yeah, we do. I mean, we charge 85 basis points on a retail fund. And in the institutional, I mean, for example, in global,
is that excluding VAT? Including VAT?
No, excluding VAT.
Okay.
Yeah. So if you look at the global strategies that are available in the country, the guys charge an arm and a leg for a global product. We're charging, including administration and everything, 85 basis points. So
that's a good fee.
If you're an institutional investor, you'd probably get away with 60 basis points. And at 60 basis points, you'd find that there are some fund managers, local fund managers for local funds that are charging more than 60 basis points. We do it at a global level. So I think it's reasonable.
No, 85 is a good fee. It could have been awkward if you'd said 300. Fortunately, you didn't. A question coming from Lorato. Tax implications when investing for kids. An account in the minor's name. So, for example, your child is, 8 years old, and you buy them ETFs or collective investments. Who pays the tax on that? Because, does the kid, because they're not submitting a tax return.
They should if they have assets. So
okay, no, fair point.
So tax, people say things that are certain in life, death and taxes. So yeah, as long as you're alive and you have assets, you do need to pay tax. So if you are investing on behalf of your kids, then you also need to consider from your end that you're donating some funds. So there's donations tax. So there's tax implications for you. There may be exemptions, obviously, for a minor child. So on your part, donating as a parent, maybe. But then there definitely is anyone that has assets, you should be registered for tax. You must pay tax. And you may qualify for certain exemptions depending on your age. SARS has not incorporated exemptions for minors. There are exemptions for senior citizens.
Yes.
So.
Yes. Okay, and donations tax, if I recall correctly, first 100, so between spouses, no donations tax. But if I donate, if I decide to give you each 100,000, the limit is 100,000 a year, and then above that, I pay, as the donatee, I pay 20%.
Yeah, so I'll agree with the 20%. I haven't looked at donations tax recently, but I think what you're saying may very well be the case.
The point then, and I know we all laugh, but I think you're right. If a miner has an asset, they should have a tax account, or they should be registered for tax. It's not going to be a complex return. Look, if it is a complex return, then they're rich enough, they can also have an accountant.
Yes.
It's going to be a moderately simple thing, and why not just keep it clean? Because I know, for example, my sister, so I donate money to my sister, who I then buy ETFs for her two children instead of birthday presents, and she's paying the tax on it. And, you know, it's fine at this point and stuff, but why not actually just say, well, donate direct to them, give them tax numbers. It's not going to be a complex return. They haven't got income. They've maybe got a few, a bit of interest income coming in. Truthfully, it won't hit the thresholds.
Yeah, exactly. And I think they also get bragging rights because...
I think so too.
We might
be nerds. We might be nerds. Some of those kids might not get the bragging rights. But okay, so some bragging rights there. I like that absolutely. Should we see different fees offshore versus local? You mentioned that a moment ago. I mean, in one sense, offshore is perhaps cheaper at the exchange level. I'm not sure about that, but maybe it is. But the other side is, again, it's expertise. I mean, should we see a difference between an offshore and a local fund?
I think you should. I think there's huge complexity in investing offshore. Firstly, from a geographic point of view, here in the local market, you already have South Africa. That's the only geography you have. And offshore, you have to have a blend of geographies to firstly diversify your fund. Secondly, you have to have a blend of sectors. In South Africa, I mean, our sectors are very highly concentrated. Yeah. You take out the resources out of our markets, take out resources in Naspers.
Richmond, you got hardly anything left.
I mean, you've got nothing left. But in the offshore market, the individual stocks are smaller, and you have a lot more different sectors. For example, we don't have memory card industry here. In the US, you'll find those type of industries. The point is, your selection process would have to be a lot more robust to pick the right sector, the right geography, the right stocks. Whereas here, if you pick the right stock and the right sector, you probably okay. So I do think that you do need to have a differentiator between the two, but should it be 100 basis points above? I don't think so.
But I take your point. I mean, I always used to say that the US has, half a dozen or a dozen pizza companies listed. We used to have one, and that was Taste Holdings, and now they sell jewelry, so things have absolutely changed. Can you see, we've been talking local, to keep it nice and simple. Offshore gets complex. I had an entire session earlier this morning around offshore, particularly around estate more than anything else. But as soon as we start to invest offshore, tax does become more complicated because SARS still wants their slice.
Yeah, they do. So as a South African resident, as long as you remain a resident, you still are accountable to the South African, to SARS for your global income. But so I think what makes it complicated is obviously there are double tax agreements if wherever you're investing, there is a DTA between South Africa and that country. So you may not necessarily be taxed twice on that income, but you're still required to submit your tax return in South Africa. It gets a little bit complex if wherever you're investing, there is no DTA between South Africa and that country, because South Africa will want their income, because you are a South African resident, and the other country who also want to tax you on the same income based on their rules. So in that case, there are provisions in the Income Tax Act where you can claim, but you must first pay or submit your return, and you can claim a rebate on whatever taxes you have paid offshore.
Okay.
But that rebate is limited to the tax you would have paid in South Africa. But you can still say you're in luck because we do have one of the highest tax rates. So, and I don't know wherever you're investing, so you're not likely going to be denied that rebate in South Africa.
Okay, I was not aware of that. Okay, so if there isn't a DTA, a double tax agreement, I can claim it back. Again, process, again, record keeping, but yes. I'm not going to necessarily pay tax, essentially pay it twice.
No, you should not necessarily pay it twice. Okay. So one of the issues that we actually see a lot of people leave South Africa for years and you live in the US, you earn income there, you have kids there, you've never financially immigrated in South Africa, and you still come back here now and then, you don't submit a tax return in South Africa because you live abroad. you're non-compliant in South Africa for tax because every year you must be submitting your tax return and paying, if there's any taxes due to the South African government, paying that tax in South Africa.
We also have a couple of tax incentives, in a sense, in South Africa to help us save. I mentioned the interest exemptions a moment ago. We've got the Regulation 28 products, 27.5% or 350,000, whichever is smaller, is deductible. We've got the tax-free accounts where that's post-tax money, but at the end, when you take it out, you don't pay tax and you don't pay dividend tax in the meantime. My sense is always, as a smart taxpayer, you should maximize that to the best you can, because this is, every February, the finance minister, whichever one it might be at this point in time, stands up and basically takes money out of our pocket. I mean, in a polite way, but that's what they're doing. This is them putting a little bit more money into our pocket.
Yeah, certainly, I agree with you. So you should, if you can, maximize it as far as possible.
What about, we'd be talking sort of equities and the like. Does it get more complex if I own a property overseas, for example, or is that just going to be treated broadly the same? There's income from it. Let's assume it's a double tax agreement, so let's say it's America. So America won't tax me. I'm then going to get taxed in South Africa, albeit I'll be earning dollars and I need to pay the tax in ZAR.
So it's exactly the same principle. Your income, your property, if it's generating rental income, you look at it the same way. What does the DTA say? Is it America that has a right of tax? It's likely going to be America, it being physical property in America. So then in South Africa, when you're doing your tax returns, the evidence is you do have the property, but in terms of the right of tax, that is tax in America. So then in South Africa, you will not include it because it is, in terms of the TTA, it's subject to tax in America.
Do we have double tax agreements with most of the developed markets out there?
We do.
I'm not asking you to name them all, but broadly most of them.
I think with most countries that South Africa does most trade with, we have DTAs.
I'd have to go find a really weird little country somewhere in an atlas that no one's heard of.
Yes, or some of the interesting tax havens. Obviously, we wouldn't have.
They call them tax jurisdictions, I learned earlier today. I was wondering what this tax jurisdiction... I get it. Zwaki, you kicked off right up front where essentially you were saying the fee is to pay for the skill of you and your team. And again, I go back to when I go to a doctor, I might think they're expensive and stuff, but I'm not going to go find the cheapest in it. I mean, the fee actually does pay for something.
It does. I mean, to set up a team and set up the infrastructure to be able to know what happened in America last night, and that costs money. So you have to pay for it, and you're rendering a service, and your hope is that as you gain scale, you'll become profitable, and as an entrepreneur, you can make money out of that. But I think there is definitely a minimum fee that will always go and pay for fees. I mean, if I look at, for example, in the administration fees that we pay offshore, you're probably paying 13 basis points away. As a fund manager, say this is between the CIS and the administration. So there is a cost to actually rendering that service. But is it 300 basis points? No. It's significantly less.
That's somebody who's buying yachts in the Cayman Islands, right? I mean, I got nothing against yachts in the Cayman Islands. Just if I've paid for it, I then wish to use it. And it comes to the point. And yeah, again, people will squeak around fees. And let's park performance fees and say that in this world they don't exist, because I agree. I think Immoral is about exactly spot on with it. We need to pay that fee. We're getting the services for it. And we also, in this day and age, have the options. And that option is passive if we want to. I mean, and I advocate my portfolio is structured. I've got a nice passive in the middle, nice and cheap, and then I put my active around it and sort of manage that and pay the fees for it.
I think that's a very good strategy. I think the perception that passive has to exist at the expense, at the total expense of active is a big mistake. And I'll give you an example where, for example, if you had an ETF that was invested in technology last year, basically you'd have lost probably 23% now. So that is because you have no option to maneuver and say, okay, I can see that we're going to hit a wall, and I need to get out of this. But your strategy of having the passive at the core and then having the satellites in terms of whatever strategy you're trying to achieve, I think it's a very, very good strategy because it enables you to say, if, let's say, the passive loses money because it's heavy into the tech sector, you may be underweight the tech sector on one side, and you'd be able to offset some of the losses here with this gain that you're making here. So that strategy can give you like a nice, smooth ride, rather than just one is good. I mean, the fund managers as well, active managers, also get things wrong, right? So
Sure.
if you're a fund manager, you invest in transaction capital, you're hurting at the moment, and your clients are hurting. So the passive can give you the benefit of a diversified portfolio. So each stock is not so highly concentrated in the portfolio.
Lower concentration. I'll take you on that. So earlier this morning when I was talking, I said there's two certainties in life, it's death and taxes. We're going to add a third to it, death, taxes and fees. Fees aren't terrible, but be cognizant. I mean, interrogate them. And if you don't like the fee, it's really simple. Just walk away. You don't have to pay it. There are other products out there. We're going to leave it there. A huge thanks to my guests. Taxes and fees can be fun. Zweleke Mguni, Chief Investment Officer, co-founder of Benguela Capital. Kanyisa Ngoganda, Head of Tax Services at S&G Grant Thornton. Really appreciate your insights, both of you.
We are not capital. It sounds like we are a tax jurisdiction. Benguela Global Fund Managers.
Benguela Fund Managers, my bad. Sorry, that was
the minute you say capital, it sounds like a tax jurisdiction.
Benguela Fund Managers. We'll be back in 5 minutes. Kieran Ryan, talking crypto.
African Bank released its annual results earlier today. CEO Kennedy Bungani will be joining us to talk through the financials. Tune into the SAFM Market Update tonight from 6 to 7 p.m. as we unpack the day's business and investment news. You can live stream and download the latest podcasts on moneyweb.coza or via the app. Brought to you by APSA, the bravery to imagine. That's Africanacity.
Moneyweb, your trusted source for business and investment insights.
That South Africa has myriad problems on all fronts, I think, is a given. Criticism, grandstanding, and point scoring really is a national sport. Noise is, though, the essence of democracy. But the time has also come for us to collegially and with level heads start to look for real solutions from all sectors of society. And that is the idea, the premise behind Moneyweb's new podcast series. It's called Fix SA. I'm Jeremy Maggs, and I've been in the business of talking to and interviewing people for years and years. And this podcast is going to offer tough conversations around South Africa's national problems, spanning service delivery, governance, social cohesion, and the economy, and a whole lot more. But here's the difference. Our intention is to interrogate creative ideas and workable solutions on how South Africans can navigate and ultimately solve problems, drawing on the insights of South Africa's top business leaders. Starting in early November, you can download episodes every second Friday on moneyweb.co.za, the Moneyweb app, Apple Podcasts and Spotify, or follow Moneyweb News on social media for more updates. I'm really looking forward to you being part of Fix SA. Moneyweb, your trusted source for business and investment insights.
Crypto, what is it good for? Should you own some? Should you avoid it altogether? Or should you wait a few years to see what happens in the space? Bitcoin has surprised everyone again, surging more than 60% since the beginning of the year. This reminds us that Bitcoin was, is, and will likely remain volatile for some time. But you cannot ignore it, since so much of the world's financial future is being built around blockchain technologies that are decentralized and censorship resistant. And what these exactly mean, these terms, we're going to get into in a minute. Some astonishing use cases for cryptos and blockchain technologies are being developed. For example, you can now load your health data onto the blockchain so that you don't have to fill out forms every time you visit a doctor or a hospital.
That's just one side of it. Decentralized finance is another, and that's the buying and selling of assets without an intermediary. You can make loans, you can extend loans, you can earn interest. But you may be surprised to learn that ordinary businesses are finding some incredible use cases for crypto. Buying US dollar-backed stablecoins as a way to hedge themselves against local currency weakness. Well, we're going to look into this, and we're joined today by Omar Iqbal, who is CEO of 5 West, to discuss this in more detail. Welcome, Omar.
Thank you. Happy to be on. Good to
let me just give you a little bit of a bio as to who you are. Omar has a degree in financial management from the University of Joburg. He's got a degree in finance from the University of Stellenbosch. That's 2 degrees so far, right? Yeah. His entire working career has been spent in the financial industry. He previously worked at Invictus Capital, Fed Group, and Nolan's, which is an auditing firm. So you're an auditor?
Yeah, I used to be one.
Trained auditor?
No, not really.
Okay.
I was trying to become one, but then I've found that I loved investments way more.
How did you get into cryptos?
So my first experience was obviously investing myself for years and years and just studying the markets and stuff. But then after that, Invictus Capital was a good way to get a grip of the market, and I learned a lot from my years of working there. So I think it was a good learning curve and a good way to enter crypto.
How did you enter crypto? Did you buy some Bitcoin?
I bought some Bitcoin back in the day.
Okay. How far back was that?
2014.
2014.
Yeah.
Good price.
Yeah,
do you remember how much you paid?
I can't remember really, but it was cheap.
A few thousand
rand.
Wow.
Yeah.
You still got them?
No.
No? You sold them?
Spent both of them.
Okay. All right, so let's talk about crypto adoption. I mean, the stats for this are kind of all over the place, right? Some figures suggesting there's about 300 million people around the world who own or have owned crypto at some time or another. I think the problem it still has, a lot of people can't stomach the volatility. We've seen since 2021, the drop was about 70%, then it's up 60%. Yeah. So what's your advice to people?
Look, well, no advice, but the way I view it is essentially crypto should be viewed as a long-term bet, if I may say, because in the short term, it's more dependent on what the retail market thinks about it. And the retail market is usually, it's filled with fear, I'd say, in most times. So if there's any bad news or any negative news in the market, the price drops, everyone tries to sell their coins, and then at the end of the day, it's not really a real feel of what the market's trying to do. It's just the retail clients that are trying to just offload everything, and that's why you see these 60-70% drops and 60-70% volatility, if I may say. But I think it needs to be viewed more as a long-term bet and a diversification tool. So it's like the same as you investing in stocks over the years. It needs to be viewed as a long-term asset and an asset class and a financial product. So I know SARS or South Africa recently included it as a financial product. So it needs to be viewed as that, and you need to actually leave it for a few years and then see where it takes you. Because anything like with short-term investing, you can have highs and you can have lows. So I think that brings increased volatility. But when you talk about institutions, they actually hold the product for a long period of time. So the price drops and the price increases doesn't really affect them because they're holding on and selling in, let's say, in the year 2030, when the price is a lot higher, as been predicted by a lot of different players in the market, that it is going to be mass adoption in the market. And that's when you'll see the real bull run happening, and that's when you want to offload it.
Yeah, it is pretty surprising. I mean, that Bitcoin since the beginning of this year is up 60%. And that, of course, has got something to do with loss of faith in the banking system. Well, what do you see now? There has been a drop, by the way, in recent days, partly because there's a legal suit in the United States against Binance.
Yes.
But what is your take on this? It's very odd, to my way of thinking, that Bitcoin would rally on a crisis in the banking sector.
Yeah, look, I think it's more people losing faith in the banking system. So recently, I was reading an article which said that the people are wanting to stop deposits into smaller banks in the US. And with the regulators just increasing rates all the time, I think it gives a lot of people hope that crypto is actually going to be the future currency of the world, and that's how it's going to go. So I think if the US keeps raising their rates and people are losing faith in the banking system with the whole Silvergate Bank, Silicon Valley Bank, all going down overnight. And then a lot more banks that are being affected, the smaller banks, because people are losing faith in it. So where do you keep your money? So you're not going to withdraw all of it and keep it under your pillow. So people want to now find a diversification tool, which is now cryptos. And I think that's where the stable coins comes into play, because you essentially are controlling, you're the owner of your own money, you're controlling your own money, so you're custodying your own money, and I think that's a huge thing. So you're not putting all your faith or all your eggs in one basket and giving it to a bank to custody. Now you can custody it yourself on a ledger or on a hot wallet, as we may say. So I think that's where the world's trying to shift to, especially with the huge banking crisis that we have on hand. I think crypto adoption and more realistically, I think stablecoin adoption is going to increase over the few coming years now.
All right, so that was my next question, is about stablecoins, because that is the real use case that has grown. It's Bitcoin and it's stablecoins.
Yeah.
That's the two stories. And stablecoins, of the top 20 by market cap, measured by market cap, the top 20 biggest, the top 5 biggest are stablecoins.
Yeah.
So that would be your Tether, that would be your USDC, it would be Binance USD, and there's a couple of others in there.
Yeah.
But what is happening? Why is this now? Let's just define, first of all, what a stablecoin is.
So a stablecoin, if you really think about what a stablecoin is, like fiat money, because it's backed one-to-one with fiat currency. So at the end of the day, principle would be 1 USDT or 1 USDC is equal to $1, because essentially there are bank deposits that match the stablecoin. So any amount of stablecoin that are minted needs to be in principle based on how much deposits you made into a bank account. So it's just a way, it's just like you have 10 Rand in your wallet, you hold, let's say, 10 RUSDC, or I don't know how to say it, but $10 in your wallet.
And of course, there's a Rand stablecoin, or there's a few of them.
Yeah.
And there's a Euro stablecoin, and there's many different stablecoins.
Correct, yeah, but it should be matched one-to-one with the bank deposits. So you need to, so that's what a stablecoin is. It's just essentially you holding money in a bank account, but now you're holding money in a wallet. So it's a different way of just having where your money is.
Right. Now, of course, the interesting thing about a dollar-backed stablecoin is that it can be traded and spent completely outside the banking system.
Correct, yeah.
It needs, there's no regulator can stop it. So you can have a stable coin, you can convert some of your profits from Bitcoin into a stable coin, and then you can spend that. So I want you to talk a little bit about the use cases that you've come across, or that you've developed actually at 5 West for US dollar-backed stable coins.
So if you really think about it, there's a few ways to look at this. So when stablecoins first gained popularity, it was people trading, let's say, Bitcoin, and they wanted an off-ramp. So usually it was US dollars, then they'd withdraw it, money goes into your bank account, and then you can spend it. And then let's say people didn't want to hold their money on exchanges, so they'd have to withdraw it. Then you'd have to redeposit into the exchange for you to buy more Bitcoin if you were playing the price, etc. So it was just a quick off-ramp for people. So, okay, go into Bitcoin, I want to sell it into USDT, and then your USDT is sitting there in the wallet. Transactions are quick, so you can withdraw it, you can self-custody your funds, and then now your money's back on an exchange if you want to buy the next day. With traditional banking, it wasn't possible because there were lots of time delays, etc., which would affect the price. So if I want to, let's say, go withdraw my money now, and I want to reinvest tomorrow, there's sometimes the SWIFT system has delays, so it can take 3 to 5 days for you to get your money onto an exchange, in which case you've lost that entire margin or the time it takes you to get the deposit on. You're now sitting there with a huge price risk, because now you wanted to buy it, let's say 20,000, but now the price is at 22,000. So you've actually essentially lost out on that $2,000 gain. So that's where it gained its popularity, I'd say. But I think the use cases would be for you to be able to spend your crypto. So you could have, let's say, merchants in South Africa accepting crypto. So it would be another way of you to, it's like a crypto payment gateway. So it's like a payment gateway like your instant TFT, like your credit card, where you just swipe your QR code, or it gives you a QR code. You send your tokens, and then you buy something on, let's say, Takealot. So that would be a great use case, because then everything's recorded. The customer's recorded on Takealot side as to who's buying it. You KYC the customer yourself, and then that's how the customer can now spend their crypto easily. And it works out really well. So when Bitcoin pumped 20% over the last few weeks, people wanted to offload that into and actually buy products with it. So I think Pick n Pay has done a great job. It's a fit in the market for people who want to spend their crypto. But I think a large number of retailers are going to start using it across South Africa, and I think across the world, really. There are a few companies doing it already. I know a company based in Singapore, AAA, They've tested this model and it's working wonders. So I think that's a good use case of people to be able to offload their crypto at any given point in time and still being able to spend it to buy whatever they want to, so laptop or computer screen.
Let's just break this down into practical steps here. So there's somebody, let's say, who's got some Bitcoin sitting on Luno.
Yeah.
It's sitting in a wallet there, wants to buy something on Takealot. What do they do?
So it'll be the same way. So you'd have to check out. So now you get a few options: instant EFT, direct, whatever, cash and delivery, credit card, and then the fourth option would be pay with crypto. So then you go click that, it'll develop a QR code for you, and a wallet address. So if you don't have Luno on your phone, you can copy the wallet address, put it into Luno, and then the withdrawal happens. Then once that happens, you'd hedge the crypto. So as 5 West, our crypto payment gateway, would hedge the crypto out into rands. So Takealot gets the exact same value that they would have using instant EFT, just with less fees. So the fees will be about 0.5% compared to instant EFT, which is a lot higher, and credit cards, which is even higher than the instant EFT option. So firstly, the merchant saving on costs, and essentially they're getting exactly the same end value as they would have using any other method. And then this is all recorded on both our side and Takealot side, so it's important to know who the client was who was spending their crypto. So it's not circumventing exchange controls. It's actually essentially still being recorded. It just gives you a quicker way to spend your crypto because you want to take advantage of the price when it's a lot higher.
And your payment gateway is called what?
Blockshop.
Blockshop.
Yeah.
Blockshop.
Correct, yeah. So
Right.
that's just our testing method now. And we now want to start going into merchants and start integrating that into a few retailers, and then want to give it a good go, because I think it's a good method. It's a good way to actually spend your crypto, and it's a good way for you to be able to spend it when the price is high. Because usually what happens is, again, I was talking about the banking system. You sell it, takes time for you to withdraw the money, and then you resend it to let's say Takealot. But in that time, there's a lot of time lag. And sometimes what we see, and if you do some research, it's a lot of impulse buying that happens at night, right? So if the price is up, I come home from work, I want to be able to spend my crypto straight away. If I see something, I want to buy that TV there, I want to be able to buy it right now and then. And in 2 days' time, I'm over it. So it helps with the merchants actually getting more sales, and also helps me taking advantage of the price. So it's actually a win-win.
So my question is, if I wanted to buy something on Takealot and my crypto was sitting on Luno, do I need Blockshop to do that, or can I do it directly with?
So you can do it directly. Blockshop is just for us. We just have a testing model there just to test the system out. But we want to be able to integrate exactly how an instant TFT company would integrate onto Takealot. We want to be able to integrate with all the merchants and just have it as a payment method. And then it develops or generates a QR code, which is obviously generated on our back end. And then the client can just interact directly with the merchant side itself.
So what are the advantages of dealing it through you rather than going direct to Takealot?
Because Takealot, so then they'd have to sit on the crypto, so they're then vulnerable to the price movement. Whereas with us, we'd hedge it out and pay Takealot, let's say 1,000 Rand, we'd pay them out 1,000 Rand, take the client crypto, convert it, and then resell it at using our OTC desk or using local exchanges.
Okay, just a couple of house notes here. The full agenda and speaker list, they're available on the Moneyweb website. And you can also view all of these presentations today on the Moneyweb YouTube channel. You got any questions, send them to events@moneyweb.coza. That's events@moneyweb.coza. Okay, so I want to talk now about another aspect of stable currencies which has been in the news quite a bit recently, and that is the collateral side of things. So you're saying that these stable coins like USDC and USDT are backed one-to-one with dollars. Yeah. Now, there's been a lot of press, and there's actually been some regulatory pressure for these companies that issue these stable coins like Circle to prove it. I think Circle is probably one of the most transparent. I think Tether there's been some questions about its transparency.
Correct, yeah.
In the last couple of weeks, we've seen a depegging. In fact, USDC went down to 80 cents to the US dollar, and a lot of people saw that as a trade. So they were buying effectively $1 at 80 cents to the dollar. Great trade.
Yeah.
It very quickly corrected over the weekend. But so talk about that and the danger of this, because we saw last year Terra Luna, which was a different breed of animal altogether. That was an algorithmic stable coin that collapsed completely. Yeah. So people might be suspicious that this is going to happen again?
Yeah, so firstly, there's a massive difference between algorithmic stablecoins and currency-backed stablecoins. So I think that's what's important to understand. I've never been a fan of algorithmic stablecoins myself because it's like a game. So it's easily manipulated. The guys who are in control of it can manipulate that the way they want it to go. And I think that's the major problem with an algorithmic stablecoin. So when I say stablecoins, I mean more a stablecoin that's been backed by reserves. And I think Circle, like you said, is one of the best in the industry when it comes to that. But also, if you really think about it, the 80 cents to $1 thing you were talking about, that was sparked by them not having 5% reserve, or 5% of their reserves were in SVB, which is
Silicon Valley Bank. Yeah.
So when that happened, if you think about it,
that was frozen.
And that was frozen. So essentially, at the end of the day, a 20% discount was a great buy because they only lost 5% of their reserves. So if I was thinking correctly, it would have to either stabilize to at least 95% for it to make sense, right? Because how can you make sense of a 20% drop when only 5% of your funds are being seized? Oh, not seized, sorry, frozen.
Yeah.
So at the end of the day, that was a good buy, and it was sparked by the retail market, I'd say, because it was over the weekend. So it was fear in the market, and people thought it's going to be a same Terra Luna situation where overnight they're going to lose all their value, and now they're going to be sitting with a massive issue, not having their funds. But also, I'd say that sparked kind of the bull run as well, because people had to now go into Bitcoin, into Ethereum, and to other altcoins. But I think most of the major market liquidity sits on Bitcoin and swaps between USDC and USDT. Because if you saw, USDT went up to 1.03 it was, and USDC was trading quite low at that time. So it was just the retail market, and I think it was it was a lot of fear in the market. I think also the fact that institutions were not open over the weekend. They were keeping an eye on it, but they weren't open. But I think any fund manager or any manager sitting with a lot of funds in USDC would have known that there's just retail market movement. And if you're getting a 20% discount, it's a good opportunity for you to buy. Because 80 cents to the dollar, why wouldn't you want to buy a dollar at 80 cents? I think that makes perfect sense. Yeah, even when it happened on Monday, I think it was already starting to correct itself. And I think it's pretty much back to parity now.
It's back to parity, yeah. Yeah, great trade. You know, you could buy a dollar for 80 cents.
Yeah.
And you could cash it in, selling into Tether for 103.
Look, it's like a black swan event.
Black swan event, yeah. Okay, let's just talk a little bit about CBDCs, central bank digital currencies. That's all the talk around the world at the moment. There have been some that have been introduced. China introduced its CBDC, I think around the time of the Olympics. Was that 2020 that happened?
I think it was 2020.
Complete failure. Yeah. Nigeria introduced its e-Naira last year, at the same time as restricting your ability to withdraw funds from the ATM. They nearly had riots and revolutions going on there. A complete failure. CBDCs, what's your view? Good thing or bad thing?
So look, there's two ways to look at it. So crypto and blockchain was developed to be a more decentralized way of transacting. Another financial infrastructure was going to be built around this. But if you give all the control back to governments, like you just mentioned, you couldn't withdraw more than X amount on Naira a day. So you're giving the control back to the governments itself, who've been completely ruining how financial infrastructure is working. I'm not saying every government has, but mostly you can just go print money like the US is doing. You can raise interest rates, and you can do what you want to do. So at the end of the day, having a centralized currency we'll follow the same exact steps that we've been doing over the years. So it defeats the purpose of having a decentralized currency, in my opinion. But it could be a good way if you're actually giving it or handing it over to the consumers itself, and they actually create utility and show you how to spend it. So that's why USDC and USDT is a good use case for them, because no government or no centralized institution is actually in control of it. The guys who are in control of it are the minters, and then it's the spenders or it's the users that they have. So at the end of the day, if implemented correctly, it could be a great way to do trades between countries. So Africa could actually work. But at the end of the day, if the government is controlling it, who's to say that we're not going to be sitting in the same boat 5 years down the line? Because like what Nigeria did, and it sparked huge crisis in that country, was how can you restrict me from withdrawing my own money from an ATM? I should have full right to my money at the end of the day. And who's the government to tell me how much I can spend in a given day? If I wanted to go buy a car, I can't do it now. So why must I have spending limits on what I can spend in a day? It doesn't make sense.
Yeah, I mean, I think a good example of the average Nigerian's attitude towards their local currency is seen in the Bitcoin market, where you have a premium. If you want to buy Bitcoin in Nigeria, people will pay a 30% premium.
Yeah, close
to acquire
45%
Bitcoin that you're going to get for 30% less here.
Yeah, no, so that's exactly it. So they've lost complete faith in their banking system. And what Nigeria is also, Nigerians are really irritated with the fact that obviously the Naira is losing value every day. So they're sitting there with a currency that is completely depreciating at the end of the day. And it's worth less. So I want to go buy a can of Coke, but now tomorrow I'm paying double the money I was paying the day before. So I think that's a huge concern. Also, the lack of US dollars in Nigeria is another reason that premium exists. I think that's a huge problem in the market currently, especially in Africa, where financial infrastructure isn't as strong. So even South Africa, we've got a good financial infrastructure. But in other African countries, we really don't. And I think the lack of US dollars also has a huge part to play when it comes to the price of Bitcoin and other cryptocurrencies, such as stable coins, actually being close to 45% it is today. That's insanity. So you're pretty much paying a 45% arb. Great trade if you're on the other side of it.
Okay, so you probably have to define what an arb is, arbitrage.
Yeah, so arbitrage is when you're paying the price. So you're buying, let's say, Bitcoin overseas, you're sending out of a bank. So you're sending $1 out of a bank and buying, let's say, 1 Bitcoin for argument's sake, but you're selling it for 1.05 in South Africa. You're creating a loop structure, and then you're using in South Africa what we call a single discretionary allowance of R1 million, and then a further FIA, which is a foreign investment allowance of a further 10 million rand. So the government allows you to send this money offshore. In South Africa, I'm talking. So you're actually creating a loop structure where you can earn returns in rands at the end of the day, just exploiting the arbitrage that exists between the Bitcoin premium, Bitcoin price overseas and with the Bitcoin premium by selling it here locally. So that's the arbitrage. But if you, let's say, a European client who wants to send money into Nigeria, and you can just do it by USDC, you're quickly making 45% on the trade, and now your expenses are lowered by 45% because you've essentially done the whole arb loop, and you can now spend the money into it, which is also really bad for the economy if you think about it, because people now want to transact in crypto rather than actually do a trusted currency, or not trusted currency anymore, but rather using the bank system where you'd actually create more US dollars at the end of the day. So now we're losing out on US dollars, and people are finding ways to get their money to where they want it to be, either selling it into the economy for a lot higher or taking it out of the economy for a lot higher gain.
Right, we're going to come back to the arbitrage in a minute. If you've got questions, send them, type them in on the YouTube chat box, or send them by email to events@moneyweb.coza. Question here from John. How do you think the current collapse in the banking system will affect Bitcoin or other cryptos in the short-term future?
Well, we've already seen it, right? The banking system collapsed recently, and the price of Bitcoin was shooting up. And I think it also depends not only on the banking system itself, but it also depends on the Feds itself. So if they keep raising interest rates, then we're going to see an absolute moon for Bitcoin, because it actually, at the end of the day, people are losing complete trust and faith in the banking system. And also smaller banks, like I mentioned before, if you're losing complete faith, you don't want to deposit money into a bank, you're rather sitting in stable coins, and then you're kind of playing the Bitcoin market and the crypto market. So I think with the banking system failure, I think more people are going to start getting into crypto, and you'll see mass adoption at the end of the day. I think that's where the market's going. So if it keeps going like this, I think mass adoption over the next few years, especially with the Bitcoin halving coming up in 2024, I think it'll be a good way. So if the governments don't fix the acts to control the banks itself, I think we'll see a lot more people there, because they'll, in my opinion,
just explain what the halving is.
So Bitcoin halving every year. So Bitcoin, there's only
every 4 years.
Every 4 years. So there's only a limited number of Bitcoins at the end of the day. I think it's 21 million in total. Yeah, 21 million in total. So with that halving, what we've experienced in the past is just price rises, because there's less amount of Bitcoin that is now left for to be minted, if I may say.
So it reduces the rate of issuance of
That's
Bitcoin
correct, yeah.
by half.
By half, yeah. So at the end of the day, soon not enough Bitcoin being minted, or not enough Bitcoin there in the market, so now that causes, it's the same as gold, where there's something that, there's a limited amount of supply for it, the price actually shoots up for you to be able to, because it becomes a commodity.
Right. Yeah, okay, so the other thing to bear in mind, I think, about stable coins, and the fact that you might have your coins residing on a wallet. Now, you mentioned earlier things like ledger. Ledger is a hardware wallet.
Yeah.
You have hot wallets. Hot wallet is something that's connected to the internet. Not a good idea. You really want a cold wallet that is disconnected from the internet. But there are these wallets that do exist. If you have your stable coins in a wallet, are you not effectively your own bank?
You are your own bank because you're self-custodying your funds at the end of the day. So if we have to think about it, if I'm sitting on $1 million in my cold wallet, in my ledger, I'm the custodian of those funds now. So with a bank, you're in no control. So as we saw with SVB and what happened to Circle's funds, 5% of their assets were sitting on the bank itself. And a lot of people actually had their money in a bank, whereas if they were with stable coins, you're your own custodian, you can spend it when you want to, and that's how you end up spending it. So you're in control of your own money. So if you lose the wallet and you don't have your key phrase or the whatever 14 word, 20 word a key phrase, you've lost your money. So at least it's in your own control. Because sometimes you can blame yourself for losing a wallet, but it was your own fault. But if someone else loses my money, I'm really pissed off at that person, right? At the end of the day, in which case it's a bank now. And a lot of people are losing faith. Like, people are stopping deposits in a US bank, and we thought it was a strong economy, strong banking system, and people are losing complete faith in the banking system. So it is time for people to self-custody their money at the end of the day.
Become your own bank, self-custody your own crypto, and hold some stable coins. Because, okay, now let's get into this. This is very interesting. This idea, you've been across Africa and you've been talking to companies they all face the same problem. That you spoke about the Naira. The Malawian kwacha devalued by 26%. I think it was 26% last year. The Naira, probably something similar, right?
Yeah.
Now, you come up with a solution for that using stablecoins. Explain that.
Yeah, so what it is, it's more of a treasury management tool that we want to give to companies. So how it works is, to give you a bit of background, like I said before, Africa doesn't have enough US dollar reserves. So at the end of the day, a company like Emirates, who works in Nigeria, can't actually take their money out of the country because there's not enough US dollars. And that's actually a real example, because Emirates had to lower the number of flights that were going into Nigeria because they actually just couldn't take the money out at the end of the day. So that's harming the economy firstly. That's not building Africa. It's actually breaking Africa, because not a lot of European and American companies now want to invest in a country or in a continent that it lacks US dollar reserves, because at the end of the day, you can't take your profits back out. You've got to leave it in, and then once you leave it in, it's devaluing all the time. Like you mentioned, Malawi, Nigeria, and it's huge examples across Africa. If you take most of Ghana, it's devaluing. Our currencies are devaluing. So another good example would be, if I want to price my stock in at R1, and over the next week, so I've signed this agreement with my client, and now he needs to pay me R1, but it cost me 80 cents to actually build the product. So I've got that 20-cent margin there to play with. But if the currency devalues, let's say for Malawi's example, 26%, I've already lost 6% on the trade. So it doesn't make sense for me to be holding local currency when I can't hedge out into a US dollar, into euros, or into GPB, wherever the firm's from. So it actually gives huge price risk to the company itself. So giving them an option to actually hedge themselves out in stable coins takes away that risk. So as soon as they price the client, they convert the money into a stable coin, hold it, and then when they want to pay out their staff members, pay for expenses, etc., now they can actually just use their US dollars or US stable coins and convert it back into the local currency on the given day when they want to make the payments, and they know exactly what's happened with their money. Because the trend we're following is African currencies actually devaluing daily, if you really think about it. I know in South Africa we've had a strong comeback from the 1840, 1850 mark recently, but it's just turned into a game, trading at 13 Rand last year, and now we're trading in the 18 levels. It's just a lot of movement in a currency which gives no faith to foreign investors.
So if you had done this, if you were a South African company, the Rand was at 13 to the dollar a year ago, if you'd shifted your reserves into a US dollar stablecoin, you would have saved yourself something like 40%.
Exactly, yeah. So that's what a lot of companies are trying to do now, is they're not trying to take the money offshore at the end of the day. So they're not trying to break the law and take the money offshore. All they're trying to do is hedge themselves against market movements. So this is already done using CFD platforms, right? So people go and they trade CFDs just to manage their risk.
Contracts for differences, which is a derivative instrument.
Yeah, correct. So they're already doing it, but it's very expensive for them to do it, and they're not in custody custody of their own funds. There's a lot of manipulation that goes on in the back end when you're actually using it with these CFD providers. So you never, and there's overnight funding. So if you hold the position out for, let's say, a month or two until that deal comes through, you're losing out so much on overnight funding. So with USDC, it's a quick transaction, quick to get the money back.
No holding, no overnight fees.
No overnight
CFDs,
fees.
I think, is about 6% per month.
Yeah.
Right.
So that's already, you've lost 6%. So at the end of the day, and then again, it brings me back to the point where you're self-custodying your own funds. So there's a lot of advantages for it, and that's what people in Africa and companies in Africa have started to see is a way of just actually hedging themselves against local market movement.
Right. I mean, just to come back to the CBDC thing, I wanted to bring to your attention, there was a number of companies have tried this. I mentioned China and I mentioned Nigeria, but Marshall Islands did one as well. And they built into the problem with the CBDC that a lot of people are pointing to is this programmable money. Now, Marshall Islands programmed into their CBDC, they have the US dollar, which they can also use as legal tender. It is a US protectorate. And they have this CBDC with 4% inflation programmed in. So it can never be expanded more than 4%. That's probably quite sensible to do that. But there's other problems with it, is that people are starting to see if you're issued a CBDC and you don't spend it in a certain time period, you can lose the money. So it's money with a limited shelf life. The other thing is it's programmable according to your compliance with various government laws. Not up to date with your taxes, you lose your CBDCs. You are voting for the wrong political party, you got the wrong skin color. You know, all of these things can disqualify you in a CBDC. What's your view on that?
Look, I think when it comes to inflation, I think it's a good way to do it, right? It's already programmed into it because there is inflation in the market. So it's already there in the banking system already. So if I have 100 Rand now and next year the inflation is 6%, I've already lost 6% of my value that I was holding in my bank account. So at the end of the day, that is a good way to do it. But like you said, it can be easily manipulated at the end of the day. And I think it's for them to define exactly what they can and cannot do before the token is issued. I think that would be a great way for people to be able to understand exactly what they can do and what they can't do with the token itself. Like you've mentioned, I think more to African or South African terms, the color of your skin or stuff like that. I think that, obviously, I don't think it comes into play when you're talking about CBDCs in general, but I think if you're not paying your taxes and if you're avoiding it, that's a good way for you to be getting your CBDCs taken away from you. But a good way would be for you to be issued CBDCs on a wallet that the government issues the person itself. So that would be a good way. It's also a good practice for anti-money laundering, I think, at the end of the day. So if you go to a shop and you want to swipe for something, you have that wallet address that you're going to be transacting with. And if you don't transact with that wallet, it brings up a red flag already. And if it's programmed right and if it's used in the right way, I think it could work. But what we've seen is if you give too much control, let's say to the Nigerian one, which is a complete failure, was the government trying to control everything and they were trying to control spending. And that's where it really fails, is because you're trying to control something that shouldn't be controlled by the government itself. It's with the consumer. So if you program inflation, you program not paying your tax and being taken out, or whatever tax you needed to pay being held back and you're not being allowed to spend it, I think that's a good way for the government and the local authorities to be able to have monitoring your systems and monitoring exactly what you're spending. And also tax avoidance is not a good thing because it doesn't help the economy grow at all. So those are good things. But if programmed right, I think it's a great idea. But if you're just going to be controlling it like you have been in the financial system, it just doesn't change anything.
So the stable coins are kind of, they were built on the blockchain. The central banks later came up and said, oh, that's a great idea. We'll do the same thing. We'll call it a CBDC. Yeah. It's a digital currency. But with stable coins, you have, I wouldn't say it's exactly private money, but it's kind of quasi-private money. It's a facsimile of the dollar or the rand or whatever the currency is. But it does give you some sort of protection. If you're in a badly regulated or a badly governed part of the world, you can opt for a currency, a stable coin, that has a better jurisdiction. It's quite a fascinating idea.
It's a fascinating idea. Look, and again, it brings you back to you being in control of your own money. So I think that's the most important point, is the self-custody aspect of it. Because it's not only in badly run or badly regulated countries. Like you've seen in America now with the banking collapse, people are opting not to have their money in a bank. So what's their next best option if they don't want to hold cash or if they don't want to buy stocks with it? They've got to keep it in something that's stable, which is nowadays it's cryptocurrencies. I know it fluctuates a bit, but that's also, it depends highly on the retail market and how they're viewing news and what comes out. It's more speculation that makes the price change. Also, people are usually trading between Bitcoin, which is the most liquid market, I'd say, in terms of stable coins. So as they get out of it, the more demand for people selling USDC and having USDC, the price might move, but it's small movements unless there's massive news in the market, like we saw with the USDC change recently. I think it's a great way to be in control of your own money. And then with Black Swan events, people want to be able to buy that quickly. So they're holding USDT, they want to go quickly swap into USDC for them to be able to earn a 20% ARB. And companies and institutions have been doing that for years. They've been finding ARB opportunities worldwide. And I think that's what actually helped correct the price on Monday after the weekend's drop, was institutions realized that this is a great ARB opportunity. They've made 20%. Good board figures at the end of the year, huge bonus payouts because now they've done a good ARB.
Right, ARB being arbitrage.
Yeah.
And that's on your treasury solutions side of things. So people who, companies that are converting local currency into US dollar-backed stable coins, sometimes there's a 20% gain over the course of the year, or a saving.
Yeah, even hedge funds, if you think about it, right? They're sitting on US dollars at the end of the day. They see a 20% discount. Hedge funds wants to buy it. That's good performance numbers for them to be able to show their clientele or people who invested in their hedge fund. Good returns at the end of the day, with a very simple trade.
Just on arbitrage, the crypto arbitrage has been quite a cottage industry in South Africa, where back in the day you would be buying Bitcoin overseas on an exchange like Kraken, and you would be bringing that Bitcoin back to South Africa, selling it on a local exchange. In those days, you would make a quick profit of 4, 6, 8, at times 24%. Great days.
Good old days.
Now, of course, it went down to virtually nothing. But something happened in the last few weeks, and this crypto arbitrage market has kind of bounced back to life. It's not back to the 4%, but it's back to 2.2%, something like that.
Yeah, look, I think that was hugely dependent on the banking crisis. So firstly, FTX affected. So giving you, let's go years back, there were only a few number of players that were doing it, right? So only, let's say, a handful of people who knew about crypto arbitrage and were exploiting the price premiums. That's why you went up anywhere between range from 10% to 24%. But the more people started knowing about it, the more supply of Bitcoin and the more supply of stablecoins was there in the market. So there wasn't enough demand, but there was huge amounts of supply. So obviously the price got squashed at the end of the day. But if you take recent, whatever happened with SVB, so I think whatever happened with Silvergate, I think that was a huge point of why the crypto premiums began to start widening again. It was because people from South Africa couldn't get their money offshore because there wasn't any bank that was accepted and then converted into crypto. And also there was a huge time delay. So I send my money today, but I'm only locking it out in 3 days' time when the funds get there. From a bank account, now you've got to move it to a crypto exchange. From there, you've got to buy a token, now sell it in South Africa. So that's not enough supply actually caused the gap to widen. And I think wasn't a bad thing for South African term, because now at least the gap's there. But obviously, the more players there are in the market and the more people who want to do crypto arbitrage, the prices will just get squashed to a point where it was so bad. It was 0.2%, 0.1%, sometimes even negative arb.
Yeah, negative.
So miserable.
Yeah. And so Five West does crypto arbitrage. You do that for clients. And you've, the fact that, was it Silvergate Bank? Silvergate Bank, a lot of the companies were using, that was because Circle, which is the issuer of USDC, demanded that you use that bank.
Correct.
That's gone out of business. You found a workaround.
Yeah, so what we're trying to do is, or what we've put into place is for us to be able to self-custody the funds itself, to have an offshore bank account where people send their money to be integrated with stablecoin issuers, just so that we're in complete control of the loop itself. So that was the huge factors that we learned from the likes of FTX, the failed exchange that went on, and the fact that Circle all of a sudden just halted third-party deposits or deposits into bank accounts because Silvergate went down. So at the end of the day, all your trust was in a third party. Whether it be a regulated entity, whether it being a bank itself, it can go down overnight, right? So what we're trying to do is really self-custody the funds ourselves as Five West, so we're in complete control of, let's say, your funds, so that there is peace of mind for the client when signing up, that the funds at all times stay within the ecosystem of Five West. And I think that's a very important point, is because we are the ones who are liable. And we are an FSP, so we are licensed for long and short-term deposits. So as a company, our view was to actually create a loop structure that stays within our ecosystem. And that's why we've been able to resume trading, is because the money is now in our custody. We can pay the clients out, and they've got peace of mind at the end of the day. With all the scams and with all the negative news around crypto, I think it's very important that clients have an element of trust with the company that they're working with.
Okay, 30 seconds. We're running out of time. How far away is South Africa from crypto regulations? Well, we do have crypto regulations, but they come into force. You're going to have to be licensed by the end of this year.
Yeah, so you do, and you had to submit a document by the 14th of Feb this year, so I know a lot of companies have done it. But I still think we are still a few good years away from having proper regulations in place. That's because I don't think we understand the industry that well yet as regulators. So I think we're a few good years away, but I think what would be really important is for the regulators to work with us, is to work with crypto companies and to actually understand the ecosystem and understand the real world features and the benefits and how it can be avoided from, let's say, anti-money laundering and stuff, and then you can actually place something. So I'd say a few good years away.
Right, okay, I very quickly want to skip through these slides, if we can just call up these slides, just so that people can get a sense of what it is that you do. I think rather than go into this in any detail, we have covered quite a lot of this ground already. So the kind of services that you offer, you're an OTC desk, over-the-counter desk. What does that mean?
So you can buy and sell cryptocurrencies using our OTC desk. So it would be the same for using Luno, but for high volume execution, and also for retail clients who don't quite understand how to use an exchange can now actually use our OTC services in order to buy and sell cryptocurrencies.
So for big volumes of crypto, big volumes of Bitcoin that you wouldn't necessarily get filled that easily on other exchanges. Okay, you have a payments gateway, and you have this treasury solution where you can convert your cash from local currency into US dollar stable coins. Great idea. That's another thing that you provide.
Yes.
And what's the take-up been like?
It's been really good. So we're in chat with a lot of different merchants and a lot of different PSPs around South Africa as well, who want to take it to their clients that they're working with. So I think the take-up's been great. It's just about implementation and getting it integrated into the likes of Takealot, etc. now. So we've got our business development team working on that.
And you've got the payments gateway that you also have developed as well. So
yes, correct.
You're not really a crypto firm, although you're using all of these new technologies. You're more a fintech, although that's a lousy term.
Yeah, we have more of a blockchain. So we believe in the blockchain space, and we believe that it's got a lot of useful benefits for people. And we're kind of an integration between the traditional world of finance and the crypto world. So we essentially want to be in the middle. We still want to use the bank, still want to do our forex trading for our huge clients or our institutions, and want to be able to provide them with real world solutions using blockchain.
We are going to leave it there. Omar Iqbal, CEO of Five West, thanks very much for joining us.
Yeah, thank you for having me on. It's been an absolute pleasure.
Hi, I'm Bitumelo Nzoko, and I host the Money Savvy podcast. Managing your money while also trying to figure out how to save and invest for the future can be overwhelming, especially when you're new to financial planning. The Money Savvy podcast aims to make personal finance easy by exploring themes such as budgeting, saving, investing, retirement planning, and so much more with Moneyweb's trusted Click and Advisor community that includes certified financial planners and wealth managers. Advisors share their expert tips without the jargon, with the aim of empowering but not confusing you. So join me and my guests every second Friday on the Money Savvy podcast. You can listen to it on moneyweb.co.za, the Moneyweb app, Apple Podcasts, or Spotify.
The Money Savvy podcast. Money Savvy. Moneyweb, your trusted source for business and investment insights.
Moneyweb frequently asked questions, Part 3, the Moneyweb Insider Gold Premium Subscription.
Welcome to Part 3 of the Moneyweb FAQ series. I'm Ryk van Niekerk. We received the question, what are the benefits of an Insider Gold subscription virtually every day? The short answer is that a premium Insider Gold subscription unlocks a myriad of premium data tools to assist any individual to analyze and research the performance of JSE-listed shares, unit trusts, ETFs, ETNs, commodities, exchange rates, and international indices. The historical performance of these instruments is available for up to 5 years, and the tools allow for the ranking of the indicators according to many predefined metrics. I want to highlight 2 unique and pretty cool tools. The comparison tool allows subscribers to compare the performance of multiple instruments over various periods. For example, a subscriber is able to compare the share price of a company such as Sasol with historic performances of the price of Brent crude oil, the Rand-dollar exchange rate, and the S&P 500 index, all on one graph. We also offer a dedicated page for each listed company and unit trust. They are the Click a Company and Click a Unit Trust pages. Each page contains detailed information on the historical price and financial performance of the instrument. Sign up today for just 630 Rand per year or 63 Rand per month and equip yourself to make better financial decisions. In the following video, I will highlight a few of the many other benefits of the Premium Insider Gold subscription. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
Welcome back to the Moneyweb Better Investor Conference. I hope you enjoyed the sessions throughout the day. We've had various sessions on investing, and now we move into our personal finance section. And for this section, some of the questions that we answer have been questions that have been quite hot topics on our social media pages. One such topic is one that we're about to dig into now. I'm joined by Elke Brink from PSG Route 21. She's a director at PSG, but what you might not know is she is the youngest qualified CFP. She qualified as a certified financial planner at the age of 22. Not many people can say that they've achieved that. And she's joining me to chat about the big question around retirement. And the question that we've posed is, can you retire on 2 million Rand? Now, 2 million Rand seems like a lot of money for some people that haven't seen that sort of money in life. Most of us haven't seen that sort of money in life. It seems like something you can retire on. But having had this conversation off air with Elke, I can tell you the answer is most likely going to be no. But let's dig into that and let's see how that conversation unfolds. Thank you so much for joining me, Elke.
Thank you for having me. It's good to be here.
I guess let's start with that question. So, can you realistically retire on 2 million Rand?
I think when it comes to retirement, you need to define what you need to earn per month. And I think there the answer is going to be different for each individual. But really understanding what the value of money is. So if you were to reach retirement today, I think firstly realizing, let's say the average age people retire is 65. These funds need to last for potentially another 25, 35 years. So we need to make it last. So a few things become very important when it comes to how you manage this time frame in your investment strategy, is how it's invested. How do we make the capital last as long as possible? And ultimately, it comes down to what do you draw down from this investment without depleting the capital so quickly. So I think to give a rough answer on what the fundamental here is we normally advise not drawing more than 5% of fund value if you follow a specific investment strategy. So that would come down to just over 4,000 Rand per million Rand you have to work with. So I think when you backtrack from there is what do you really need per month and how do we get to that stage? So if we work on a 2 million Rand investment, you're going to be able to earn just over 8,000 Rands basically a month if we want to make sure the funds don't deplete.
So, I mean, we'll get into a lot of the things around depletion and how that's set up. But the crux of the matter is the planning stage of it becomes very important. And planning to ensure that at the point where you get to the retirement age, you have enough to sustain you beyond that so that you're not dependent on the social grants of the state and those sorts of things. Looking at that planning phase, where does that start? Do you start planning just before you retire? Do you start planning when you get your first job? Where's the best time to start that process?
I think when it comes to building any resilient investment portfolio, the main gift you can give yourself is time. And it takes a lot of pressure off later on in life. I think a lot of the negativity around financial planning comes when the pressure starts loading, and we, from a financial point of view, start saying, okay, now you need to save 50% of your income, which is completely ridiculous. So I would say the moment you start earning an income, just starting to really benefit from time in the market and that effect of compound interest, and you'll take a lot of pressure off later off in life. So I think there's a principal idea out there in the world that you need to save 15% of your income and you will be okay for retirement. But this percentage doesn't really apply if you only start off, for example, if you're 40 or 50 years old. So 15% is a calculation that applies when you're 25 years old and you just started working. So I think that's quite important to know exactly what do you need to save for your specific scenario, and starting off as early as possible and just getting used to it. And you will have 40 or 50-year term to actually invest for.
So how do we save? Save where? Do we put it under a mattress? Do we... Because, I mean, I've started a job. I now earn 8,000 Rand a month. I've got the ability to save 500 Rand a month. Should I be putting it in a fixed deposit? Should I go straight for an RA? Where does that process start? Because a lot of the time when we get our first jobs, there's the pressure to get a vehicle, to get a property to stay at, to rent a place, or to, you know, buy certain things. And I think the saving component that you mentioned is probably the most important one at that stage. But where do we put that money so that we don't have to be focusing on it?
Yes, I think ultimately you want to start building up the ideal portfolio, which would consist out of a few different things once you start working. And it's not possible everything at once. You have a lot of expenses, a lot of pressure, only earning X amount once you start working. But I would recommend starting off, at least once you start earning an income, to optimize your tax benefits. So maybe start off with retirement annuities, start off with your company pension or provident fund if they offer that benefit, and at least having that additional tax benefit as well, where you can start optimizing that from the start. And as you start growing into your portfolio, we start adding on different products that have different tax benefits. So a tax-free investment, an emergency fund, a different type of vehicles that would have various investment strategies and different tax benefits in your portfolio. So they all play a different role. You would have shorter-term planning, longer-term planning, but I think the main crux of it would be to be invested in growth assets, especially as a younger person, and that would mean equity exposure. So not just being too conservative, because it doesn't really help if you're just saving in the bank and you're basically earning, you're just keeping up with inflation, if even. So just having that benefit of earning above inflation returns over an extended period of time, and then you'll be fine. And I think what goes together with this planning is, and that would define what you actually need at retirement, is if you can also become or plan to be in a situation where you don't have debt. I think in principle, the end result needs to be planned for. So what is your expectation in terms of expenses per month, income per month, and then we can start planning around that. You can very much comfortably retire with 2 million if you don't have a lot of additional expenses. But if you're in a situation where you still have a lot of commitments, liabilities at that stage in life, then it becomes a difficult story.
I like that you touched on the debt thing, because, I mean, one of the questions is obviously, at the point where you're about to retire, let's say you have managed to pay off your debt, how significant a difference or how significant an impact does that make on your ability to retire comfortably, given the fact that what we all know is even at retirement, your funds are still taxed? Yes. So how big a difference does it make if you go into that situation having paid off as much of your debt, and is it worthwhile to keep some debt to go into retirement with?
I think that's quite an interesting question, because I think a lot of younger people also, if you have a mortgage or a bond or a study loan or whatever form of debt you're paying off, I find that a lot of people only want to focus on that. So they don't end up saving in their investment portfolios. So for 10 or 15 years, they're just focusing on paying off this component in their portfolios, where you're losing a lot of time in an investment portfolio, and exactly the benefit that I'm explaining now, benefit of compound interest. So in the perfect world, you would want to be in a situation where you have a significant, which is relative, portfolio built up, which you can live off from, and not having additional expenses that you still need to. You basically, the largest headache at retirement is your medical aid, which becomes extremely expensive, and it's normally almost a third of your income that you just spend on keeping your medical aid in place in a phase in life when you really need it. But I think if you can manage a type of portfolio where you don't have a bond you're paying off, especially with interest rate cycles that can move around all the time like we're seeing at the moment. And then together with that, yes, keeping in mind, depending on what the source of funds are, your income that you're going to start drawing from your investment portfolio is still taxed at an income tax level. So you need to plan for that additionally. So being able to accommodate that tax income and still having enough net income to be able to live off.
To survive off of, yeah. I want to look at something that you and I spoke about off air around the structure and the strategy that you use to then employ to ensure that you optimize your retirement plan. Particularly, I mean, we spoke about things around replacement ratios and very technical terms when it comes to retirement. But I mean, can you just shed some light on the strategy that you should employ, considering things like that, like the replacement ratios and all of that, to ensure that at the point that you retire, you've saved up enough, you're spending the minimal amount. Where's the sweet spot in terms of what you can draw on and that sort of thing?
Yeah. So I think there's two parts to it. I think leading up to retirement, what I just referred to about the 15% assumption I think a lot of investors make, I think firstly really approaching it on an individual level. So knowing that a 22-year-old and a 30-year-old or a 40-year-old are going to save different percentages, depending what you have already saved, how it's invested, what is the return you're earning on your investment. That's going to depend what are you supposed to be saving to be able to replace. And if I can maybe just elaborate on replacement ratio, the average investor normally retires with around 75% in the ideal world of their last income. So it's very rarely that you actually retire with exactly the same income level you were used to, but with the assumption that your expenses would hopefully be less. Of course, in the ideal world, you want to keep your standard of living and what you're used to doing, but then you need to be sure you are actually saving enough from the start. So firstly, I would approach that on an individual level. Either calculate it yourself, where there are significant tools that can help you with that, or approach an advisor that can assist you to ensure that you are contribution-wise saving enough. It doesn't help your portfolios earning an excellent return, but you're physically not saving enough compared to what you're earning. And then together with that, when it comes to how the retirement is managed, and I think that's extremely important when it comes to the strategy, is to not be invested too conservatively. You still need to ensure this capital is going to last for X amount of years, which is, life expectancy would be at least 30 years plus. So building a strategy that in the short term you are protected against significant market volatility, where your income is drawn from, where we normally use cash and bonds. And then together with that, all the capital you will mainly only need, let's say 4 or 5 years onwards, we build in growth assets. So ensuring that you are earning an above inflation return on this portfolio. So basically 2 things need to happen at retirement, or 3 things. You need to outperform inflation, and you need to outperform your income drawing to be sure that you can, I don't know how long you're going to live for. So you might live to be 110, and we need to ensure the funds aren't going to run out. So the strategy becomes extremely important. I think there's automatically a conservatism that kicks in once you reach retirement, that you don't want to take risks with your funds because you're not going to be bringing in more capital. But that's almost more of a risk. So I see just being invested in cash almost more risky than having exposure to equity exposure, because basically inflation is going to deplete your capital within years.
You mentioned something about short-term investing, and I like that you did that, because we've got a question from Sonia saying, is it possible to have a short-term investment strategy of 5 years considering the current global instability?
Definitely. I think it depends how it is invested. Maybe this SVB was a very good example of how to invest short-term funds or how not to invest short-term funds. Different asset classes play a different role in your planning, and I think anything, I would say 1 to 2 years' time, you can basically do cash exposure. Anything over and above that, you start building in bond exposure. But with bond exposure, for example, you need an 18-month rolling period. So something that is seen, and I think it's a very big lesson a lot of people learned in the last 2 weeks again, as a safe haven asset, can be very volatile, and it can react differently than planned. So yes, short-term exposure needs to be invested quite conservatively, and there would be different pockets built into that. 5 years is actually a long time still. You can start building in slightly more risk when it comes to that period of time. But I think what you always want to achieve with any portfolio is just keeping your options open. Should you move through a market cycle where either bond exposure or equity exposure reacts in a way that you don't want to sell off at that stage, and you can wait out the cycle. So just ensuring there's enough liquid assets as well where you won't be negatively impacted.
Let's look at that liquidity component, right? How different, or how many different investment vehicles should one have to retire comfortably? So earlier in our conversations, we looked at things around alternative streams of income and that sort of thing, just to balance out against what you're drawing down against. But from a retirement point of view, the investment vehicles that you have, things like an emergency fund or things like a side fund that you contribute towards that is beyond, or second RA, for example, those different types of vehicles, how would they contribute towards your retirement? Again, looking at the fact that your retirement funds are still going to be taxed and those sorts of things. Is it wise to have more than one RA and that sort of thing? If they're all going to be taxed, are they taxed at the same rates? And how does that work?
I think combining a few different products, because you can optimize your tax implication at retirement also by combining different products. So I wouldn't necessarily advise having everything just built up in a retirement annuity or a pension fund, for example. Especially for people who are only starting out to build their portfolios now, a tax-free investment, for example, can be optimized in a great way, almost as a retirement structure as well, which we haven't really seen play out because it's still too young. But if you had to build up a significant tax-free portfolio, and you can start drawing an income from this portfolio where you're not going to pay a cent tax on it, together with that, you'll have your retirement annuity, possibly also a retirement fund that comes from your employer, should they offer one. I wouldn't necessarily recommend having more than one retirement annuity, but you can diversify within the investment by optimizing different managers, different styles within the structure, and that way keeping fees at a low level, but also diversifying your strategy. And then lastly, which I think is very important at retirement, and the tax-free can play a role here, but having a normal, accessible investment, because I think apart from the tax implication with the retirement annuity that is taxed at an income tax level, it's also tied up quite strictly when you get to retirement. So a lot of investors tend to forget this part, that you now need to start earning an income between 2.5% and 17.5%. And you can only change this once a year. So if you have crisis, we can't do anything for you. So having an accessible portfolio, which is also taxed in a different way. So that would be taxed, it could potentially be taxed in a much friendlier way. So how a voluntary investment or a flexible investment, or all the platforms have a different name for it, but anything that is interest bearing, so basically cash and bonds, would be you have certain exemptions that you can qualify for every year, and then it's seen as an income tax earning above that. Everything that's in equity exposure can possibly trigger capital gains tax, but it's not that your income out of this investment is taxed at an income tax level. So you can very much manage your tax implication on this structure. So I think if you optimize all of the products together, keeping your income earning out of the living annuity or life annuity as low as possible, and basically supplementing from a tax-free investment and a voluntary investment, you can really manage your tax implication and keep it quite low.
Aubrey wants to know, how much do I need to contribute to my pension fund each month in order to retire comfortably in 25 years? So, I mean, I guess the first assumption there is your retirement age is 65, which off the 25 years means that you're currently at 40 years old. You've got another 25 years to contribute towards that. How much realistically, if you've only got 25 years to start contributing and you have to contribute monthly, is there a calculation one can do? Is it based on your income? Is it based on how much you're saving per month? But I guess to Aubrey's question is, how much should you be saving so that at 65 you're not too stressed out about the situation?
So this is where the calculation and the individual calculation comes in. I don't think there's a set rule for any individual out there, but there's a few components that make up the calculation. So firstly, it's a percentage of what you're earning. So we want to try to replace what you used to, if you want to keep the same standard of living. of course, whatever has been saved up until now, if there is anything to work with. And then the investment strategy becomes very important. So if you're going to be earning a 7% return compared to a 10% return, of course, the outcome is going to be very different. So I think taking all of these inputs into calculation, and as from there, every year can make a difference. If you retire 1 year earlier or 3 years later, it can also look different. But basically, it comes down to a percentage of what you're earning. And that can be anything from 10% to 40%, depending on what you've done and what your expectation is at retirement. Will you be okay with less than you're earning at the moment if you maybe have a replacement ratio of 80%? Or do you actually need to be able to replace your entire income that you're used to now? But it's something that can be calculated, yeah.
So then, where do we start? So let's take Jimmy as an example, 30-something-year-old male, hasn't started saving for retirement, wants to now look at that, has 30 to 35 years of starting to save and that sort of thing, just got a new job. Where do you then begin so that you optimize the time you have left? Because what you mentioned earlier around the fact that the sooner someone starts, the better it is. So if I'm at 30 years old and I didn't start at 25, I've already lost 5 years that I could have earned the compound interest and been diversified in various portfolios and that sort of thing. But let's say I'm at that point now where I'm ready to start. I finally got income and I can save some, and this is what I'm looking to do. Where's the starting point for me?
I would definitely recommend starting with your retirement fund, so to start optimizing these tax benefits from the start. And I think that's a very much an underutilized benefit in principle in any portfolio. So if I can maybe just fast forward it a bit, but if you can start building up your contributions to a retirement fund within your working lifetime. So basically the main tax benefit is you can deduct on an annual basis 27.5% of your taxable income, up to a maximum of 350,000 rands a year. And this is now an annual benefit you get. But anything you save over and above this benefit starts getting pooled up in a disallowed contribution pool, which you can one day again offset against your income and pay less tax. So there's amazing tax benefits that you can start implementing for later on in your life and essentially create an almost tax-free retirement if you start doing it early on. So optimizing all your tax benefits from the start, I would do a combination of two things. So starting to save in your retirement fund, but also starting to save in a more accessible investment for more than one reason. But I think having that emergency fund, which we all need at some point, but also in terms of investment strategy. So retirement funds are governed in a different way. So you can invest accessible investment in a completely different scenario and diversify in that way as well. And then I think in terms of contribution, calculate from day one what is more or less needed over a 30-year period. If you start saving 15% of your income, for example, and every year increasing that with inflation at least perhaps, or perhaps more, and that calculation needs to be revisited often because, of course, everything can change. Your income is changing, market returns are changing, so at least ensuring your portfolio planning is staying on track. But I would make sure I make the right decisions from day one. You're going to, in terms of investment strategy and in terms of contribution and costing and all of that, so that you're not losing too much time.
For those of you just joining us, I'm chatting to Elke Brink, who's a director at PSG Route 21, about the ability to retire on 2 million Rand, whether it's feasible, whether it isn't, and what it is you need to do to retire comfortably. Please note that all our sessions for today will be available on the Moneyweb YouTube channel as well as on moneyweb.co.za this week. So if you miss any of the sessions, don't feel bad. Download the Moneyweb app. You'll still have access to all of the sessions. You'll be able to watch them back. But Elke, back to you. I mean, I just wanted to look at the retirement side of it from, we're at 65. Yeah. I've retired. What do I then need to do? Because you mentioned that keeping the funds as cash or being conservative at that point might not be the best option. So what do I need to do at the point of retirement? Let's say I've amassed 3 million, 5 million, the amount isn't really relevant, but what do I do to ensure that the money keeps growing, even though I'm going to be drawing on that money almost on a monthly basis? Is it advisable to draw on a monthly basis, or should I do a quarterly withdrawal in bigger lump sums and then just manage my budget better over that period?
Out of a market timing perspective, I would definitely say stick with a monthly drawing. because of the reality that you can't time the market. So anything can happen at any point. Should it be a pandemic or a war or a banking crisis or name it, there's always going to be something new. So I think in terms of that, try to basically even it out on a monthly basis and start building up your budget planning in terms of that. Together with that, the investment strategy becomes incredibly important at this phase in life. And that will depend on what your income need is. So how much do you allocate to more conservative asset classes and what do you allocate to growth assets or equity exposure, combination of local and offshore, of course. But I think that's one of the biggest mistakes that a lot of investors make at this point in time, that they feel now that I'm retiring, I need to be invested more conservatively, where that's not really the reality. The investment term that you're working with is actually very long still. So even if you're 65 today, we may be entering a new phase of another 30-year investment term. So in terms of the equity exposure and the time frame you have around that, we have a long time to work with still. So be wary of going too conservatively and ensure that the strategy is accommodating your, not only over and above inflation, but your income need as well. And then optimizing your tax-free components. So normally at retirement, that was now increased with the last budget speech, you can access up to 550,000 Rand tax-free, which my recommendation would normally be to take it out and reinvest it in an accessible investment, where this can either supplement your monthly income or it can be used as an emergency fund, depending on what your need is. And then together with that, the remainder of the funds will now have to be invested in either a living or a life annuity or a combination. I personally recommend a living annuity. I just think there's much more flexibility in terms of the product for many different reasons. You just keep your options open in terms of investment strategy, income drawing, all of this going forward. But mainly you will need to choose an income between 2.5% and 17.5%, and this can only be revisited once a year, so that needs to be planned very well. And there's a certain recommendation here where we would normally say 5%, depending on the strategy, of course. It doesn't help you draw 5%, but you're only earning a 7% return. So the strategy becomes incredibly important together with your income drawing.
So I'm getting a sense that a lot of it comes from going to the end and saying, how much am I going to need at that point?
Yes.
And working backwards from that to say, okay, if I want to have 30,000 Rand a month in retirement, after tax, because that's something we all have to consider, how much do I then need to, and sort of calculating backwards to say, to get to that 30,000, for example, I need to be putting aside 2,500 a month over this particular period and that sort of thing. So the products and the strategy and all of that comes into play once you've determined sort of where you're going to be at that point, right?
Exactly. I think it's so important to determine the end in mind. I think it can be seen as a marathon or running a long distance race. It's not something you just go and do. You need to plan with the end in mind, and then we can work backwards from there. And I think it's important to have a plan. It's much easier if you know more or less what type of lifestyle you want one day, where are you heading, at what age do you want to retire, do you want to travel then, or do you want whatever you want to do, but then it's easy to plan. And then you're going to know if you're still on track or not leading up to it. Otherwise, you're just basically running into this blind and not knowing where you're going.
So then where do investment managers fit in? And I think the reason I ask this is because, one, we don't know how, life is unpredictable. We don't know what tomorrow holds, right? So the plan is, yes, plan for the eventuality that you do live to 100. Yeah. But from an investment manager's point of view, I mean, how do we get investment managers to then align goals or set goals for clients so that it's a situation where, one, it's more fashionable and more proactive on my part as an investor to want to be involved in these sorts of retirement products and to want to have retirement front of mind, because often we don't do that. Often we find ourselves in situations where life takes control on a daily basis and we say, okay, cool, to that extent, I'm going to live for the now because I don't plan on living 35 years beyond my retirement age of 65. So what's the role of investment managers in that space to then ensure that these things stay front of mind and you stay focused on remembering that you are going to retire one of these days?
No, I think unfortunately we live very much in an instant gratification generation where I think it comes down to discipline in a big way. I think there needs to be this independent, and I think that helps working with an investment manager because it takes the emotion out of it and it keeps a goal in mind. So really ensuring as your life changes, with every individual's life changes significantly on an annual basis. So knowing that you're still staying aligned with your goals, and I think that's where a lot of the short-term planning comes in as well. Should unexpected events happen, at least you know you're not touching the long-term planning. So just ensuring that's staying in place and that you're actually making active changes as your life evolves, because I think that unfortunately happens a lot that you don't revisit your plan, so now you're not actually keeping up with the goal or the plan. And then together with that, as with any relationship, I think the communication is very important between the manager and the individual. So knowing what the goals are, and if they do change or if unforeseen circumstances come, or positive things, you want to go on a certain holiday, or you want to buy a home, or whatever it may be, that you plan your portfolio accordingly. So it's much easier from a managerial point of view if you actually know what the goals are that you work with, to know how to plan for them. So I think really actively working with an individual, not just once a year, but actually on an ongoing basis, and planning for everything short-term and long-term.
Thank you, Elke. So plan for the retirement that you want so that you're not stuck with the retirement that you can't do anything with. That was Elke Brink, who is a director at PSG Route 21, just running us through what it takes to retire. Can you retire on 2 million Rand? How much planning goes into ensuring that you can retire comfortably? And she's left us with this closing bit of advice that make sure that your financial advisor or your financial planning team is a team that understands your goals and will assist you in achieving those goals. And to that end, stay tuned for our final session of the day, where we look at the financial advisor side of things. We look at how to pick a financial advisor, what the right financial advisor looks like, and what a good financial advisor can actually do for your portfolio. Stay tuned.
Hi, I'm Suren Naidu, Deputy Editor of Moneyweb and host of the Property Pod. My Moneyweb podcast is published every second Tuesday and covers the broader property industry. We get valuable insights from leaders in the property sector, including the CEOs of GSE-listed real estate investment trusts, property entrepreneurs, industry analysts and experts, as well as private developers and estate agencies. If you're interested in the property industry, then tuning into the Property Pod is a must. Listen to the podcast on moneyweb.co.za, the Moneyweb app, Apple Podcasts, or Spotify.
The Property Pod with Suren Naidu. The Property Pod. Moneyweb, your trusted source for business and investment insights.
Moneyweb frequently asked questions. Part 4. The Moneyweb Insider Gold Premium Subscription.
Welcome to part 4 of the Moneyweb FAQ series. I'm Ryk van Niekerk, and today I'll highlight a few other valuable tools to answer the question, what are the benefits of an Insider Gold subscription? Whether you are a novice investor or a money-savvy professional, a premium subscription offers several tools to keep subscribers informed of all the daily developments and announcements related to listed entities. One of the most popular tools is our live SENS service. With a few clicks, you can access the latest SENS announcements as and when they are released. As you may know, traditional SENS announcements are notoriously challenging to read. However, you can access PDF versions of all SENS announcements, making them easy to read and to save. Subscribers can also elect to receive notifications when companies they follow release new SENS announcements. And exclusive to Insider Gold users, we offer a portfolio tool where subscribers can create their own share and unit trust portfolios to monitor their performances on one screen. Go to moneyweb.co.za and click on Sign Up and choose the monthly or yearly Insider Gold subscription options available.
Moneyweb, your trusted source for business and investment insights.
Welcome back to the Moneyweb Better Investor Conference. We hope you've enjoyed your time with us today. We're into our final session of the day, but it is an exciting session. We are looking at the role of financial advisors and what difference a financial advisor can make in your financial planning, in your financial goals, and in your ability to achieve those financial goals. I'm joined in studio by Tulisile Nkomo, who is from NFB Private Wealth. Thank you so much, Tuli, for taking the time. I guess the starting point for this one is, what is the role of a financial advisor? I mean, today, throughout the day, we've gotten various experts come in and give us tidbits about how important a financial advisor becomes, and you should rely on your financial advisor and that sort of thing. But what is the role of a financial advisor in the life of an individual?
Thank you, Jimmy, for having me here. The role of a financial advisor is to help the client achieve their own individual goals, because I think it's very important that one starts thinking about this as soon as they start earning an income, because that's when the role of a financial advisor comes through. Because let's say, for instance, you just finished varsity and you start working, then you don't know what to do because you've never been exposed to so much money. You don't know what is important. So the role of a financial advisor is to help guide someone that starts working or someone that's owning a business. And if I go back to a person who starts working, first, the things that are important is that we help them in assisting them to understand the importance of saving. Because just because you're earning an income doesn't mean that in 12 months' time you'll still be earning an income. So we assist them in terms of planning around having emergency savings to make sure that the decisions they're making are very informed, in a sense that we educate them about financial planning to just make things that are complicated not less complicated. So our role is to help people reach their financial goals, and then we take them step by step, but that is something that we do with each client. So we help clients achieve their personal financial goals.
So then, as Jimmy, who now needs a financial advisor, what do I look for in a financial advisor? Do I look for certain qualities, certain traits? Obviously, I mean, I think the more relatable and the more identifiable a financial advisor is towards my needs, the easier it becomes to sort of build a relationship with that. But what do I look for when I look for a financial advisor? And with that, are there specific questions I should be asking that financial advisor to find out if they're the right fit for me?
I think very important is to look at the person's experience, qualifications, the scope of the services that they're able to provide. Because when you start working, I think if we go back to our parents, if you say, Mom, I've got 100,000 rands to save, the first thing they'll say is go to the bank. There's someone who's going to assist you. So a financial advisor should be someone that has the qualification, someone you can relate to. If I look at my personal background, people that are my clients are people that I can relate to. I think earlier on you did speak about black tax. Someone that is not exposed to black tax might not understand how important it is for a person to be contributing to their family members. So you look to someone you can relate to, someone who communicates with you in a level that you understand, because finances can be so complicated, and you want someone who can communicate at that level. And I think the most important thing is accessibility, because you can have questions at any time of the night, but you want to send an email and then you know that somebody is going to respond. So you want somebody who's got your back all the time, and someone who can communicate with you.
How do I identify that person? I mean, where do I start looking for that person, and what sort of screening process, I guess, is what I'm trying to get at, to identify whether the person's going to be a right fit for me? Because something you mentioned around the financial advisor was the financial advisor being relatable to you and identify or recognizing what your needs are and that sort of thing. But now, when I myself might not know the full extent of my needs, I don't necessarily know what questions to ask, right? So what questions do we then ask to the financial advisor so that I know that, okay, Tuli understands where I'm coming from?
I think we live in a very interesting world where information is in abundance. As a result, if you're looking for a financial advisor, you can Google Moneyweb. Is also another platform where people go and look for financial advisors. And then from there, from a regulatory point of view, you can also go to the FSCA to confirm if this person that you want to deal with is actually reputable. And I think the best place is us family, because I believe just like a specialist, a doctor who's a specialist, you want to rather get somebody who's already dealt with them, who can actually refer you based on the services that they've provide to them. And then when you have found that person, I think it's very important to screen them, because as much as it's my responsibility to screen a client, it's also their responsibility to screen me to say, is this my person? So I think the first question you ask the person that you found probably on the internet is to ask, are you going to be charging me for this consultation? How do you work on the fees? Because I think we are financial advisors, we provide a service and then we do actually earn a fee. But it's important just to understand if you would be liable for that consultation. Because normally some advisors come on risk and then the fees come later. And then the next important one is, how often will you meet with me? And what is the scope of the services that you offer? Because if you look at certified financial planners who belong to the Financial Planning Institute, one thing about them is they provide a whole scope of financial planning services, which would include your investment planning, retirement planning, tax planning, estate planning, and financial management. So it is important to understand that your whole range of financial planning services would be provided for. And also ask the person, like, have you dealt with someone that is like me, someone with similar situation to mine, and how did you do it? So it's very important to just have that open conversation. And I think the last one is that you also want to deal with someone who's going to make it very easy for you to actually disclose your information, because I don't like to disclose my income and some of my fears. So you want somebody who's gonna make you comfortable that I'm okay with letting them know, and I'm okay with letting them know what my fears are regarding financial planning.
You're right. Financials, financial planning, retirements, all of this is very, very personal, and that level of comfort that you get from a financial advisor is absolutely very important. Something you mentioned earlier, Tuli, around the access to information, right? Now, that's important because we've got a question from Jayashree saying, with the onset of personal finance and investment content and education that we're seeing on social platforms like TikTok and Instagram and the like, and the financial tools that you mentioned that are available online and that sort of thing, basically self-learning is on the rise. People are able to achieve greater than what they were in the past, right? And the question Jayashree has is, will there still be a place for financial advisors in the next 10 to 15 years? Will financial advisors still be relevant given that we have access to so much information? And to add to that, I think from my side, it's if they will still be relevant, under what circumstances, under what situations do you suddenly wake up one morning and say, hey, I need a financial advisor? Have I won the lottery? Do I suddenly have more of a bonus than what I had planned for? So to Jayashree's point is, will financial advisors still be relevant in the future? And under what conditions would one actually go out and look for a financial advisor?
I think that's a very interesting question, and information is in so much abundance, but is that information tailor-made for you? So it's very easy to say, I can do a financial advisor's job. I remember when I started working, I had a financial advisor, and they recommended a whole lot of products, and I did not know what I had. As a result, I don't believe that solution was tailor-made for me. So I think the role of a financial advisor is to help you understand the information. Because let's say, for instance, you start working, and then you want to protect your biggest asset, which is your income. You take out income protection, you take out death cover if you've got family members that you look after. But you need to know that there is a need. So financial advisors would put together a solution for you, because we've got the tools that are able to assess your personal situation and then come up with the plan. So in that instance, you'd say you need so much life cover, and then you need so much income protection. But the thing about people, they think income protection is a protection against retrenchment. So the first thing they do is when they get retrenched, like, I'd like to make a claim. So our job is to explain and custom-make solutions that are suitable to our clients. And also those solutions that are on the internet don't take into account your risk profile, your personal fears. And also, we as human beings, we're very guilty because we like to paint a perfect picture. So if you ask me to put my budget, it's going to be very perfect. It'll have a big surplus. So our job is to help you as a person that's looking for services to bring it down to your level and also be accessible. I think so much is going on in the world right now. If you look at how the interest rate is going up and people not able to afford their repayments, they come to us. Those are fears that I might have to sell my house. Can you go to the internet and say, I think I want to sell my house? And then the person can say, you know, this is my recommendation, this is what we can do. So I think our place is, I don't think the internet or the people who are making content on TikTok will actually replace us, because there is a place for us. There is also a place for those financial advisors or for those educational people on the internet. But for us, we are targeting a specific market who have a lot to lose. Because when you look at financial planning, it's not just about taking money and saying, I've got 500 rands, what do I do? There's a lot that goes into it. And we work on taking care of your loved ones. You want to make sure if someone passes away, their loved ones are taken care of. If they're disabled, if there's income to take them to retirement. When they retire, like my previous colleague said, you want to make sure there's enough at retirement. So when we look at the current generation, all they look at is here and now and not the future. So what we do is look at now, the future, and what you can put in place to make sure that you achieve those goals. So I don't think we are going anywhere. I think people that know the kind of services we provide are able to come to us and also just come and ask us for our advice in terms of achieving their personal financial goals.
I like that you mentioned that financial advisors have unique tools to assist the financial planning process and to assist and customize solutions for individuals. And the reason for that is because Ross wants to know, how will AI, artificial intelligence that is, assist financial advisors in future in terms of being able to offer better services or better products towards their clients?
I think it's very similar to the previous question, because I think I don't believe that AI is actually an enemy to a financial advisor, because such tools assist us in actually developing solutions much quicker. So such tools are designed to actually assist us to service our clients better, and also for those clients who might not be able to have the means or actually have the access to the financial advisors, that will be accessible to them, and that will assist in actually reaching that gap, because not everybody wants to work with a financial advisor. So I think that AI is good. It will assist us in a sense that it will help us to provide the solutions efficiently. It's not an enemy. So that's what I think about it.
Let's get into a very contentious topic, right, around financial advisors, and that you and I spoke about off air as well, the cost component, right? So a lot of the financial advisory space and a lot of this is, I don't want to do this because it's expensive. I don't believe I need a financial advisor because I'm not going to pay somebody else to draw up a budget for me, and I can do that myself. So how does the cost component of financial advisory, and particularly financial advisors like yourself, how does that cost component factor into the decisions that I make as an individual on which financial advisor I choose, but also on the quality of the financial advisor I get out of it? Is it a situation where I need to pay for quality, or I need to pay more, or get an expensive financial advisor for them to do a better job? Or is it a situation where just there's an industry standard, there's what is a fair price in the market, and there's a couple of guys that might charge a bit more and a bit less, sort of thing?
I think very important is, if you do get a good financial advisors, they will actually explain to you what's fees, what the fees are and what fees you're paying for. And just to touch on fees, I feel that fees are relative in the sense that it can be expensive to one and to the other person. But in terms of the fees, if you look at the clients that we service, it's your doctors, your lawyers, those people are very busy. So if you decide that, you know what, I don't want to pay the fees, I'll do it myself, do you have the time to keep up with what's happening in the world? Do you have the time to keep up with all the legislation that takes place? So if you have all the time to do that, so I believe that the fee that you pay as an investor can actually help you in avoiding future mistakes, because at times, because we are human beings and we're driven by emotions, like when the market fall, the first thing people do, and it's normal, the first thing they do is just sell. And they try to protect themselves. So that's where we come in and say, we have a goal. Please, I'll let you know if there's anything that you should do. So that's where we come in. So we have a lot of value that we bring to the table. It's not just giving you a selection and say, this is where you invest, but we make sure that we help you stick to the plan, because it's not always good. It's good when we sign the contract and we say, we're going into this, but when times are bad, a financial advisor would stick with you. And let's say, for instance, you pass away, we make sure that the smooth transition of wealth from one person, the deceased, to the beneficiaries. So those are some of the services and the value add that we bring to the table. And we also help clients to spot their blind spot, because sometimes you know what you know. You think, okay, I just want to invest, that's it, I don't want to pay fees. What about when you're not there? What happens to that money? What about potential tax implication, because you might be investing in a wrong investment vehicle because you've got a higher tax bracket? So we help to make sure that a person makes an informed decision. And unfortunately, we have to get an income for the services that we provide, but sometimes it's not an easy decision. But I believe for those that access the service, they see the value and the quality. So I believe that as a financial advisor, you need to just have a conversation with a client.
Advisor, and when would be the right time to break up with your financial advisor and end the relationship? Because that's what it is. It's a relationship at the end of the day, whether it's for a 6-month period, whether it's for a 6-year period, and whether it's intergenerational as well. It's a relationship. So what are the red flags to look out for? And if you found those red flags in your financial advisor, how do you break up? Because breakups are very awkward conversations.
I think the question is relevant for a lot of people. I think the first red flag is that if you've just signed a contract with a financial advisor and then you send them an email and they don't come back to you. The second one is, with everything that is happening in the markets, you need to be hearing from a financial advisor to say what is happening, what my thoughts are. So your financial advisor needs to be proactively communicating to you to say, we are aware of what's happening in the market, but everything is under control. It's not something we haven't witnessed in the past. So those are the red flags I would look out for. And I think the other one is no meetings. Like, I think you need to have like an annual meeting at least to meet with the clients, because so much can change in 12 months' time, to make sure that the client still has the solution that you have is still suitable for the client. So it's very important that you as a client make the decision if you feel that you're not getting that love. And I think for me, it's a very personal thing, in the sense that if your financial advisor, if you say to your financial advisor, I've lost my mom, and they never come back to you like, oh, sorry, and they never want to get to know you. For me, my job is very personal. I want to get to know the person I'm dealing with. So you want someone who's got best interest at heart, not someone who's just, every time they call you, they just want to sell you a product. That is not a financial advisor that you need to be with. So I think the right time would be to say, at that time when you are not feeling that love, that's when you need to say, it's time out. And you can do that by looking for, so when you decide that you want to break up, what you do then is look for a new financial advisor, and then you can look at appointing them to take over your portfolio. So that's how it basically works.
For those of you that have just joined us, I'm chatting to Tulisile Nkomo, who's a financial advisor and wealth manager at NFB Private Wealth, around the importance of choosing the right financial advisor. This is something that my previous guest, Elke Brink, touched on, around the importance of getting the right team behind you. And it's something that Moneyweb's taken very seriously. And to the extent that Moneyweb itself has a team of advisors, Elke and Tulisile are both advisors that are available on Moneyweb's platform called Click an Advisor. You can simply find that on the Moneyweb website at moneyweb.co.za. It is also available on the Moneyweb app. So if you download the app from the Play Store or the App Store, you'll be able to find the Click an Advisor section there. And they're ready to assist, and they're more than happy to give you some financial advice. Tuli, before we wrap things up, I mean, we've looked at the importance of a financial advisor. We've looked at the red flags to look out for within a financial advisor and that sort of thing. Are there, I guess the question is, are there differences between a financial advisor and a wealth manager, a portfolio manager? Is there something that a financial advisor can give you at an advice level that you might not necessarily get from allocating your funds to a asset management company like the Sanlams of the world, or what's traditionally known as the Tide advisors that you mentioned to me? Where do the differences lie there? And in those differences, is a financial advisor better for me or for my personal needs, or is it a case-by-case basis?
I think the difference between a tied agent, so someone who only sells a specific product, to a private wealth manager that is independent, is that a tied agent would only be selling products that they are affiliated with, the brand that they're affiliated to. So even if something might be good from another brand, they cannot deviate from that. So there might be a bit of conflict of interest there. But it doesn't mean it's bad for you, because obviously they will sit down and make sure that they give you the best, but it has to be only their brand. But then when you look at an independent financial advisor or a private wealth manager, is that they actually don't have to work with a specific brand. They look at what is available in the market and then make a decision that is suitable for your personal needs. So that's the difference between the two, but it's not like a bad thing at all.
So having a financial advisor that offers you certain products versus having an independent financial advisor, there's no right or wrong answer for it. It just comes down to the ability to offer you more flexible products and to customize the solution, I guess, for what you're looking for. I guess in closing, my final question to you, Tuli, then becomes the importance of a financial advisor. If you had to sort of put that on a scale of, say, 1 to 10, or even 1 to 100, how important is it to have a financial advisor, to have one as early on as possible in your journey? And how much of a difference does a financial advisor contribute towards your success, or the success of your financial goals in the long term?
I think very important is to understand that a financial advisor's role is to assist you to achieve greater financial benefits in the long run. So our job is to make sure that we actually help you achieve your goals, and then the decisions or the decisions that we made for you or recommend to you are actually objective, in the sense that we take your personal situation, whatever, and we don't judge you. I think that's the most important thing, that we don't judge you. And also we help you save time, because people don't have the time to actually sit and do their own thing. So we help people save time by coming up with solution, making sure that everything is covered from a tax planning point of view. And also I think the biggest thing is that we save you money, because there are times where people make a lot of mistakes because they're anxious, they're emotional. So our job is to help you manage those emotions, and we'll hold you accountable, because there are times where people, they start with a plan, but then halfway through, they don't want to continue with it. So we help you achieve your personal goal the best way we can.
Before we go, Tuli, you mentioned that financial advisors are all regulated, and we can all go to the CFP's site and all of that to find good financial advisors? Are there other resources that we can use when sort of sifting through the pool of great financial advisors that we have in this country? Are there other platforms like the Moneyweb platform that we mentioned that has the Click and Advisor section? Are there other online platforms that you can share with our audience around where to find really good financial advisors?
I think the biggest one would be the individual service providers, because generally they would say this are our preferred financial advisors that we would recommend. So let's say if you go to a certain provider, you'll go to the website and say, I'm looking for a financial advisor, and then they would recommend to say, these are our preferred, and then you can make a selection from there.
Thank you very much, Thuli. That was Thuli Nkomo, who is a private wealth manager at NFB Private Wealth, just taking us through the importance of the right financial advisor and how significant an impact having the correct financial advisor can make on your investments, on your investment strategy, and ultimately on achieving the financial goals that you set out for yourself. That brings us to the end of our show and the end of this session in particular. I trust that you've enjoyed the session. We thank you for having spent the day with us and tuning into the conference. And from our team, until next time, it's goodbye.
Did you know that small and medium-sized enterprises, or SMEs, contribute more than 30% towards South Africa's GDP? They are the lifeblood of our economy and make up an incredible 90% of businesses across the country. I'm Akona Machoba, and I'm really passionate about small business. And I'm inviting you to listen to my new Moneyweb podcast, Small Business Conversations. I'll be digging deep into the minds of entrepreneurs and business experts to give you the essential information as well as practical tools you need to protect and nurture your business. Each week, I will talk to those who've made it in or influenced the sector on topics such as financing growth, job creation, the impact of SA's energy crisis, mental health, and the role of technology in the pursuit of growth. If you are interested in starting and succeeding in business, I would love you to join me and my guests from the 2nd of February on Small Business Conversations. You can find the pod on moneyweb.co.za, the Moneyweb app, Apple Podcasts, and Spotify.
Moneyweb, your trusted source for business and investment insights.
Well, that's it for the third Moneyweb Better Investor Conference. It was an honor hosting you, and I trust that all the views that was expressed here today have helped you to become a better investor. We will publish all of the sessions on moneyweb.co.za and our YouTube channel. So if you have missed any of them, you can watch them at your leisure. Please send us your feedback on the event to events@moneyweb.co.za or post it on social media. A big thanks to the Moneyweb team who put this conference together. I want to single out Danica, Tappy, John, Jono, Tracy, Mashekla, Jimmy, Simon, Kieran, and Suren, and there are many, many technical people behind the scenes. Thank you so much for putting this together. So, thank you for tuning in today. This is a wrap for the third Moneyweb Better Investor Conference.